This is some real change, stock options, trading journey. And today, this terrific Thursday, February the 25th, I want to thank you all for joining us and being a part of today's show. Let's get started, shall we? See what we got going on today. And I want to go ahead and show you my charts as well. Don't forget to hit the like button when you guys come on in. I do appreciate you. Especially if you're kicking it with us on the Kick platform as well. Let's talk about money. We got NVIDIA earnings coming out. We do know that NVIDIA earnings are coming out after hours. Definitely going to be interested to see how that affects the market today. Those NVIDIA earnings. On a little early today. A little earlier today. I already have my plans. I want to see how they work out, how they come into fruition today. Big shout out to y'all for being here with me. Go ahead and put up pre-market, see what we're doing this morning. Pull that up in one quick second. 86. 92. See how my plans line up on this large chart today. Okay. $6.97. Yeah. Break and retest of the 690. I'm interested in a call at the 690.7. Believe we could take it to the 692 and then possibly the 694. If we get over that 690.7, this is also a very important area. I have a white line here. You know how I feel about white lines. A lot could happen in this area. A lot of good things for bulls could happen today. Also looking at this for bears as well. It's really under 680. 687.5, 683.5, and possibly 682. If this all comes undone, it will come undone around that 686.5 area. So I'm gonna go ahead and put my alarm. Put my first alarm here at the 690.1 area. It's going to be my first alert. It's going to go there. Let's put that first alert there. At the 690.1, looking for a break and retest of that. A very important area. The bulls have the possibility to regain the month and the week. It's a very important opportunity for the bulls above that 690 area. I'm also going to put an alarm at 687. $687 and below. Because if it does come down, I want to get in it at the 686.5 area. Take it to the 685.7. If we get below that, then we're going to have a very nice opportunity, possibly even all the way down to the 682. So that's where I'm at with that. Let me show you what it looks like on a trading view chart. That's what it looks like on the trading view chart. I'd like to get in with that break of that 690, that 690.6 area, and take that up to the 694. If it doesn't happen and we do come down, it could possibly come below that. I got a line at 687. Once we break yesterday's close, if we come down even further, we could go all the way down to the 682. So I do like that as well. Again, for context, I like the 688 strike with a 690.7 enter, 692 first profit target, 694 second profit target. That's what I like for the calls. For the put, I want to see that alarm go off at 687 and 687 strike. I want to get in at 686.5. Take it down to 685.7. If we break that, 683.5, possibly 682 on the day. Keep in mind, it could be a very choppy day with NVIDIA earnings coming out this evening after hours. So let us keep that in mind as well. I want to thank you for coming out. Thank you for tuning in. Thank you for hitting the like button. Feel free to share any plans that you may have as well. Oh, today is Wednesday. I'm talking about some Thursday. Today is Wednesday. This wonderful Wednesday that we're having. 688. This is what we are looking at here, ladies and gentlemen. Potential retake of the week by the Bulls. Potential retake of the week by the Bulls. That's a sweep too. That sweep area, we get over that sweep, we go to the races. This is the 4 hour I'm looking at right now. Microphone check 1 2, testing, testing. All right, let's see what's going on now. It's Wonderful Wednesday. Very important area right here at this 690. The 690 represents an area, a sweep area that the Bears could use if the Bulls are able to get over it. Looking real good for the Bulls today. Don't forget, also this afternoon, after hours, we have NVIDIA earnings today. That is going to be very impactful on the market. How? I have no idea, but I can't wait to find out. So I'm looking forward to that as well. Special shout out to those of you who are here joining us. We appreciate you. Alrighty. Yes, sir. Quiet soul in the building. What it do, bro? How's everything? Yes, sir. Great day today. Grateful for today. What do you think about this NVIDIA earnings that's going to come out after market hours today? How do you think that might affect the market? I wonder if people are going to be aggressive prior to openings, prior to earnings, or if everybody might just wait and see what NVIDIA earnings will be. But there is a lot of talk about NVIDIA earnings today. I'm going to be very interested. Might be a good opportunity to take a next day expiration, just to see what happens. Kind of leaning towards that myself, to be honest with you. Quiet, to be honest with you. Unfortunately, I haven't been able to keep up with earnings like I should. No problem, bro. I'm just hearing about it myself. I just heard about it today, too. So, but regardless, the chart is still the chart. It's never the news. It's always the reaction to the news. So, We do want to remember that too. It's never the news. It's always the reaction to the news. But I tell you what is happening while I'm interested in it is because two things are happening. At this 690 area, the bulls take control of the week and the bulls take control of the month. A lot of things are very key in this area, and that is why I am looking for a call, okay, above that 690 area. I want to get in at the 697, looking at a 688 strike, get in at the 697, and believe we can take this all the way to the 692, to the possibly to the 694. Seems like the market is already moving right now. But that is beautiful. Still got 20 minutes until market opens. So we're just going to let it do what it does. And we will be patient. Market is already at where I want to be. That's where I wanted to get in right there, that 690.7. Hopefully I'll get another opportunity when we begin. And Kosi, call just went through last week's high. Yes, sir. I was just sharing with Todd that that's exactly where I want to be in at right now. I want to get in at that 697. And believe we can take that all the way to 694. What do you Nkosia, do you know anything about earnings? How do you feel about Nvidia's earnings this afternoon? Do you think the market might try to position itself for that, or do you think the market might potentially just wait to see what those earnings are before a move is made? But I know there are a lot of anticipation around earnings for Nvidia specifically. Go ahead and move my alarm up. I move my alarm to 697, the area that I want to get involved at. I see the market also came up to that area and also pulled back. So that absolutely is reaffirming to me that that's a very key area, that 690.7 and above. Again, if this fails and comes down, it could be catastrophic. We just gotta wait. We cannot anticipate. We just have to wait. And I definitely want to do a better job today. It's a very strong pullback. A very strong pullback. Alrighty, team. I see you all closer to opening bell. All right, team, I am back as we get closer to the opening bell. Jared Lewis is in the building, and Kosi said, just looked at the yearly chart for SPY and NVIDIA. It looks like choppy days ending down. None of these days had 47 speaking the night before as an additional catalyst. Here we go. Alrighty, I did what my plans called for me to do. I am in a call. She is taking off. For those of you who made my plans earlier, I wanted to get in that 690.7 area for a call, and then I wanted to take that to the 692 and then possibly the 694. Okay. Additionally, I got in a expiration date for ending tomorrow, just in case with NVIDIA's earnings turns out to be great, you know, and we shoot off into the stratosphere. So I am prepared for that. I also want to show you my trading view chart. On my trading view chart, you can see I was interested in this area also for that. Made these plans early this morning. 688 call, 690.7 entry area, 692 first profit taking area, 694 second profit taking area. Could possibly expect a little bit of chop today with NVIDIA earnings coming out, but we can already see what the majority of people are thinking, with a lot of orders placed right at the market open. Very grateful for that. Very grateful for this opportunity, as I truly, truly, truly do love trading. Again, full transparency, I am in a call. The Bulls now have control of the week, as well as the Bulls have control of the month. Go ahead and put my arrow up there so you guys know that I am in this trade, as you know how I do. Full transparency. Let's go on the other side. Alrighty, there we go. Done my job early today, team. Identified the area that I wanted to get in. When the market got to that area, executed my trade. Now I set it and let it. Gave myself even more room with an expiration for tomorrow. So there's plenty of wiggle room. Plenty of wiggle room. Let's just see what happens. That's all we can do now. And let's hear a little bit of what they're talking about on CNBC as far as the impact of these potential NVIDIA earnings. I am interested in that as well. And the trade is working out beautifully for me. I want to give a special shout out to myself. Yes, sir. Was at the market early today, prepared early today, executed right on time today, according to plan, setting and letting it. Nothing else for me really to talk about. I'm just let this chart play out. I'm gonna let the market do what it does. I'm not even in control of what it does. I'm only in control of the areas that we see a potential opportunity in. Taking advantage when the opportunity presents itself. That's it. Let's rock out. Set it and let it. Literally, set it and let it do what it's supposed to do.
wants it. Wants rocket ships, and it. Right.
So, well, it wants SpaceX. And it's
Oh
going to
my
want
God,
OpenAI,
that's a double for people
and
who
it's
put
going to
money
want
in.
Anthropic.
Right.
I don't know what else it's going to want, but
It doesn't want Oddity. I don't know if you've seen that
I don't know
one.
what Oddity is.
It's a cosmetics company it's kind of an AI cosmetics company.
Oh,
AI.
what's an AI cosmetics company?
I'm an AI anchor. I don't know. I mean, you can AI anything, right? You put that before anything. Well, but these guys have an artificial intelligence-driven online platform for beauty and wellness.
Right.
But that stock's down 15. That's kind of a hammering. That's not a 2-for-1 split, guys. It's not.
I did want
Don't
to
relax. It's not a 2-for-1.
The journal wrote up. We've been talking about it, guys. But when it comes to the alternative asset managers and private credit, of course, this is just going to be a continued question. We're also keeping an eye on the BDCs, which remember there's more of a retail audience, and whether or not people are going to want to continue to try to pull, and whether in fact they're going to have to gate those people in terms of getting their quarterly liquidity.
But those are the private BDCs, not the ones you can just jam if you want public market BDCs.
The private ones.
Yeah. UBS today says private credit defaults might go to 15. About a month ago, they were at 13. That's if AI causes a severe disruption in that space.
I think that it's not bad. I think it's the multiple that people pay for these companies, not for the private.
It may well be, and as we pointed out, it's not like this is going to be this quarter phenomena. Although with Workday, maybe we take a closer look there, guys. I haven't.
They still have a good book of business.
Right.
It's just
but it's those names that you're worrying about. But near term, first of all, they're going to make an argument that says they're, in a good position and that they're going to be charging for outcomes as opposed to perhaps for seats. I'm not saying they're doing this specifically here, but that's sort of what you're going to start to hear. But it's not about their ability, and this company's. It's not about these private software companies' ability to repay in the near term. It's just simply whether they can sustain over the longer term.
As you said, IGV's still below Liberation Day lows.
But I look at ServiceNow. ServiceNow's a really good company. Okay, it's just a good. Bill McDermott. He's got a lot of AI. He's done a lot. It went from onboarding to basically running the infrastructure of the company. And I think they're just an amazing company. It is down 34%, but it still sells at 24 times earnings, and that's the Achilles heel. Mark Benioff's company, which reports tonight, sells at 15 times earnings. That's a radical adjustment. Maybe that's
enough. It's a radical adjustment.
Maybe that's enough. But if
is it enough? That's the. Maybe it's enough. That's the key question.
Well, maybe so many people in the part of the company that is not the growth agent force. Maybe there's a lot of other people that have been laid off, so you can't pay. They're not going to pay you more money if you have fewer people that use it.
Right.
And that's what the Workday phenomenon was.
Unfortunately, you can't also disprove the negative because it's
because if it's not this quarter, it'll be next quarter.
And if it's not the next quarter, it'll be the one after that. I mean, you heard Dario Modé at the beginning of the broadcast anyway.
Nice guy.
We got a tsunami coming.
Yeah, the tsunami warning.
And we're not looking at.
That's better than the canary in the coal mine.
That's kind of frightening.
We don't use the president might bring back the coal mine canary, right? Coal would be the solution. We have. How do we get from a tsunami to a coal mine? Now don't forget we're the Saudi Arabia of coal. Remember we were the Saudi Arabia. We built all those coal plants that they lasted for 40 years. That was Jimmy Carter, and I think that the president would like to be. You can make a coal plant lickety split.
Okay, so that's for the power of the data centers that are to run the AI
doing a transition
that are creating the tsunami that is going to.
Well, I'm just saying, what is the analogy? Is it the canary in the coal mine? That had been the analogy until I saw it was the tsunami. No one yet is using nuclear war. I may go there.
Two different things. One is the power problem, and the other is AI is going to wipe us out.
Yes. Yeah,
they're two different things.
Well, AI was a dirty bomb. Now I'm getting a sense that AI is an actual atomic bomb, but not an H bomb. We have not seen that. The Easter Christmas Island, we were bombing the Christmas Island. Remember that one? We took the H bomb.
I think you know what? I think he's just like
no. I'm Oppenheimer.
He's cycling now.
It's not Oppenheimer.
He's lost.
Which was Comcast, by the way.
It was a great Universal picture. Yes,
it was
a tsunami, and now he's just riffing.
Christopher Nolan, you got it.
He's like a jazz musician.
just
Coltrane.
Who knows where he's going?
Coltrane.
Modal.
There you go. Coltrane.
Yeah, my favorite things.
It's okay.
Still
Coltrane.
the best.
It's going to be fun.
All right,
it's going to be fun.
No, I'm just saying that we are getting more and more dire. And yet, I think that it's to a small group of companies that it's really dire. And yes, what you have to do is say, is IBM vulnerable? You have to go from saying no to being maybe. And that's why I don't like definitive statements that we're not vulnerable. Because there's some kid in a college dorm right now who is trying to figure out exactly what Workday does. And in another 3 weeks, David, you might have it. She might have it. That's not a coal mine. That's
Or it could be just somebody at a company
existential.
who's actually vibe coding something that says, maybe our HR, we can just do this.
Yeah,
Right.
yeah. Well, there's Dyer, Jim, and then there's the beer business Dyer. Diageo, again,
All right. Can we
close
just
to
talk
a
about that?
multi-year low. I don't know if you saw this chart out of B of A today. Shipments they expect in 2026 beer business at 37-year low. I mean, it is just fallen off the cliff.
I read the look. I know they got a new CEO at Diageo, and he's a very straightforward person, Dave Lewis. I have to tell you, I thought that his conference call, he just got there, was once again avoiding the real problem. And the real problem, by the way, fastest growing aisle in any liquor store is the agave spirits aisle, and their numbers were horrendous in tequila, Don Julio, and Casamigos. I'm talking down 27, 30%.
Are smaller brands, like in Mezcal, for example, taking share?
Well, you had to be artisanal. And what happened is there was a labeling problem for the older ones. And they have not been able to, let's say, clean up their labels. But Brown-Forman is overvalued. You, of course, also, again, he says GLP-1, don't worry about it. Okay, I won't worry about it. The fact that it tastes, when you're drinking whiskey, it tastes like you're having it for breakfast. You don't drink it for breakfast.
I know. People don't drink anymore.
Well, they drink ready to drink.
Go out with people, and they're like,
RGG.
I'm like, really? You're just going to have, that's fine.
But look, these
Okay.
were the greatest.
Nobody
This
has
was
to
a
drink
group.
anymore.
They cut the dividend in half. Oh,
Yeah.
this was a group that you could count on.
It's a journalist.
in
I
good
went
or
to a
bad
bar.
times.
That's how you did things. Sit
Pen
with
and
your
pencil.
sources.
Did you ever go to the
have
pen
them
and
have have them have a few drinks. Now it's like, oh, I'm gonna have the soda water.
No, you want Tropicana from Pepsi. PepsiCo's been really good stock here. But Frito-Lay somehow has managed to beat GLP-1. I don't see Diageo outrunning it. That was a miserable quarter. I mean, horrendous.
Wait, which one?
Diageo.
Oh, Diageo.
Yes.
Oh, and they were in
Not
denial
Pepsi.
about even the things that were so obvious to all of us. Like when something's down, like Casamigos, when it's down like 27, 30%, that's not an oddity. I didn't mean, it is kind of an oddity. That stock's down 50%. How's Whirlpool doing? I know they
How's
priced
what
that deal
doing?
at
A Whirlpool
69.
now? Wow, he's
Tepper
just
loves it.
all over
Jim,
today.
really quick on the
Yeah.
banks.
Yeah, it was a good deal.
Yeah, the banks.
On the banks, it's the worst sector of the year. It's the XLF is flat since June. Yesterday, underperformance versus the S&P. Actually, the last 2 days of underperformance is the worst since March.
But the president, everyone was expecting the president to talk about the 10% cap, and he didn't. He gave the banks a pass,
Well, we
and
had
that's why they're
Warren on
rallying.
yesterday, and she was like, I don't know what happened to our little
He won't
conversation.
return my phone
Yeah.
calls. He won't return my emails.
Really?
Susie Wiles won't return my email. Yeah, that's what she said, Senator Warren. So the 10% cap may not happen. But I mean,
Well, it
listen,
didn't happen.
M&A activity may not be quite what we thought it might be. Even, you take software out of the equation,
But-
unless somebody gets brave and starts buying these things.
Banco
take
Santander.
privates.
Banco Santander bought Webster.
I don't know.
And
but
that was a
there's
good
some
deal.
worries. There's overall worries on the
About
debt
the Santander
in
deal?
terms of credit, and I think right now.
Look
So-
at Banco Santander. Could we have a symbol? This SAN. SAN. Look at this. This is a bank that's making acquisitions in America, all over the world. It's it's top 5 in so many places. The largest bank in Europe.
And
Look
it's
at
been
that.
a great call from
That's
you. I'm
Anna
just
Boutine.
making the point of the things that are concerning
that.
investors right now when it
Well,
comes to
she's
the
bold.
banks, Jim. That's all.
She's bold. The
what?
others are not. She's bold. She just bought this
Bold.
great out.
Bold,
She's
yeah.
bold and gold. I just bought this great bank in Connecticut. I love the bank. It was a brilliant acquisition. Just now she bought it. It's very impressive.
Okay.
She's not lucid. Are you lucid today?
We're going to get to Lucid
be.
later
That's
on
not-
this production guidance. Also not good.
That's
Watch
right.
bonds today. Some Fed speak on the calendar. Barkin, Schmidt, and Musalam as we work through the session today. We'll get new homes at 10 and a 5-year note auction today. 10-year 405. Take a look at shares of First Solar. This is going to take you back to maybe September of last year as they cut their revenue guidance for the full year. EPS miss, bear downgrades as we continue to look at some of the impact on these green initiatives. Dow, though, hanging on to about a 200-point gain, and we're still above 6,900. We'll get Stop Trading with Jim next. Let's get to Jim and Stop Trading.
Okay, so Oracle, finally someone steps up and says, you know what, it's time. The Oracle sell-off, they think OpCo may have run its course, or at least getting there. This has been one unbelievable stock on the way up and one on the, unfortunately, on the way down. But it's an interesting idea. They're going to build all these data centers. Maybe they know what they're doing. They're going to be able to get some money. I don't want to go with this, but I do point out that someone finally steps up, and that is what I like. I like an analyst who hasn't liked it, who's kind of, okay, now it's good. It's very encouraging.
Do you think after tonight we're going to return to a bit of a tech narrowing and hence maybe a higher index?
Well, look, I think I'm not saying we're going to go back to Magnificent Seven. I do think that after Jensen speaks, you're going to have some clarity about why an Anthropic can do so well, because it's about it's about accelerated computing, not just AI. And accelerated computing is remarkable. I think the world of AMD, I think the world of Lisa Su, but there are qualities that Jensen's going to talk about of his next chips that are better reasoning.
This is what I was going to get you, because there is a school of thought that the next iteration of the conversation is going to be about better chip efficiency, hence less need for memory.
Yes,
and that maybe some of these memory names.
Well, look, I mean, Corning's in there using glass instead of copper. That certainly cuts the cost because of the heat.
Cut the cost.
So
don't forget, on the point you're making, NVIDIA did do that large deal with Grok. Remember, I mean, it wasn't really an acquisition, but this was a company that makes accelerate compute chips.
Right. Jensen's going to solve this. I think that this is not. I keep thinking the industrial fourth revolution, some of these problems are going to be solved. Remember, who thought that this was going to produce millions of jobs? It wasn't supposed to.
But does
It
that
didn't
mean that a
exist.
Micron and a Western Digital are vulnerable or not?
No, he can't do it fast enough. He just can't. I think that he's got some things on his mind. Remember, he takes a 20-year view and then walks backward, which is really an amazing way to think. We all don't. I don't know anyone else that thinks like that. He's got Vera Rubin. He's got Richard Feynman, the next one. And I think he has a vision of how to be able to save the cost. He doesn't like, obviously, hurting the environment. It's one of the most important priorities for him. A little different from the president. A little gulf there.
How about tonight?
Okay, so I have I've got Snowflake, which is, we got to find out, are they a consumption model for data? That could work. And I've got Arista Networks. And David earlier talked about Coltrane. I think Coltrane, double check, Arista was, I think, may have been his initial.
Oh, his initial label?
Label?
Yeah.
Before, what, Concord? Blue Note.
Blue Note.
Yeah, whatever,
Blue
of
Note.
course.
And my favorite
Great,
was Aisha, just for
Great Philadelphian, right?
big,
Yeah.
yes, and yet they never did anything. You know, like Jefferson, they don't have anything for Jefferson, they don't have anything for him. I mean,
Nothing for
the greatest
Coltrane?
Philadelphia we've had in the last 100 years. Coltrane.
Yeah, I hear you.
Jim, we'll see you tonight. Important show, Mad Money, 6 p.m. Eastern Time. As we hang on to gains here, S&P 69.28.
Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live, as always, from Post 9 of the New York Stock Exchange. Coming up on today's show, is NVIDIA still the AI bellwether it used to be? We'll talk about what's at stake when the company reports results in just a few hours. Plus, CEO of EV maker Lucid will be on with us on the back of results as questions swirl around the future of the EV market and as the company lays off workers. And we're on Supreme Court watch again as we await potential decisions, including on President Trump's authority to fire Fed Governor Lisa Cook. We don't know if that's coming today, but we'll monitor it and bring any headlines as soon as we get them. But guys, I have some good news. It's a little pushback to the narrative lately and the fears lately about AI coming for all of our jobs, coming for white-collar jobs, coming for the economy, coming for consumer stocks, basically coming for everything. Remember, this Citrini note created a lot of fears and a lot of disruption and a lot of sell-off on Wall Street. Well, guess what? Citadel has a very interesting note out today from Frank Flight, who's a sort of macro strategist over there, with some pushback. And the thrust of it is that just because AI is accelerating very quickly in terms of its technology and what it's able to do, does not mean that the economy, enterprises, and consumers will be that fast when it comes to adopting it. And just a few charts that he highlights here that I thought were worth sharing with everybody. Number one, rest assured, software engineer job postings are way up. In fact, they're much higher than overall job postings. Remember, this kind of goes against the narrative that all the software engineers are going to be extinct because Claude Code is just going to do everything, right? That we're not going to need as many software engineers. Right now, there's still a ton of demand for it, which I think speaks to a little bit of the slower adoption. And then the other chart that I just wanted to show was the overall enterprise adoption. And this comes from the Citadel report, but he takes it from a St. Louis Fed survey about whether businesses and working age adults are using AI. And what you can see here is that there's a lot of different lines, but basically it just shows that the share is rising slowly. It's not rising quickly. It's not a linear move. And I think that's the bottom line. They say, for AI to produce a negative demand shock, the economy must see a material acceleration and adoption, experience near-term labor substitution, no fiscal response, negligible investment absorption, and unconstrained scaling of compute. And there's not evidence, first of all, historically, that happens in technology cycles. It's usually more of an S-curve in terms of adoption, or that it's necessarily happening right now.
Yeah, you'll hear about the J-curve and the S-curve. There's no doubt about that. And many of the software companies will actually give you a positive that will say, ultimately, we're going to get paid on outcomes, not on seats, and we're operating on data sets that are individual to these companies, so they're not available to the large language models. That said, I think, Sarah, the question that investors really have is what's the terminal multiple for many of these companies? I don't think many of them expect that there's going to be a diminution over the short term in their business. But the question is what it means longer term for their business models, and therefore are they deserving of the same multiples because of the recurring revenue nature that had typically been the case for their businesses that was deserving of a higher multiple. That may no longer be the case. That is what we've seen. Now, whether or not the sell-off that has already taken place is discounting that already is certainly a key question for investors.
And what I'm talking about is less the software sell-off and more the idea that there's going to be some sort of macro shock in the form of mass layoffs and big consumer spending declines. Just to put another anecdote here from Bernstein on enterprises and their adoption, just what they write about it today. Bernstein also pushes back a little bit on the SaaS apocalypse that you were just talking about, saying enterprises have never been fast to adopt new technology, especially technology they don't fully understand. Well, consumer adoption is already happening. Enterprise AI adoption will be much slower due to lack of maturity for the technology, concerns about security, governance, and legal regulatory implications. Important data still on premise that will need to move to the cloud, as you were saying, and it takes time to bring enterprise apps to market and build a customer base. So yes, it all feeds into the same question, which is just how fast is this all happening and how disruptive is it going to be to businesses, to the job market, to the economy. You always say, we don't know. But
no, of course, we don't know. I mean, listen, you got Dario Modè. I played the sound earlier on the last hour, who's one of the leaders when it comes to AI in this world, saying it's as if the tsunami's coming at us. It's so close we can see it on the horizon, and yet people are coming up with these explanations for, oh, it's not actually a tsunami. That's just a trick of light.
So buy all of our products.
There hasn't been a public awareness of the risks. So there are different views.
No, for sure, and we pay attention to all of them. But I just thought it was a little comforting to show the adoption trends, certainly from business. I mean, you talk to business. I mean, I get this too, certainly from like big banks it's happening, but it's not happening at the speed necessarily that the market may be
without a doubt.
assuming.
I think that's a fair point. And again, when it comes to job losses, which obviously is something you're going to cover closely, you're thinking about a lot, given your macro focus. Macro focus, can I actually?
Yeah,
anyway,
that's a macro focus.
Yeah, no, that's what you are.
That's what I'm trying to do.
Is also going to be, right, are the job losses really coming anytime soon, or is this something that may never happen, or the dislocation is going to be over a period of time that it's not that
dislocation, but maybe not
dramatic.
Shock.
Right.
And that we'll continue to look for. I mean, we don't see evidence of the shock yet in the macroeconomic data of a job shock or anything like that.
Not yet.
No, not yet.
Let's get to
Layoffs are still low.
Let's get to the broader market, talk about the stocks for today, led by the NASDAQ. Joining us is Michael Kantrowitz, Chief Investment Strategist over at Piper Sandler. Michael, good to have you. Thanks for the time.
Morning. Good morning.
Going into NVIDIA and Salesforce tonight, some discussion about whether or not we continue to see a broadening and dispersion, or whether we get back to our tech knitting of the last year.
Yeah, well, we made the call back in September of last year as we started to see the green shoots of a broadening macro backdrop take place for the first time in 4 years. And what's different about this broadening in the market that's been going on since October is that it's the first one that's backed by fundamentals. In 23, 24, and the beginning of 25, we had a lot of periods where small caps and cyclicals outperformed for a few weeks, but it didn't sustain itself because those were all events based on lower rates. Rates haven't fallen, yet the broadening has certainly taken hold, and it's the improvement in the fundamental data that I believe is supporting it and has a ways to go before the story's over.
You're right that we couldn't quite crack 4% on the 10-year. You think we will, though?
Yeah, I do think we will. I still think there's plenty of labor market fears just from the cyclical aspects of employment being a lagging indicator. I'm not expecting any kind of strong improvement in the labor data that's going to be sustainable. I would think that would be a risk to higher yields. If anything, we are seeing continued sluggishness in the market, nothing terrible, but the continued fear of AI, I think, is what is pressuring yields year to date. There's really no macro explanation for why the 10-year has fallen as much as it has. We've seen better jobs data. The inflation data came in pretty much as expected. But if you look at the relative performance of the Mag 7, they do a pretty good job at explaining why the 10-year has been weaker in the last several weeks.
That sort of gets to what I was talking about, which are now larger concerns about what AI is going to mean for jobs and for consumer spending and for the economy as a whole. Do you think fears are overblown?
I think the near-term fears are overblown, and there's a tremendous amount of speculation and extrapolation of what may or may not happen. Markets don't tend to be that forward-looking, particularly 2-3 years out. So I think this is a current narrative that will eventually resolve itself, particularly as we see some better macro data and the jobs data continue to more or less stabilize. If you want to look for job weakness or strength, look at the NFIB hiring report, which is about, it's been stable and if anything has been improving in the last 9 to 12 months. That's not showing any signs of any kind of imminent job weakness. But the good news, the silver lining of employment weakness over the last 3 years and going forward is that it helps to resolve the inflation anxiety that investors are still very fearful of. So I continue to see a sluggish job market as a positive that keeps yields and inflation expectations contained and allows this soft landing and broadening to continue to play out.
Right. We could go on. Conference Board labor differential tells a little more worrisome story, but to your broader point, does that mean you're playing in things like housing and other rate-sensitive sectors at the moment?
Yeah, I think rate-sensitive sectors are a good place to be, but I don't think the market needs lower rates anymore. Sure, that would certainly continue to help housing, but unlike the last few years when small caps and broadening only took place when we got lower rates, now we're actually getting better economic data. We're seeing the broadest manufacturing data in 4 years, both in the US and globally, which is why I think you're seeing international stocks with more cyclical sector exposures outperform. So when you have better data, you don't need to lean on lower rates as quite as much. So more in the value space, industrials, smaller regional banks, transportation. So, they're classic cyclical names that have been really ignored and kind of left for dead in the last several years.
Cleveland Fed did a paper this week about tariff uncertainty and the ways in which it suppresses investment and hiring and durable goods purchasing. Do you think if we move into a period now where we're going to start arguing about 232 and 122 and all of this mess of trade tools, that's going to hurt consumption?
I don't think incrementally. If anything, we should see the tariff rate is effectively going to be likely lower a smudge. Yes, we've got more uncertainty now that we've had the Supreme Court's decision, but I don't see that as being a massive headwind to consumers incrementally. I think the benefit of lower rates, the stabilization of inflation, and tariffs that sure will continue to be a headline issue, but not a systemic macro issue. So no, I don't see that as a big headwind going forward.
That's good stuff. By the way, beautiful winter wonderland over your shoulder. A gorgeous shot in the yard. Michael, thanks. We'll talk next time. Michael Kantrowitz. By the way, we just got word this morning that we will not get the Lisa Cook decision today from the Supreme Court. Still a couple decision days on the calendar, and the week ahead we'll watch closely.
All right, meantime, keeping an eye on shares of a lot of different software companies, including Workday, which is down in the early trading. Seema Modi is here to explain why. Obviously, the company did have its earnings, Seema.
He did. The company did, and Workday founder and CEO Anil Bhusri, David, said point blank he doesn't see AI replacing or relegating the company's business, adding that application domains are hard to build and that no amount of vibe coding is going to produce an entire business. He ultimately sees Workday and the large language models as partners where to create a systems of record, Workday will be using the reasoning capabilities of OpenAI and Anthropic. But those comments seem to be not resonating at this point. It's light guide for 2027, raising some new questions around competition. Mizuho analysts calling its outlook, quote, disappointing, though they do view Bhusri's return as CEO as a net positive. RBC Capital analyst Rishi Jaluria sticking by his outperform rating, referencing early signs of AI traction. The company did reveal new customer additions and ways both its recently acquired companies, Sana and Paradox, are being integrated into the company's toolkit, while also working to automate key processes across human resource management, and that does include payroll. But M&A, guys, that's going to be key. Even when we hear from Salesforce and Snowflake reporting tonight, how much do these giants lean on inorganic opportunities to boost their AI capabilities, especially given the big discount so many public and privately listed software names are trading at right now? Sarah.
And, Seema, I'll come back to you. I mean, interesting looking through the call, Bhusri. You're going to hear this from a lot of these companies that do important things for other companies. When he was talking about payroll, he's like, you can't be probabilistic. It needs to be 100% accurate and completed 100% of the time. And you're going to hear that a lot. Probability versus, probabilistic versus deterministic enterprise apps, I think, is another thing that they're going to lean on to say why we're so important and we're not getting kicked out of the enterprise anytime soon.
Sure. And then I would also reference some of the comments by Workday founder and CEO Anil Bhusri, who talked about this disconnect of, well, okay, we're working on agentic capabilities to automate more of the workflow, but then why is the guidance so conservative? That was a big question on the analyst call, and he said, listen, I just joined, I'm back in the CEO seat just as of a few weeks ago. I'm an optimist, and I see that some of the agentic things they're working on will come to realization towards the back half of this year, David. So maybe we're still in the early innings as these companies sort of catch up to this realization of how fast Anthropic and OpenAI are able to come up with enterprise offerings.
Yeah, how much market patience too?
Yes.
It's 56% off the 52-week highs. Thank you, Seema. Seema Modi. Here's our roadmap for you for the rest of the hour. Still ahead, from tariffs to affordability to home ownership. We'll talk about the big takeaways for Wall Street from President Trump's State of the Union address.
Plus, NVIDIA is due out with quarterly numbers. It's just a few hours from now. We're going to look at what those results could mean for, of course, the entire AI ecosystem.
And we'll talk to the CEO of Lucid, out with numbers today. Its interim CEO, Mark Winterhoff, will join us with his read on EV demand when we return.
Welcome back. NVIDIA's earnings report after the bell today is going to be a key test for the entire ecosystem of AI. Analysts are expecting another blowout quarter for the chip maker. But of course, we'll be listening for updates on revenue guidance and, importantly, shipments of GPUs. Let's bring in Matt Bryson. He's senior equity research analyst at Wedbush. Has an outperform rating on NVIDIA's stock. I guess we'll start off with what you're expecting, Matt.
Just like you said, I think they're going to come in ahead of estimates. They're going to guide better, and they're going to tell us that demand is still pretty amazing.
Yeah, no, they've done that before, and typically the stock doesn't, at least of late, react too much. I'm sort of curious as to whether you think or what they need to do tonight to actually get the stock, not that it isn't up, because it is up almost 5% this year, but nonetheless, to get that kind of appreciation that investors became accustomed to not that long ago.
Yeah, it's a little bit hard to say because, as you said, the last couple quarters they've outperformed, and the stock hasn't gotten a lot of love from the investment community. Having said that, I see a very similar setup to 2025. You have fears about DeepSeek. The stock wasn't doing well, and they hit targets a couple quarters in a row. You had good news out of GTC. And all of a sudden, NVIDIA's values increase significantly. I think we see the same thing in 2026.
I've been fascinated this morning with this question of AI adoption from the enterprise. How do we extrapolate the demand and the sort of exponential rise in demand for compute that we see and that we're expecting from NVIDIA with how quickly it's working its way into the enterprise and into the broader economy?
It's hard to say, and this has always been a struggle. I think the difference now versus 6-9 months ago is we are seeing this increase in demand for standard compute, which is supporting inference, and that's real applications versus just training models. I think from a numbers perspective, probably the easier way to think about it is you've had 3 of the hyperscalers give you their spending profile together. They're looking for roughly a 75% increase in CapEx. More of that's going to go towards AI, and NVIDIA should be able to maintain share this year. So they should grow at something faster than 75%.
Yeah, I mean, listen, we know Meta's gone up enormously in CapEx, and Alphabet and Amazon. We can all add up the numbers, and we know a lot of that's ending up, not all of it, but a lot of it in spending on GPUs from NVIDIA. I guess, is that already reflected in the stock price?
So I think we've seen these CapEx increases, and we haven't seen NVIDIA's stock price increase so much. So even moving back 3-4 months, there were concerns that the CapEx might not come in where it needed to come in 2026. And, we saw all of these hyperscalers announce higher than expected spending. And so I don't think it's in the stock. And I think, again, that you see NVIDIA's revenue simply grow faster than is in models, and people are going to wake up and realize that this is a company that is trading at 20 times earnings or even lower.
I know, yeah. I think you have it in your note 27 times or 32 times 27 estimates. Another analyst this morning say it's multiples below that of McDonald's, but I guess, the question is that going to change? I mean, your point, will they wake up? I don't know what's going to make them wake up. It's been kind of hanging in that same area in terms of multiple for a while now.
Yeah, so I think the fear has been that there's competition out there. Obviously, yesterday we got AMD announcing a win with Meta. I just don't think you're going to see that this year. If nothing else, it is so hard to get components, in particular memory, and NVIDIA's just done a better job than everyone else in terms of getting their ducks in a row there. And so even if Meta falls in love with AMD, you can only ramp so much, at least in the near term, because you just can't get parts.
So is NVIDIA the best risk reward in the sector right now? Because it looks like so it's outperformed AMD, which is flat this year, but certainly underperformed a lot of the memory chip makers like a Micron, which is already up 50% this year.
I think NVIDIA's, again, I think it's in a great place, and I think that I think real expectations out there are $10 plus for 2027. I think that NVIDIA, when it begins to outperform, it's historically traded at closer to 30 times. versus you're kind of close to 20 times that number right now. And that kind of gives you an idea of where the upside could be, assuming that again, they execute to my expectations.
All right, well, we're going to be keeping a very close eye on it. Matt, thanks for your time today. Appreciate it.
Anytime. Thank you.
Still to come on the show, President Trump doubles down on tariffs in last night's State of the Union address. We'll talk about the big takeaways for Wall Street next. Plus, Lucid making headlines after a wider than expected loss and a new round of layoffs. The company CEO will join us to discuss. Also, check out Joby Aviation and Uber as we head to break, because these companies are launching Uber Air, powered by Joby in Dubai. Riders will be able to book Joby's electric air taxi in the Uber app. Cool. Joby expects to carry its first passengers later this year. We'll be right back.
Well, we got the latest chapter in the saga for the ownership of Warner Brothers, and it's a significant one because Paramount has now put itself in the prime position to own Warner Brothers, unless, of course, Netflix chooses to compete with its latest offer. Now, it hasn't been deemed superior yet, but it is likely to lead to a superior offer, is what Warner Brothers board said late yesterday. That is the $31 a share, all-cash offer for the entire company, and most importantly, the certainty that Paramount provided around that offer, saying that Larry Ellison and or others will provide more equity should that be needed towards close. If in fact the banks somehow were to say that Paramount was not in a solvent state, seems unlikely, but they wanted that assurance. They've carved out the performance of Warner Brothers cable networks in terms of contributing to any claim that Paramount might try to make about a material adverse change. So they have given Warner Brothers board certainty along with $31 and even a higher reverse break fee should the regulators say no to the deal, all of which puts this in Netflix camp. Now, to be clear, it hasn't been deemed superior yet, but my expectation is in the next day or so, it will be. And then the clock will begin for Netflix, as is its right, to have 4 days in which it can match the Paramount offer. Now, it doesn't have to match it dollar for dollar, and it wouldn't, remember, because its offer is a different one for the studio and streaming business, and then involves a spinoff of Warner Brothers cable networks. And of course, there has been a lot of debate about what those would be worth, given the significant debt load they have, given the multiple being applied. Our parent company, which is a compilation of cable networks, being quite low, that multiple. So Netflix got to decide. Now, based on conversations I've had, I'm not reading too much into Netflix's decision previously not to preempt by raising their offer so that they didn't have to give a waiver, or raising their offer after they were told this is likely to lead to superior offer from Paramount. They're making their decision. They're going to have their 4 days. They certainly have the capacity to compete should they choose to do so. The key question is whether they will. And you can see some investors in Netflix are saying they don't expect they will, because they're sending that stock higher, which is the expected response should Netflix choose to step aside.
I was just looking at the Kalshi odds. I don't know, have you gone to that?
No,
on who will acquire Warner Brothers? Paramount, 54%. That's the favored.
Yeah.
Netflix is 39%. But Netflix was favored as of last weekend. So it's really shifted.
Yeah. Listen, there's been no let up in their efforts to acquire the company. Ted Sarandos has has been vocal. He's been out there talking. They've been working with regulators.
Last week, right?
Exactly. So, they haven't stopped on that front. They also, though, have used the words disciplined and not a must-have, but a need-to-have when they've described this. I don't know what they're going to choose to do at this point. I only know not to read too much into their decision not to yet preempt, because sometimes we will see companies not want to see the matching rights ever have to be exercised. You want to just stay in that position where it's your merger agreement. Netflix has chosen not to do this here, but they're going to have their 4 days, and it will start soon, but not yet. Not yet.
See how much they want it. I did also note that David Ellison of Paramount was a guest of Senator Lindsey Graham at the State of the Union last night.
Address. Yes. Well, of course, remember, this would bring together CNN and CBS were Paramount to be successful in its acquisition of Warner Brothers, and obviously the Warner Studio along with Paramount. A lot going on there. Just an interesting
juxtaposition with him at the State of the Union and then Trump bashing Netflix's board member Susan Rice on Truth Social just a few days ago. They're going to need the administration sign-off, whoever gets this.
Well, they're going to need the DOJ's sign-off, which typically has not been considered part of the administration in the sense that you're describing it. But yes, that's right.
Meantime, let's get a CNBC News update with Courtney Reagan. Hey, Court.
Hi, Carl. A Ukrainian delegation will meet today with U.S. envoy Steve Witkoff and Jared Kushner in the lead up to the next round of trilateral talks with Russia. Ukrainian President Volodymyr Zelensky says today's meeting is taking place in Geneva and will focus on details of a post-war recovery plan for his country. Zelensky says the talks, including Russia, could take place as early as next week. Wellness influencer Dr. Casey Means is appearing before the Senate this morning for a hearing on her nomination to be the next Surgeon General. She was supposed to have a hearing in October, but went into labor the day before she was set to appear. Means, who is closely aligned with Robert F. Kennedy Jr.'s Make America Healthy movement, is expected to face tough questions about whether she's qualified for the role. And Amazon is letting users change the personality of their Alexa Plus AI assistant. The company launched the new feature today, which lets customers decide between 3 styles: brief, chill, and sweet. The feature is available for all users, and Amazon says there's more to come. How about encouraging? I've got some other suggestions. Carl, back to you.
Thanks, Court. Still to come this morning, the big Wall Street takeaways from the State of the Union last night. Raymond James, Washington policy expert, will join us. Later on, Kava surging on these better-than-feared comps from the Mediterranean chain. Now up 35% this year. Company CEO is going to join us later on. We're back in a minute.
President Trump giving a record-length State of the Union address last night, spending much of his time celebrating the U.S. economy, also announcing a proposal to offer workers access to government-backed retirement accounts, and again calling for a ban on large institutional investors in the housing market. Let's bring in Ed Mills, Raymond James, Washington Policy Director. It did strike me that there were a few proposals in there, and some reiterated, where he really could get bipartisan support. The investors in housing. He also mentioned the congressional stock trading ban, which got a standing ovation from Senator Elizabeth Warren. What do you think happens next?
Yeah, what I think happens next is that there will be an attempt to do some of these things. I'm not too optimistic that there is bipartisanship that's going to break out here in D.C., Sarah, and that we can get a lot of these across the finish line. You mentioned that stock trading ban. Right now, there's been a move to get that done, but it excludes the White House and excludes the executive branch. And so there's not a desire from some Democrats to do it unless it includes everyone. So oftentimes, perfect is the enemy of good. And while we do have a very long speech last night, Sarah, it was short on new details, and there were actually very few market-moving events, which is, I think, part of why we see a generally positive market reaction this morning.
Yeah, no tape bombs, according to your note this morning. I saw on tariffs. I mean, he sort of played down the impact of the Supreme Court decision and said he's going to march ahead. Also, and I don't know if this was ad-libbed or not, but he said, you know, the tariffs are important. They've helped me negotiate ends to wars. I thought that was an interesting way to put it. But for anyone thinking that, I don't know, we'd see tariff relief, not happening, right?
Yes, I mean, what we've told clients here at Raymond James since the Supreme Court took this up and since the Court of International Trade took this up is that it was likely going to get struck down. However, that only meant the process was going to change, that the outcome was unlikely to change. And that's basically what President Trump told us last night. I think investors were bracing for more announcements. He said that he wants to get aggressive. He wants to continue to pursue this. I do think it is absolutely true that one of the end goals of these tariffs is using the economic leverage of the United States to force policy change. We have trillions of dollars of investments that could come into the United States, trillions of dollars of market access, and the ability to drop tariff, non-tariff barriers and use it from a geopolitical cudgel. Those are really important things. I think what we see from a market perspective is they just don't like the process and that it's too volatile. If you told us exactly what you wanted to do and why you were doing that, I think that would be much more perceived as a good tool of the for the market. But this volatility and kind of this almost enacting retribution at times is why the market and clients at James here continue to not like to have these tape bombs that consistently come out on these tariffs.
Yeah, he has bragged in recent days that he could do, quote, terrible things to foreign countries. I had a question for you, Ed, on some of these tariffs. Greer's on the tape today arguing that they could possibly do 15 and not 10 on certain countries. But my understanding was that 122 was non-discriminatory, meaning if you apply it to one country, you would apply them to all. Can they vary country to country?
So, Carl, you're asking a really important question. And part of the answer is we don't know because this has never been tested. So this came in the 1974 Trade Act, coming after Richard Nixon did an across-the-board 10% in 1971, and it has not been used. I think one of the other questions we've been getting quite a bit at Raymond James is that it is only intended when there's a big economic event. It is only intended for countries where we have a trade deficit. If this is challenged legally, there's a chance that this does not get held up. But the issue here is that this is only in place for 150 days. We saw in the last court case, it took about a year to get through. So even if you sue, it's probably done by the time you get an answer. And so I'm not sure that it really matters all that much between 10 versus 15. What matters is, are tariffs staying? Yes. Are there other tools, even if 122 does not kind of get upheld? Absolutely. And when we look at 301, when we look at 232, is there a maximum tariff rate there? No, but it takes time for those to be implemented. And that's why I do think a lot of these trade deals that have been struck since April 2nd of last year, Carl, absolutely stay, because you don't want the uncertainty of what happens if you try to, quote unquote, play games, as he has talked about.
Well, that's what he said in the State of the Union, that the deals are in place and that they've heard from trading partners. So, Ed, I guess one thing investors are wondering about, as we're all wondering about, is what's the upshot? Everybody's talking about the 39% approval rating that has come down for the president going into the midterms. What does it look like?
So going into the midterms, what we've always said is this is a bit of a math problem. Democrats are well positioned in the House because they would need to pick up 3 seats on a net basis. And with a negative approval rating from the president, that is a normal outcome of an election. The big debate is probably going to come down to the Senate, where it's also a math problem, Sarah. Democrats would have to pick up 4 seats. That is a really tough thing to do, even in a good environment.
I guess what I'm wondering
that path goes through Alaska. You know,
sorry
that
to
is
cut
hard.
you off, Ed, but can he turn it around before the midterms is really more my specific question.
Yeah, it's going to be difficult. Never say never. We don't know what the future holds, but that's where I do think that the base case here is a Democratic House or Republican Senate afterwards. Even if he does improve slightly, it would have to have something massively changed. After he's been in power for as long as he's had, a lot of opinions have already been formed, and Democratic enthusiasm will be there for the midterms.
Okay, Ed Mills, good to talk to you today. Morning after
Thank you.
State of the Union. Appreciate it.
After the break, the interim CEO of EV maker Lucid. It'll be his first interview since the company announced results and some plans for layoffs. Also, check out some movers today in energy. Albemarle and First Solar. They're both going in opposite directions as follows earnings from both those companies. Stay with us.
What can investors take away from the current state of the markets now that
Welcome back. EV maker Lucid reporting a wider than expected loss per share for the fourth quarter. Comes after the company in recent days announced a reduction of its salaried workforce by 12%. Joining us this morning is Phil LeBeau, along with Lucid's interim CEO, Mark Winterhoff. Morning, Phil.
Good morning, Carl. Mark, thank you for joining us this morning. It's been an interesting last 24 hours, given not only the results that you reported for the fourth quarter, but your guidance for 2026, particularly when it comes to production, which is far lower than what a lot of the people on the street were expecting. Explain why your production is not at the level that many analysts were expecting you to announce.
Well, before talking about 2026, let me explain a little bit of the backdrop of 2025, because we actually grew our production quite extensively. We doubled our production from 2024 by almost 100%. We also delivered more than a growth in deliveries of 55%. Revenues went up by 68%. And just in Q4, we doubled the production from Q3 to Q4, and were the only EV maker in the United States that actually had meaningful growth in Q4. So we're actually in a good trajectory when it comes to execution. When it comes to 2026, we're really focusing and continue to focus on execution and on our path to profitability. And it's a conservative approach that we're taking with our production guidance, which might be lower than what people expected. But at the same time, when you just look back at 2025, so many headwinds that happened, basically on a monthly basis, that came at us, and we decided to take a prudent approach. And from there, we can always go up.
Mark, you mentioned the path towards profitability. At this point, am I correct? You're not giving a target rough timeline in terms of when you expect to be profitable. But for a lot of investors, they're looking at Lucid saying, I see what they're doing in terms of production. I see what they're planning in terms of robotaxi. But I need to have a better clarity in terms of when this company will be profitable. What do you say to those investors?
Yeah. Well, I have to say, tune into our Investor Day on March 12th, because that's exactly why we're doing it, to really outline our path to profitability. And thank you for mentioning the other topic about robotaxis, because we were not only executing last year, we were also making strategic decisions. For instance, our autonomy strategy that we refined, that now allows us to participate in this now emerging market of robotaxis, where we expect quite a significant growth. We want to be a big player in that space. But also when it comes to offering advanced driving assist systems and autonomy to our consumer vehicles, also that we will be able to do very soon.
When you talk about this year, you've mentioned yesterday that by the end of this year, you plan to begin at least production of a lower-priced, mid-size model. And many people have said, can you get it down in that $50,000 range? Can you get it under $50,000? I know you're not announcing pricing right now, but should people expect a mid-size vehicle under $50,000?
Well, it will be under 50,000, but slightly. So we're not expecting, or we're not actually planning to go further down, like in the $35,000 range or so. Lucids are still a premium product. We are spending so much effort in making it, actually the best, we believe the best cars out there. They're extremely thrilled to drive. Performance is awesome. And, we don't plan to go really to the very low cost segment. We really want to provide something extra for our customers. So that's the price range where we're going to be, and it will be slightly below 50 where it starts. The mid-size platform actually is not only one product. There will be 3 top hats on that platform over time. So there will be something for everybody.
Mark, quickly, one last question for you. You've said you have at least enough liquidity to make it to through the first half of 2027. Will you need another capital injection at some point before you can hit profitability?
There will be another fundraise, yes. We basically watch when it makes sense to do so. Right now we are funded until, as you said, first half year of 2027. We exited last year with 4.6 billion in liquidity, so we're in a good spot. So nothing further to talk about this at this time.
Mark Winterhoff, the interim CEO of Lucid. Mark, thank you very much for joining us this morning. Sarah, I will send it back to you.
All right, Phil, thank you for bringing us Newsy interview with Lucid. After the break, the numbers sending Circle shares surging right now and helping the whole crypto complex, in fact, today. We're going to be right back. Stablecoin and payments player Circle seeing big gains this morning after results there. Mackenzie Segala is here to break down the numbers. Quite a move, Mac, for Circle, up 20% in the entire space.
Yes, it is, Sarah. That surge coming after the stablecoin company blew past expectations on its Q4 print. Massive beat on the top and bottom lines. 43 cents a share versus the street estimate of 16 cents. Profits up almost 3,000% in a year. And then you've got revenue surging 77% from last quarter. And what this really shows is that digital asset investors fled altcoins for stablecoins during the 2025 meltdown. Circle's flagship USDC ended the year with $75 billion in circulation and now commands nearly a third of the stablecoin market. Now, Tether is still the largest player by market cap, but Circle is steadily closing the gap. This print is a total departure from the narrative that is gripping crypto markets right now. Circle actually benefits when tokens sell off. Traders dump volatile tokens and then park it in stablecoins like USDC as a safe harbor, and that drives Circle's balances higher. The company makes most of its money earning yield on the treasuries and cash equivalents backing USDC, so larger balances mean more revenue. Circle is also pushing hard into enterprise payments. Visa now lets its U.S. issuers and acquirers settle using USDC, and Intuit signed a multi-year deal to integrate Circle's infrastructure across its platform. Now, putting this into perspective, Circle stock, it's still down around 70% from its post-IPO peak last summer, but management says they expect USDC circulation to grow 40% a year on average, even through the downturns. And it just got conditional approval to establish a national trust bank. That would be a major milestone for a crypto-native company. David?
Mackenzie, thank you. Mackenzie Segalas, yeah, that move very significant in Circle. Did want to focus on another story impacting a number of stocks today, back in the media space. No, it's not Warner Brothers Discovery. It's football. Football. A note today, there's been a lot of press reports of late that the NFL is going to look to renegotiate many of its deals, even though many of them don't expire for quite some time, because it knows it can get a lot more for its product. We discussed here so many times the fact that in a typical year, the top-rated broadcasts for CBS or NBC or ABC and on from there are typically an NFL game. And many of the people who follow this industry closely believe the NFL could get as much as a 50% increase off its current deal. Well, that would be expensive. Very expensive. And in a note out this morning, for example, B of A media entertainment analyst Jessica Reif Ehrlich goes into some detail in terms of what it could mean for the likes of Fox, which she actually downgrades to an underperform, in part because of the expected additional cost for companies such as Fox, for our old parent company Comcast, which owns NBC, for Walt Disney conceivably as well, which owns ESPN, and Paramount is up, actually, in part because of the other thing I've been discussing, but they own CBS. Carl, as you know, this is the key programming asset, and now you've got competition from Netflix, from Amazon, from YouTube, maybe others, but those are enough right there with their deep pockets.
Yeah, Fox had already started to come down. I mean, the share price prior to this, it's actually a double downgrade from Jessica. And she points out you can either pay up and try to match big tech or lose the asset and then risk the audience loss.
And the audience loss is almost incalculable for some of these companies. I mean, it's the key programming that many of them offer. You know, remember that day a few weeks ago when a lot of the big names were down because of disintermediation by AI, but Fox was also down, which is only news and sports, so conceivably wouldn't be disintermediated by people creating their videos. And in part, many people after that said, you know what, it's this NFL renegotiation. It's going to start to pressure all of these names.
When is that happening?
Well, it may be happening very soon, even though the contracts in place don't expire for quite some time. The NFL says, we got to renegotiate.
Good time to be the NFL.
It sure is.
It always is.
Yeah.
Meantime, when we come back, Kava is surging on some results. We'll talk to Brett Schulman when he joins us on Money Movers as the S&P losing some of the opening bid, but still holding 69.20. Wednesday morning. Welcome to Money Movers. I'm Carl Quintanilla with Sarah Eisen here at Post 9 of the New York Stock Exchange. Today we're watching the tech trade. The sector has struggled a bit this year, pressured by all this AI disruption. NVIDIA is a big test tonight as that looms large after the bell.
Plus, shares of Kava surging after reporting fourth quarter sales gains boosted by menu prices. We'll discuss the company's latest guidance with CEO Brett Schulman.
And the Pentagon's AI clash with Anthropic, demanding the company to give the military access to Claude or else face some harsh consequences. We're going to break down what's at stake with the DoD's former director of AI strategy. As for the overall markets, NASDAQ pretty optimistic, at least going into the Salesforce and NVIDIA print tonight. Little weakness in energy, down a full percent. Industrials as well. Home builders actually having a rough day, worst since last April, and that's with the 30-year fix down to 609.
But financials are catching a bid for the first time in a few days. That has helped an overall market with tech on top. We'll start with the latest for the software trade. Workday issuing light guidance, sending those shares lower. And now Salesforce and Snowflake are getting ready to report this afternoon. Seema Modi has more on what we can expect, Seema, and just whether these stocks right now are connected with the fundamentals that we're getting.
Yeah, and that's going to be key, especially when looking at Workday, Sarah. The stock is off the lows of the day. That fourth quarter beat, positive comments from CEO Anil Bousri, really being overshadowed by its light guide for 2027. Bank of America saying even with software stocks down sharply this year, there is zero tolerance for missing even by a hair. And that could be a challenge for Salesforce and Snowflake tonight. Salesforce really needs to prove three things. First, to Agentforce, its AI agent business. Are there new Fortune 500 customer wins? And is that leading to a meaningful bump in annual recurring revenue? Second is CEO Mark Benioff looking to transition from a seat-based model as agents are increasingly measured on outcomes rather than user licenses. And then flexibility on pricing amid intensifying competition from Anthropic and OpenAI. Guys, Deutsche Bank conducted some channel checks and spoke to several partners of Salesforce and came away with what they call a mixed picture on demand, noting softness in the month of January. We're looking at the stock down about 40% from its recent high. Also, M&A, that's expected to be a key topic of discussion with analysts. Then for AI beneficiary Snowflake, it's not seen as a victim of artificial intelligence. Like Datadog, it helps the large language models players aggregate complex sets of data. It counts OpenAI as a customer, and yet its stock has been caught up in the recent software sell-off. The channel checks by Morgan Stanley for Snowflake suggest strong demand, but they also add that the magnitude of the beat on product revenue guidance, that will be key. If it misses, they say you could see some volatility in the stock.
Seema, we keep going back to this line from Workday last night in which they say no amount of vibe coding is going to produce an HR or ERP system.
Right.
Industry is definitely trying to defend itself.
Absolutely. Those comments from Boustry being talked about a lot, just given that all his experience that he has from Silicon Valley. He's a very respected name, coming back in the CEO seat and saying, look, I'm looking at the environment, and I do not think vibe coding can be competitive to our business. And I think over time, the jury is out. He also talked about the agentic opportunities that they're adding to automate the workflow, but said this is going to be a second half of the year story, and the market sort of needs to have that patience to see that integration happen. And in the meantime, you're seeing the likes of OpenAI and Anthropic continuing to come out with these new models that is going to create a really interesting next couple of months, guys.
Yeah, you can see some of the volatility already in the trade today. Seema, thanks. Seema Modi on software. For more on the market, let's bring in Wells Fargo Chief Equity Strategist Oh-Sung Kwon joins us here at Post 9. It's great to see you. Welcome.
Thanks for having me.
What do you think? We keep having this discussion about whether or not we get back to sort of a narrower tech trade or whether this broadening dispersion continues. What happens after tonight?
Yeah, no, I think there is some upside in the NASDAQ, given that the NASDAQ has lagged so far this year, and especially in areas where people hate it the most, which is software too. So I expect at least a little bit of relief rally there, but I do think the market is going to continue to broaden out. We love the Russell 2000 trade here. I keep saying this, but there are two things that you need for the Russell 2 to rally. You need a good PMI and you need speculation. And I think both are, we're going to get both this year.
And lower rates doesn't hurt.
Right, exactly, yeah. And I think speculation is going to come back. I think we're starting to see a little bit of that happening today as well. So today basically marked the first day of big tax returns really getting distributed to the economy. And between now and by the end of this end of March, we're going to get about 2/3 of tax returns getting distributed out. So between that and the Fed's $40 billion a month purchase, we expect about $150 billion of liquidity injection back to the economy. And that's about 50 basis points of GDP, and that's pretty significant over the next 5 weeks.
Some argue that's going to pay for electric bills and grocery bills, but others argue it will feed equity flows, right?
Yeah.
Historically, it has.
Exactly, and for the high-income consumer, they're going to see, some high-income consumer are going to see about $10,000 more versus the year before in tax return. So that's going to be very significant, and I think consumers going to YOLO it. They're going to speculate with it. About 20 to 25% of retail trades are in options these days. So they are really the speculators. And I think with extra money in their pockets, I think retailers are going to speculate.
That's why I was going to ask what you meant by you need the speculation to work for the Russell 2000 to work. So what do you mean sort of extra free money that'll go find its way into the market?
Yeah, exactly. And if you look at the composition of the Russell 2000, it's no longer a good old cyclical index. I mean, there's still a lot of that, especially regional banks and some of the smaller industrial companies. But there's a lot of power companies in there. They're smaller. There are a lot of nuclear, Bitcoin miners, things like that are more speculative. So you need both things. You need good economy and speculation, and I think we're going to get both.
Right, a lot of non-earners in there too. Does that mean you buy the index, or you buy the components that you like in the index?
I like the index. I like the index overall. I don't think positioning large caps, so I still think there's more upside there.
But is there a sort of big company versus small company edge when it comes to implementing AI that's going to show up in better profitability and margins, and maybe lag for the smaller ones?
Yeah, great question. And I think that's the real bull case, medium to longer term for smaller companies. What's really interesting is that since ChatGPT came out, we actually saw huge productivity gains for the S&P 500. But for the Russell 2000, we actually saw productivity fall. And we even adjusted it for sectors, but it wasn't really sector composition, it was really size. And if you look at the percentage of companies that talked about AI during earnings calls, far greater percentage of companies in the S&P talked about AI than the Russell.
That makes sense.
So I think their smaller companies are just late to the AI adoption game. And when they start adopting AI, and I think that's going to happen, the multiplier effect of lower labor costs is a lot bigger for the Russell 2. It's 2 times for the S&P. It's 6x for the Russell 2.
Right. Now that makes sense. Are you a buyer of the notion that the job market is vulnerable then?
So if I have to guess for this year, I think the job market is probably going to be more neutral because we have that secular headwind from AI, but at the same time, job market is really cyclical, right? If we really start to see that cyclical rebound in the overall economy because of the fiscal tailwinds from the tax returns, then I think earnings are going to broaden out. The layoff cycle has been really the earnings cycle historically, except this time. Then there were really 2 things that happened this time, which was one, because of AI is a headwind to the job market, but also B, a lot of the earnings growth has been coming from AI companies. And if earnings really start to broaden out, then I think the job market is going to be fine.
I mean, the corollary would be in the back half of the year, if you're right that adoption starts to pick up, that the budget plans for 27 will start to get made, and you'll start to see incrementally higher layoffs, or at least lower hiring for the following year. Would that make sense?
Yeah, I think it's still going to be no hiring, no firing type of environment in the job market. But for this year, I'm more optimistic than others.
So what could go wrong? What are some of the big risks to your forecast that you worry about?
Yeah, I think from the macro perspective, it's really the second half inflation reacceleration. I don't think that itself is going to be bearish if the Fed is okay with it, and if the administration and the Fed just decide to run it hot and sort of like inflate out of this fiscal deficit issues. And that's really the debasement trade that's happening, and that's why gold is ripping. And I think the perfect example of debasement trade is Japan. I mean, the trade is FX collapsing, rates ripping, and stocks actually going higher. I think something like that could potentially happen here.
Although the president has made such a case for lower rates, you think you'd be okay with that?
I think the long end is probably going to be locked in at around these levels because of fiscal issues and potential inflation. But I don't think that itself is bearish for equities.
Right. What is your target on gold? You have
I
one?
don't have a target,
No target on gold?
I'm still bullish on gold, though.
Right. Finally, a year ago, the acronym was FANG, or maybe it was a year and a half ago. Now it's this Halo thing: heavy asset, low obsolescence. It kind of melds with your Russell thesis, doesn't it?
Yeah, and we also looked at the most asset-heavy companies in the S&P versus the most asset-light companies in the S&P. And the asset-light companies obviously have done really well over the past decade, given the move to and the rise to the digital economy. Going forward, I mean, if AI is really that good, we need more data centers. We need more compute power. And I think it's going to be more constrained by physical constraints rather than the digital constraints. And if that's the case, we just got to build more stuff, and which is bullish for the old economy and
then you start getting into municipal pushback and more social areas of friction. Oh, son, great to have you. Thanks so much. Good to see you.
Optimistic guy.
Yeah.
7,800 target. Up next, CEO of Cava, first reaction to earnings, why he says the restaurant chain has been able to bridge the K-shaped economy. That's next.
Plus, Goldman breaking down how you might want to play NVIDIA going into results tonight. Some of the key items on that call that may well move the stock when we return.
Welcome back to Money Movers. Take a look at shares of Cava getting a nice boost today after the company reported a top and bottom line beat for the fourth quarter, also posting record revenue for the full year. The company telling CNBC that it saw firming among cohorts facing more economic pressure, like younger and lower income consumers. Joining us now first on CNBC is Cava CEO Brett Schulman. Brett, welcome back. It's good to see you.
It's great to be back with you.
So talk to us about the trends that you're seeing from consumers, because it felt like a bit of a pickup here in the last quarter and this current one.
Yeah, we noted coming out of Q3 that we saw underlying strength in the brand, even as the 1-year same restaurant sales had decelerated. Our 2-year same restaurant sales had sequentially increased each quarter, and our new restaurants were opening at record levels. And we saw that firm up and strengthen as we ended the year, and then certainly as we began the year in 2026. And we think that's a reflection of a couple things. One, it's the differentiated nature of our unique Mediterranean cuisine. It's meeting the needs of the modern consumer. And then it's a reflection of our long-term strategy to really deliver great value every day. In an environment that was, reflective of very intense discounting last year, we've tried to focus on everyday value. And in recent years, we've underpriced inflation by over 10%, and we've taken less than half the price increases of the average restaurant company. So we think consumers have really recognized that and understood the value and the bang for the buck that they're getting when they have a meal like that.
I know we've talked to you about that before, which is that you're able to hold menu prices significantly below inflation. And I think you expect to sustain, right? 1.4% menu pricing in 2026. Just explain how you're able to do that.
Yeah, we recognize some of the inflationary pressures our guests are feeling around them, and it's our job to continue to work on their behalf to mitigate any price pressures we're seeing on our end and not have to pass them through. And that's by being more efficient on our operations, it's delivering great value, and it's driving traffic and driving that sales growth. We're able to get operating leverage and then share that leverage by not having to take price with our guests, mitigate that menu pricing.
Brett, we've seen some historically bad comps from some burger chains. We won't say who at the moment, but I wonder, you think you're gaining share from areas that have been traditional fast food?
Yeah, well, traditional fast food, as I mentioned, took over half the price we've taken in recent years. And I think that those aggressive price increases led to a lot of discounting to get back to a more affordable level. We've seen the ability to take share from whether it's casual dining, whether it's limited service fast food, or traditional fast casual peers. I think you're seeing kind of a blurring of the lines of a lot of the segments in the restaurant industry. And it's really about why somebody's walking by 3 restaurants or coming to you, is that you're delivering a differentiated, better experience, better value proposition. And we look at value as not just the lowest price, but a holistic combination of factors, including the quality of the ingredients we're serving, the relevance of that Mediterranean cuisine, the convenience in which they can access it, and then the experience they have when they engage with our brand, whether through our digital channels or certainly the hospitality they get in our physical spaces.
Right. Remind me about beef exposure and whether or not you're calling for some relief in beef inflation.
Yeah, that's one of the things that's advantageous about our menu and our basket of goods is that we don't have one outsized component. It's pretty balanced across all proteins, across produce, across dry goods. So we don't see an outsized pressure from beef, but beef is at elevated levels. We don't see it getting much more elevated from here, but staying kind of where it is at current levels.
A big part of the story, and for the stock certainly, and the bull case has been on your expansion, just how much white space there is and brand recognition and how many stores you can open. What does that look like now?
Yeah, so our guidance for this year is another 74 to 76 restaurants. We were able to actually grow compound annual unit growth over 19% last year. And what gets us so excited about the white space opportunity is the consistency of our performance that we've seen, not just in the last year and those record new openings, but in our 15-year history. We just celebrated our 15-year anniversary, and that performance is consistent in all regions of the country. It's consistent in the cities, the suburbs, and the exurbs, whether it's smaller markets like Augusta, Georgia, where we opened recently, or Fayetteville, Arkansas, or in Manhattan, where we've opened new units in Columbus Circle or the Upper East Side. So that consistency of performance allows us to go into so many different markets across the country. We're excited to bring Cava to those communities.
And how's the productivity as you open these new restaurants? We talk all the time about what AI is going to mean for various businesses and how, automation obviously has been a story for restaurants for years. But what does that look like for you guys?
Yeah, we see a great opportunity in leveraging modern data technologies and generative AI to improve in a step function way the productivity of our restaurants. Very similar to what we saw the last decade with digital innovation in our digital channels. We think data can really help, whether it's for predictive prep production, predictive cook production, inventory management, labor management, that it can really allow us to be much more effective, efficient operators. And again, not have to pass those costs along to those savings and mitigate menu price increases, or invest in our team members and help invest further in those wages. And I think another interesting aspect of AI for the restaurant industry is, as AI may impact some entry-level opportunities for folks, the restaurant industry is one of the few industries where anybody from any background can come and make a career for themselves. And we always talk about that if you come into Cobb as a team member, within 24 to 36 months, if you have the will and the skill and develop the skill, that you can come in and run a multi-million-dollar business, make 6 figures plus in income, and build a career for yourself. So we see that as an opportunity for more folks to come into our industry and be business leaders. We launched our Flavor Your Future platform in that spirit, really to help create pathways and careers for folks to run these restaurants across the country.
Brett, one of the upside surprises in the print was a new store guide, new unit guide, and I wonder, there's been some push by some competitors in, say, the coffee space to develop new stores at a more efficient price, to try to take off some of the bells and whistles and get a new store going for less money. Is that a similar push for you?
Well, we just launched our new Project Soul Design, which is an enhanced, warmer environment, because we think the demise of the dining room is greatly exaggerated. And we want you to have a great physical experience or a great digital experience, depending on what you want to do. And our development team has done a phenomenal job in adding and enhancing our interior without increasing the cost. So we're focused on delivering a great environment, a great aesthetic, and then we'll manage the cost structure to make sure we're delivering great returns for our shareholders.
I mean, we talked about your pricing advantage, about how Mediterranean food is hot, but just what do you think is going on with the broader industry right now, and why we're seeing such weakness when it comes to traffic and same-store sales? I mean, even for you, I know you got about 5% on same-store sales, but that was an improvement for where it's been. What is it? Is it the affordability concerns that consumers have? What's going on out there?
Yes, Sarah. When you look back to prior to the pandemic, while the restaurant industry has grown sales from a nominal sales standpoint, a dollar standpoint, transactions are actually down. And so it's become a share shift game in a sense in the industry. And I think a lot of that is a result of what I spoke to earlier, that there has been significant price increases in the industry. And, we as an industry have to continue to work to be more affordable for our guests, as they're facing price pressures, not just within our industry, but all around them. So how do we deliver a better competitive alternative to where they can get food at the grocery store or other channels? And that's what we've tried to do at Cobb.
Brett, good to talk to you. Thank you for joining us on earnings.
Thanks for having me.
Even on Zoom. I know you had a flight cancellation. We'll get you here next time. Brett Schulman, CEO of Cava.
Up next, CNBC unveiling the 3rd annual Changemakers list. Some of the most influential voices shaping consumer trends. We'll reveal it next.
Plus, the Pentagon threatening to invoke national security powers to access Anthropic's AI technology. The DoD's former director of AI strategy will help us break down this story next. Today, we are unveiling our third annual CNBC Changemakers list, and a number of these women are changing and leading consumer trends. Julia Boorstin joins us from Los Angeles. I love this list, Julia.
Thank you so much, Sarah. And many of our 50 new CNBC Changemakers are transforming consumer products and services. They are running brands serving consumers spanning categories from energy to retail to food and beverage. Now, changing the face of consumers, Rare Beauty founder Selena Gomez scaled Rare Beauty to a $2.7 billion valuation and expanded her philanthropic work through her Rare Impact Fund. While Sephora North America CEO Artemis Patrick led a bold transformation of its stores. And Kim Kardashian's Skims reached a $5 billion valuation, in part on the success of its partnership with Nike and the expansion of its physical stores. And on the other end of the consumer spectrum, how people pay for power. Sunrun CEO Mary Powell is converting consumers to solar power and battery storage.
Our obsession is providing that kind of control energy, and they view solar as green energy. Some Americans, that's not it at all. They just want a greater sense of independence and control.
You can find out more about all of these women and the other incredible changemakers on our list at cnbc.com/changemakers. Sarah?
I thought you were going to talk about Susie Wolf. I was so excited to see this is the leader of F1 Academy, which is
F1 Academy.
It's incredible. Yes. I mean, you pick from a variety of places, Julia.
Yes, a variety of places. Susie Wolf, who runs F1 Academy, is one of the women in sports on the list. We also have the head of the U.S. ski and snowboard team. And what's really interesting is that these women in sports on the list are not just succeeding, but they're really broadening the audience for sports, particularly for women's sports. So, Sarah, it's a fascinating time for the women's sports business. And we also have a big event coming up. It's April 16th in New York. It's our Changemaker Summit. Sarah, I hope you'll join us there.
Awesome. I always love it. And Julia, thank you. I love it also, Carl, because you talk to different CEOs and corporate, they're always looking for more diversity, I think, in corporate boards, just to have a diversity of viewpoints. And, there aren't that many women CEOs, but you want women, people should want women on boards as well. So it's a good list of people that you wouldn't necessarily expect because they're not just CEOs. There's CFOs on this
Believe
list.
me, we're all for all
officers.
kinds of diversity on boards.
So it's not. Here's a list for you, future board members, if you're looking for strong, accomplished women.
And of course, nobody has written more about female leadership than Julia. Thanks, Julia. That's our Julia Boorstin. Let's get a news update this morning with Courtney Reagan. Hey, Court.
Hi, Carl. Some Democratic lawmakers in the House set to introduce legislation today in an effort to ban taxpayer money being awarded to pardoned January 6th rioters. The legislation comes after at least one financial settlement. North Carolina Democrat Deborah Ross, who's sponsoring the bill, says President Trump's blanket clemency already absolves the rioters from having to pay millions in damages caused at the Capitol. With concerns mounting about potential insider trading in predictions markets, Kalshi today announced that it has recently resolved two separate instances of insider trading and froze the accounts before any profits were taken. The prediction market says it has opened a total of 200 investigations and frozen a number of flagged accounts. CNBC has a partnership with Kalshi. And another delay for the Artemis II crewed mission around the moon. NASA is rolling the massive space launch system back to the hangar for repairs today. The rollback means no launch in March as previously scheduled. NASA says it could happen in April, but will depend on the repair schedule. Sarah, back over to you.
Okay, Courtney, thank you. When we come back, Goldman's NVIDIA playbook. Key things on the earnings call, they say couldn't move the stock tonight.
Plus, we'll get to this cloudy outlook in solar. First Solar under some significant pressure right now. We're back in 2.
Welcome back. NVIDIA earnings on deck after the bell today. That's as the AI trade remains in the spotlight, and we continue to see this broader software sell-off. Joining us now is Goldman Sachs senior analyst Jim Schneider. Jim, welcome. It's good to have you. What should we be paying close attention to tonight?
So first of all, I think NVIDIA earnings and guidance will be very strong. We're expecting relative to the street 4% upside on earnings for this quarter, 8% upside for next quarter, and 16% upside for the calendar year 2026. So quite a strong path. And I think one thing that's a little bit different in terms of the setup this quarter than in past quarters is I think the catalyst path over the next few months for the stock to outperform is a little bit cleaner than it has been for a while.
Why is that? Because it feels like expectations are high, and yet the stock hasn't done that much this year. It's up a little bit.
Yeah, I think investors are really looking for clarity on a few things. So I think there's a few ingredients for the stock to work or outperform from here. The first of which is upside from the hyperscaler CapEx numbers. Now, we saw a little bit of that from the forecast this earnings season for 2026. I think we're going to see more signs of increased CapEx going into 2027, which I think is something investors are really focused on. The second part of it is really spending from the non-traditional customers. That is the OpenAIs and Anthropics of the world, and how sustainable their spending is. And I think the third part is, I think NVIDIA is really set to sort of reassert its competitive dominance in the chip space among some of its vendors and I think competitors. And I think the key is the release of some of these new models that are trained, whether it be OpenAI or others, that will be coming out in the next few months, that have been trained on NVIDIA's latest generation chip, which is Blackwell, whereas all the ones that are in market today have been trained on the previous generation.
Right, and you do have a neutral on AMD, right?
That's correct.
Not a buyer that they're encroaching in any markets in a big way on NVIDIA's turf?
Yeah, I think there's some promising signs. Some of the deals that they've done recently, I think, are quite promising. There's a little bit more we want to see in terms of the sustainability of those, but I think they're improving their competitive position for sure.
Short term and tactically, we're looking at the chart here. This recent period where it got challenged around 193. Why did that start, and what allows it to bust through, if at all?
Well, as I said, I think people sort of understand what the profile of earnings for this year is because CEO Jensen Huang has given us visibility into $500 billion plus of that data center forecast. He alluded to that at the end of last year. And I think now people are looking and really focused on 2027. What's the upside from 2026 into next year?
And you think he opens the kimono a bit on that, on 27?
I think we start to get some elements of that, and that can continue at the GTC event, which is in mid-March.
Because that's always the overarching question, right? Is we know demand is super strong right now, but for how many years can this last? What is 27? What does 28 look like? Does it fall off sharply just because these numbers have gotten so big?
It's a very fair question. I think that one thing we've seen is continued high revisions in terms of the CapEx estimates from the hyperscalers, more than I think anybody would have ever guessed a couple of years back. I think the other thing is, can the chip providers, NVIDIA, Broadcom, and others, really keep providing the same level of cost reductions and performance increases? So right now, those leading chip providers have been delivering 60 to 70% cost reduction per year. That's a very, very fast rate of cost down. And so I think that if you want to swim in that kind of that fast river of cost reduction, if you will, I think that you need a few elements. It's not just enough to have a processor or a GPU. You need to have increasingly other things or other elements to the story. One is networking to connect all the chips together in a data center, and the other one is increasingly things like storage to really kind of feed that AI inference.
We were kicking around this morning the idea that they might say something about chip efficiency and whether or not some of the memory names might be vulnerable in the weeks to come. You do have a neutral on Micron and Western Dig, right?
That's true. We also have buy ratings on SanDisk and Seagate. So I think that memory complex is certainly poised to go higher from here. I think that the thing that I'm very focused on is the supply dynamics in that market. We're starting to see some elements of supply additions by some of the competitors come on. I think that's a question mark. But we're seeing no supply additions in NAND flash, which kind of keeps me structurally positive on that space.
Okay, Jim, appreciate you joining us. Head of the NVIDIA report. Good to hear from you. Jim Schneider from Goldman Sachs.
When we come back, why First Solar shares are losing nearly a fifth of their value this morning. We'll look at the guidance and some of the comments about tariffs in just a minute. Welcome back. Weak guidance has shares of First Solar under some pressure this morning, although off of the lows of the session. Pippa Stevens has more on the quarter. Morning, Pippa.
Hey, Carl. So the panel manufacturer is facing a lot of unknowns, opting not to give EPS guide, while full-year revenue guidance of 4.9 to 5.2 billion came up well short of the street's expectation of 6.1 billion, and that is what is sending the stock tumbling down 13.5%. The company is the largest U.S. panel maker and has a strong backlog, but CEO Mark Widmar struck a cautious tone on the call, pointing to uncertainty around Section 232 actions, FIOC restrictions, and AD/CVD cases, all of which are on top of the administration's potential 15% tariffs. The company expects those tariffs to have as much as a $135 million impact. Production in Southeast Asia also softer amid decreased demand for those panels thanks to the tariffs. The company curtailing some of that production as it looks to increase its domestic footprint with its 6th U.S. facility under construction in South Carolina. HSBC and Baird downgrading the stock to neutral, but Goldman reiterating its buy rating, saying to buy the dip, pointing to better bookings moving through the year and an inflection in both volumes and margins into 2027 and beyond. The stock now pacing guys for its worst day since June.
Pippa, to the degree they're able to beat some of this guidance down the road, is that mostly a residential or a commercial story?
So this is a commercial story. First Solar is the largest manufacturer in the U.S. of utility-scale panels. And that is one of the issues that they're facing, is that all of this policy uncertainty and unknowns means that their customers are kind of moving out the timeline and putting a pause on some projects, because particularly if they're looking at things like the tax equity market, if they don't have clarity into what the policy is going to be and the extent to which they might have a claw back in some of those credits, they're not going to receive financing from the biggest banks. And while it's an issue with panels, it's especially an issue for battery. And of course, energy storage right now is paramount given the stresses on the grid. And all of those cells essentially are still made in China. And so when we see solar plus storage, if you don't have that storage element locked in place, the project might be put on hold. And that's really what this industry is saying. They're saying, if you want to put in tariffs, okay, but we need clarity and certainty going forward.
On power, Pippa, I wanted to ask you about this because it came up in the President's State of the Union last night, the address about concerns over energy demand from data centers driving up electricity costs. The president said, we're telling the tech companies they have the obligation to provide for their own power needs. They can build their own power plants as part of their factories so that no one's prices go up. Can that work?
Well, so we've seen a bigger push from the tech industry. At first, they seemed reluctant to kind of pay their own way. But given that the power element is such a small portion of the overall data center cost, we're now seeing a movement towards BYOP, or bring your own generation, from big tech. We've seen announcements from the likes of Microsoft and Anthropic. And so last night specifically, it's a little bit unclear if that announcement goes above and beyond what we've already seen from some of these tech companies. Last night, it was just a pledge. There was no info on exactly what that looks like and which tech companies might be involved. But affordability is clearly a very big issue for consumers ahead of the midterms. And AI is certainly one driver of electricity. It's not the only one, also reshoring manufacturing, but certainly the data center, influence on power prices is getting all the attention right now.
No, and they seem to get it. Those utility bills going up and trying to address it. I guess the question is how. Pippa, thank you. Pippa Stevens. Up next, the Pentagon threatening Anthropic over access to its AI tools. But who has the upper hand in these negotiations? Anthropic now moving away from its core safety pledge. We'll talk about all of this when we come right back. Welcome back. Tensions escalating between the Pentagon and Anthropic. Defense Secretary Pete Hegseth now reportedly giving the company until Friday to remove safety guardrails on its AI model or face potential contract termination, even invocation of the Defense Production Act. Deirdre Bosa has more on this in today's Tech Check segment. So, Deirdre, what is the story?
So there's a story, but there's also a fascinating contradiction playing out around Anthropic right now, and it tells you a lot about where safety actually stands in AI. On the surface of this Pentagon fight, Anthropic looks like the principled company standing up to the most powerful institution on Earth over autonomous weapons and mass surveillance. Now, those are legitimate concerns, but simultaneously, Anthropic has scrapped the core safety pledge the company was founded on. It is replacing hard safety commitments with what it calls non-binding, publicly declared targets, because otherwise, it says, competitors could race ahead. This was laid out in a blog post. Now, in other words, CEO Dario Amodei is making the same argument they left OpenAI over. We can't slow down because our competitors won't. This is what was supposed to make them different. Anthropic's safety rhetoric is starting to look like branding and leverage, maybe a little less like principle. Now, fighting with the Pentagon, it may actually be a masterstroke in PR for the company as well. A defense official told Axios that they need Anthropic, and the problem for these guys is they are that good. Every enterprise CEO or CTO reading that takes away two things. The U.S. military thinks that Claude is the best model in the world, and Anthropic cares so much about safety, it'll walk away from a $200 million contract. We'll see what happens this Friday, guys, but the bigger story is what has already happened. The company, the one company that was supposed to be different, serious about safety, just told us that it can no longer afford to be. And if that is true, the AI race just got faster. And for every company in the path of this technology, the disruption will only accelerate from here.
And just to remind viewers, Dee, when we're talking about safety or Anthropic's qualms, was it about surveillance of Americans or the ability to deploy a weapon without a human, something else?
All of that. They've been very clear on sort of what they want their technology to be used for and not used for. And to be clear, these are two different issues, right? It doesn't want its Claude chatbot or now Claude code to be used in weapons of mass destruction or for surveillance. That's one side of it. But on the other side of it is they have made safety their whole brand, and they're moving a little bit away from that on sort of those core principles. They're saying that they need to change it to reflect what's actually happening in the race. And it's interesting, right, because the Pentagon right now is only using Claude from Anthropic, which kind of tells you that maybe it's the most capable model, at least for what the Pentagon wants to use it for. If they focus too much on safety, I think the worry maybe is that OpenAI or Grok or others will be able to catch up and replace them, and they would probably argue they wouldn't have the same kind of eye on safety. So use the lesser evil.
It's a good setup, Dee. Thank you, Deirdre Bosa. For more on this topic, let's bring in Gregory Allen, Senior Advisor of the Wadhwani AI Center at the Center for Strategic and International Studies, former Director of Strategy and Policy at the Defense Department's Joint AI Center. It's great to have you back, Gregory. Thanks for joining us.
Great to be with you.
Did you expect anything different? I mean, did you expect the company to adhere more forcibly, supposedly, to their principles?
Well, I think you have to separate the safety concerns at issue. The dispute with the Department of Defense is really about what their tools are going to be used for in the national security context. And they're specifically looking for stipulations in the renewal of their contract that their tools will not be used in domestic mass surveillance or in fielding lethal autonomous weapons without human oversight. They're even willing to help the Pentagon develop such weapons. They just want to stipulate that they not be in the absence of human oversight. By contrast, I think that's by the terms of these contract negotiations, it's actually far less than what the Pentagon agreed to in the initial contract with Anthropic in July 2025. That original stipulation included things like not using Anthropic models for offensive cyber weapons. Anthropic has abandoned all of those provisions and retreated to this set of relatively modest two requests on domestic mass surveillance, which is really not something the Department of Defense should be engaging in regardless. That really really falls to other parts of the U.S. federal government in those types of concerns. And then also this deploying lethal autonomous weapons. Now, I think Anthropic's requests are reasonable, but I'm sympathetic to the Department of Defense's view that they don't want to have those kind of debates in contract negotiations with the companies providing them technology. Those are the kinds of debates they want to be having inside the Department of Defense, with Congress, with the White House, and in the broader public sphere, not part of a contract negotiations. I'm sympathetic to the Department of Defense in that regard, but I think the threats that the Department of Defense is making, such as threatening to label Anthropic a supply chain risk type of company, those are the kinds of labels that we use for companies that have secret Chinese or Russian ownership or are known to have active spies working at those firms. It is a radical escalation to take the company that has really been out front in trying to support the Department of Defense and throw such big threats at them for this. It's an unreasonable escalation on the Department of Defense's part.
Yeah, the Defense Protection Act's a pretty powerful tool here. To Deirdre's point a moment ago, does all of this suggest to you that Anthropic is, in fact, in the pole position?
So I think there's a couple really interesting data points that we've actually gotten from this dispute. If you think about the LLM chatbot models like ChatGPT or Claude as it might be used by an everyday consumer, I think what we've seen is that the switching costs from those kinds of models has been relatively low. I might use ChatGPT one day, I might use Google Gemini another day. But what this dispute with the Department of Defense shows is that once you actually integrate these models deeply into your tech stack, whether that's for cybersecurity applications or intelligence analysis applications, there actually are very high switching costs. The Department of Defense does not want to have to go through the exercise of ripping out Anthropic's technology and trying to build up a competitor in that regard. And high switching costs, if that does indeed remain the case, that suggests high margins and a first mover advantage in this industry. It says a lot about what the AI economy might look like in the next few years.
You know, Greg, to me, this is a broader sort of societal question that we have to deal with, which is who should be imposing the moral, ethical, and safety standards of AI companies? Should they be doing it themselves? Should it come from government? Should it come from Congress? I mean, why is Anthropic in a better position than the Department of Defense to decide this sort of thing?
Well, I think Anthropic's commitment to safety is very real, and you can see that just in the investments the company has made internally, as well as the research publications that come out. For example, I recently chatted with the lead author of the International AI Safety Report, which is a flagship sort of scientific consensus community. And if you look at the citations in that report, Anthropic publicly disclosed research is all over that report. They are clearly investing hundreds of millions of dollars to advance the state of AI safety science and freely sharing almost all of that with their competitors. I think the commitment to AI safety at Anthropic is extremely real. And in fact, when employees accept a job offer at Anthropic, if they accepted it because they wanted to work at a safety-focused organization, they encourage that employee to call the other companies and tell them, I went to Anthropic because I think they care more about safety, because Anthropic is trying to spark a race to the top amongst AI companies to care more about safety. I think that commitment is very genuine. I've known Dario, the CEO of Anthropic, for almost 10 years. I knew him when he was not rich and not a CEO, and he was obsessed with AI safety then.
Yes. Gregory, we got to get you back to kick around the Citrini blog later, which everyone on the street has opinions on. It's good to have you. Thanks so much.
Thank you.
Well, we'll learn more about the AI trade and what demand looks like tonight. We've got NVIDIA reporting, obviously, and whether it is a true bellwether anymore. We were discussing this yesterday. Questions over that because the other part of the AI trade, the disruption trade, has become so prevalent. Software, obviously, is the big one there. We'll get Salesforce earnings on that later today.
Yeah, and then later in the week, we're not quite done. We'll get Dell, and CoreWeave will be another good tell on where we are in this whole race.
I mean, so far what we've heard from all of these players on the servers and on the chips is that demand is off the charts.
Yeah. Let's get to the judge in Post 9.
All right, Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the state of the tech union. With NVIDIA, Salesforce, Snowflake, all reporting earnings tonight. We discuss and debate what is on the line for these markets with the investment committee. Joining me for the hour, Joe Terranova, Shannon Saccocia, Jim Leventhal, Rich Saperstein. Let's go to the markets, give you a look at the picture. 12 noon, NASDAQ is leading as we look ahead to these big events. It is, I think, fair to say, Joe, the biggest day for the tech trade in some time, not just because of NVIDIA, but given what's happened with software, with Salesforce and Snowflake also reporting. The NASDAQ's the only major average to be down year to date. Most of the mega caps are as well. Take it from there.
Well, I think the market was able to shrug off the earnings report from Workday. So I think really the bellwether, and I'm going to call NVIDIA the bellwether because I am 100% confident that exactly is what it means to the marketplace. That bellwether is critical, and it's critical because the mercurial nature of 2026, we see it represented today. The leading 4 sectors for the S&P all up greater than 13%. They're all down today. The worst performing sector, financials, that's higher. Software is higher. Crypto is higher. Technology coming back once again. So I think what's critical about NVIDIA this evening,
and the software ones. I think that this
I disagree.
Time, no, not given what's happened with the software.
We have stabilization today. Workday.
One day means nothing.
Workday. Workday was down. We were expecting that would bleed into the software names. Continue. I think you have stability in the software names. And I go back to the live stream yesterday from Anthropic. I think that was critical in giving a little bit of comfort to the market, in particular the software industry.
How can you have stability? One day means zero. IBM's down another. IBM on the week is down 7%. Who cares what it's doing today? Snowflake is down on the week. Who cares what it's doing today? CrowdStrike and Palo Alto and some of these other names are down on the week. Who cares what they're doing today? Which is why, Rich Saperstein, I would submit to the court as the judge.
I disagree.
That the tech trade in general has so much riding on it today. Salesforce and Snowflake are arguably 2 bellwethers in terms of the questions about AI and what's been happening there. So yeah, all 3 add to the importance today.
Look, the offensive team is off the field right now, and the defensive team is on the field. And that's probably going to carry on for, I don't know, weeks, months, who knows. But I think there's a defining point where we have to look at what price you're paying for earnings and the growth in earnings, which is PE to growth. And if you look at the staples, whether it's Procter & Gamble, Clorox, Coke, Kimberly-Clark right now, the PEG ratios are anywhere from 2.5 to 5. I own Procter. It's 5 times right now. If you focus back on the Mag 7, the bigger stocks, the PEG ratios are 1 for Google, 1 for Meta, 1 for Amazon, and 1.5 for Microsoft. So at some point, the market will redefine who's going to be on the field. Right now, it is clearly the consumer staples. As it turns to NVIDIA, they're going to put up good numbers because the hyperscalers are basically is spending $670 billion this year.
Doesn't mean that the stock is going to trade in kind, right? The stock has been stalled. It's run a little bit into the print. So a great report doesn't necessarily mean great price action. And that, frankly, is something probably more interesting to watch than anything else. I would also suggest, as Piper Sandler today downgrades tech to neutral, B of A's credit investor survey says AI bubble now seen as the #1 risk for the first time ever. Okay? 23% investor risk for the first time ever, AI bubble. So, Shan, that says to me why I framed it from the top the way I did. Joe's sort of sitting back looking at me like I'm crazy because I know he wants in
Never
again.
Crazy.
He's
Never.
leaning
I have
like
so many
this,
things to say.
looking at me. And I know when he does that what it means, and we'll get you in a minute. But Shannon's sitting next to you, and I want to get to her first.
Sure.
That's why I framed it the way I did.
And I think your point, Scott, is that the market right now is teetering between oversupply versus obsolescence. And I think that regardless of that B of A survey, I think investors are looking at what is the broader impact of AI. A couple months ago, we were all talking about the potential productivity enhancements, the creative destruction and disruption of businesses and the opportunities for growth. Now we're looking at it from the perspective of maybe some of these business lines are no longer relevant in terms of this AI. But I would point you back to NVIDIA. You made a great point. and Rich, you sort of talked about this already. Valuations, if you look at consensus expectations for EPS for NVIDIA for 10-17 implies a multiple of about 19 times, Scott. So given your point and how much demand has already been stated, put on paper by the hyperscalers, NVIDIA, I have to agree with Joe here, continues to be really important in terms of corroborating those expectations.
Hey, I didn't say it wasn't the bellwether. I'm not the one who said that. D.A. Davidson was the one who said that yesterday.
But I will agree with you that we get a blowout in earnings on NVIDIA. I actually don't know that that completely tamps down some of these concerns on software. And I think, again, the obsolescence idea, this disintermediation, this is going to be a rolling concern between now and when we start to get earnings again for second quarter.
I'm saying, Jim, that when Piper Sandler downgrades tech, and then Bank of America's credit investor survey says the AI bubble is now the #1 risk for the first time ever, that's why I think there's added and greater importance on these in total today. The two software names along with NVIDIA.
Well, look, I am today focused on the software names. Part of that is because NVIDIA, we all agree, should have an excellent quarter, an excellent guide, and the stock's running up into it, so it gives me some comfort that it will probably respond well.
I don't know. You know what?
I know.
They've seen muted earnings.
But the reason
that the stock has not moved a whole lot in recent prints. That's another thing.
True. That's absolutely true.
The stock's gained or fall in less than 3.5% after the last 3 reports.
That's absolutely true. But the fact that it's rallying the last few days into the report gives me some comfort. Maybe I'm wrong, but it gives me comfort. Where I am still concerned is software. Now, I do have to say with this D.A. Davidson report that when we say AI bubble is the biggest concern, are we saying that the data centers...
That was the Bank of America credit
Bank of America.
Survey.
There's two things that can't be true at the same time. We can't have this massive overbuild of data centers and then at the same time say that AI is killing everything in its path. I just don't see that as a viable duopoly.
No, again, it's their credit investors, so it all plays in the same story. Well, if you're borrowing hand over fist to build data centers and to raise capital to deploy towards the AI trade, well, if you're overdoing it on all accounts, like the market has placed its bets at certain times with some of the names out there, whether it's the private credit names or the Oracles of the world or others, that's why you get #1 risk for the first time ever, according to them, an AI bubble.
Just go back to where I just want to finish my point really quickly, because software is, to me, the more important part today. And I think the Workday earnings report basically doesn't answer the question. Because on the one hand, hey, they've got 12 to 13% growth going forward. On the other hand, that's down meaningfully from the high teens of a year ago. The one thing I will point out on this, and I think it applies to Salesforce, applies to Adobe, applies to all of these guys, is that their share price charts actually exactly mimic their valuation charts. It's not a question of earnings. It's a question of what we're paying for earnings. And I think when we're down at roughly 12 times for some of these companies, that it's cheap enough. And that's why Workday is actually slightly positive
It's what
today.
you're paying today for your idea of what the future earnings are going to be.
A lot of
You're
questions
not paying
about that.
these prices based on what you think today's earnings are going to be. The real fear is that you might have to pay even less because you're more worried about what future earnings are going to be. You got to keep that into perspective too.
That is in my perspective, and what I'm saying is specifically, if you look at Workday, just as an example, I don't own it, but 2 years ago, stock traded at roughly 35 times. Now it's trading at 12 times forward.
For a reason, isn't it?
Yes, and the question is, what you just said, Scott, about the skepticism about what forward earnings are actually going to be, is, I think at this point, appropriately priced at 12 times. At 12 times for an asset like these are asset like.
You're trying to be a rock star. They keep telling you at Workday not to be a rock star. You watch these commercials.
You think I'm trying to be a rock star?
You watch
I'm just
these
telling you what's on
commercials?
my mind. I'm just telling you what's on my mind.
Billy Idol is telling you don't be a rock star.
Billy Idol? Okay.
He's in the commercials.
Okay. All right, now I know what we're talking about. Sorry, I kind of...
Jimmy.
Look, man.
Jimmy, have some water.
I'm not an HR guy. So those are good commercials, but they go right, in one ear and out the other. I'm sorry.
Just save him.
I know Joe wants to get in on this, but I think I want to note something that you just said, Scott. That was from the credit analysts, right, at Davidson. There's a reason that there's equity investors and credit investors.
Yeah, the equity investors ain't feeling much better.
But AI actually creates hard-to-price tail risks for bondholders. And I think that you're going to continue to see some dispersion in terms of views on credit versus views on equities. And I think that investors need to take that with a grain of salt in terms of thinking about what is the earnings going to support. That may not be as supported to bondholders because of that cannibalization for CapEx.
I want to focus on what has to happen tonight. when you have, according to Vanda Research, retail conviction soft into NVIDIA. Net buying into the earnings is running materially lighter than prior quarters. I told you what the response has been to earnings over the most recent prints. And who better than Christina Partsenevelos to join us now with the title of her hit today, Show Me the Money, Jensen. What does he have to really show to change the, I don't know, the trajectory of late?
A lot of it is going to ride on the earnings call for what he says, because you guys talked about it. Another beat and raise is really just the base case this afternoon. April guidance is going to be roughly around $75 billion. We're expecting the backlog to climb higher than $500 billion. Blackwell, which is the advanced GPU, which is still ramping, but none of that is really a surprise at this point, and maybe why you're not seeing retail investors get into this stock. The stock is essentially flatlined for months. Year to date, it's lower than the SMH, despite two reasons. You guys talked about the hyperscalers continuously raising capex, but also bullish supply chain from, let's say, Wistron, for example, which tells you the bar isn't the numbers, it's Jensen's conviction on what comes next. What markets actually want to hear is the narrative. How durable is hyperscaler demand in 2027? What happens to margins as memory costs climb into the Rubin cycle, which is another iteration of their GPUs? Are sovereign AI deals actually moving? And the stock, we talked about it, it just really hasn't traded meaningful post-earnings since mid-2024, Scott. And options right now is pricing in a sub-5% move. And NVIDIA's at its lowest pre-earnings multiple in a decade. Most seem right now content to sit on their hands and actually wait for GTC as the next big catalyst, which is March 16th.
Yeah, wow, that's interesting, those stats that you had. Thank you for the setup, Christina Partsenevelos. So Rothschild and Redburn, they write an open letter today to Jensen Huang. They talk about two deals, AMD with OpenAI and AMD with Meta. That was a big deal this week. AMD shares rising substantially on that. Illustrate the strength of your market position. Again, this is the letter to Jensen Huang. Yep. They also demonstrate the degree to which your rivals are determined or desperate to compete. Your largest customers are no exception. The big five all have XPU accelerator programs. I asked Jensen Huang about this very question, about the competition. When we spoke a few weeks ago during the Super Bowl run-up, here's what he said.
You know, none of that bothers me. We're the only company in the world that takes our roadmap and all of our secrets, and we share it to our customers who are also building their own chips internally. That's how much confidence we have.
All right, so that's Jensen Huang on the competition, right?
Yes.
They're doing business with them, but they also want to beat them. It's undeniable that they want to do that. As Rothschild talks about in the letter today, in which they also mentioned the GTC event coming in March, which Christina was just talking about. They want to know about strategic threats to NVIDIA, competition with AMD and others, geopolitical, customer concentration, supply chain, and so on and so forth.
And that's what I'm looking for in this conference call this evening. I want the confidence furthered to what Jensen Huang already spoke with you about out at the Super Bowl. You have the inference chips, you have the tensor processing units, you have Meta and others who have said they are building out and designing their own chips. I want to understand that he is extremely confident and comfortable with the significant market share that he has. I think that's really important to hear. We know the earnings are going to be good this evening. The stock as we speak right now is trading to its highest level so far for 2026. I think that confidence brings the stock higher.
Well, we'd be shocked if it was anything but that. I mean, you can't come off of a mega cap earnings season where you've got like $700 billion in projected spending this year on CapEx, and Jensen Huang is going to sit there and say, you know what, I'm not really sure about demand. I'm not sure where that $650 to $700 billion is really going, guys. Right. No, obviously you know what he's going to say. I turn to you on the software angle because you own Snowflake, which was avoiding the big sell-off in the software pullback initially, but it's been caught up in it like everything else. Now year-to-date down 24%. You see where it was in the early part of the year, and it's just been a steady decline with that cliff dive and now a sideways trade since.
It's a tiny position which we just bought. So I think
timing.
What's it?
Nice timing.
To be determined, but
I had to say that because whenever I come at somebody with like something that's like, well, it's a very small position in my portfolio, I'm like, It doesn't matter. What do you think? Our viewers have massive positions in all these stocks?
It's 10 days.
They feel the pain, whether it's large, big, medium, whatever.
It's a 10-day-old position.
Okay.
And I think we have to have a framework for evaluating software. Those companies that charge excessive rents are going to be impaired. So there'll be reduced license fees, seat costs. But those software providers that have hard to replicate workflows or proprietary data or security or compliance integration, they're going to be doing just fine. And they're going to actually thrive by adopting AI. Snowflake falls into that category. So first of all, they're a pay-as-you-go revenue model. It's not a SaaS model. Secondly, half their revenues come from AI-related workflows. 125% client retention, meaning that their existing clients are actually boosting the revenues with them. So I'm not worried about one quarter. It's a toehold position, which I plan to build over time.
You think this is a one-quarter phenomenon? Ostensibly, you bought the position 10 days ago because you looked at the landscape of the software sell-off and had to have at least some inkling in your mind that, okay, maybe this is it. Maybe it's overdone at this point.
Yeah, the software Armageddon is at or close to bottom right now.
The SaaS-pocalypse.
Exactly, whatever you want to call it. And it's time to have a framework, which I just laid out, and to start identifying where there is value in that landscape of fallen companies.
All right, then let me ask you this. Would you buy Salesforce here?
No.
Why
That's
not?
the one that's a SaaS model, per seat, per license, with excessive rents being charged.
So any SaaS-related name you're running?
It depends. It's got to fall into proprietary data, hard to replicate workflows, security integration, compliance integration. Within our framework, we're looking for names that fall into those categories.
Okay. How about that?
Big picture, I think there's far more complexity surrounding software than we're really giving credit towards. If you believe that software has resolved the carnage of the last several months,
do you?
Well, then you're buying the private credit names, because that's really the opaqueness of all of this, is the exposure that they have to the significant direct lending loans that they have made to the private software industry at valuations that no one knows, 20, 30, 40 times. So you're going there to the private credit. As far as what's going on with public software companies, okay, I mean, it's easy to understand. First of all, there's a significant rotation going on that's continued from 25. So far, year-to-date software, as represented by the IGVs, down 24%. Semis are up 20% so far year-to-date. So the money just keeps going from software to semis. You have semiconductor names making 52-week highs today, Monolithic Power, Applied Materials, you have Lam Research. So the money is in semis. The real complexity resides on if software is going to continue to fundamentally deteriorate, then it's private credit that I'm most concerned about.
I can't find many people trying to call a bottom in software. I don't, Shan. I mean, I've asked this question to guests on, either one of the programs, and when I say, do you think software has more to go? They're like, yeah.
Well, I think as a group, I mean, we haven't really seen that dispersion or differentiation in that universe yet. And so I would argue with you that that's what should be the next step, is when we figure out, who, to Rich, there's a lot of investors like Rich who are looking at each of these individual software companies and thinking about the potential sustainability of those businesses, their competitive moat. But to Joe's point, I just want to clarify. I think what, Joe, you're saying is that if you feel like there's a software bottom, why wouldn't you buy those private credit names?
And I don't feel that way.
But why wouldn't you buy those private credit names? Because that's only a portion of what's in those private credit books that likely has been pulled down, perhaps overdone, if you will.
That's why I don't think it's 2008, because the full exposure of the portfolio is not in the software names. But those lenders that had the exposure to software, I don't think they're past the worst.
So I agree with. Can I say I agree with Joe? I don't think there's an easy button on software right now, and so I do think there is more dispersion to occur.
All right. So on the private credit angle, the iConnections conference is going on down in Miami, and Boaz Weinstein had an interesting comment down there. And he was looking at what's happening in private credit. Said the wheels are coming off, worried about the overspending in AI. He said, quote, all you need is the snowball to start going down the hill, and it started. Blue Owl is right in the middle of that. I think we are in the super early innings of the wheels coming off the car. Okay, so I had Mark Lasry on of Avenue yesterday on Closing Bell. I asked him about the software piece of this and the concern about where some of those loans are marked. Here's what he said.
Of course, you should be concerned. I mean, we should all be concerned. Today, would you want to make that loan at par? That's the real question. And I think the answer to that is no. You'd want more collateral. You'd want a higher EBITDA. So things have changed, but you don't have that luxury. So if I was going to go buy that, or other people wanted to buy that loan, you'd buy that loan at 80 cents. You wouldn't be paying par for that loan because you're not getting paid enough for the risk you're taking.
Okay, this is about one part of the story that we're focused on. I'll come back to you guys. I want to have a conversation about this because UBS today says 15% defaults could happen in private credit. Now, those who are in the private credit business disagree vehemently, I think, with the fear, the anxiety, with what they probably perceive as fear-mongering about what's taking place within their books and their businesses. We'll see what happens. Where do you all come down on this? What do you think?
Well, look, as I've said previously, we don't own any private credit. We don't own illiquid assets in a world that moves way faster than you can get in and out of them. In terms of AL, ARCC, KKR, APO, those names probably at some point become cheap and over the long term do rebound and become, good opportunities. I wouldn't go near them now. It's just too much uncertainty. I'd rather own the direct companies. Going to Joe's point, the direct companies that are public companies versus the lenders to private software or private companies right now. I just don't want to be in there.
Well, hold on real quick. Because you're kind of the perfect person to ask. Your clients are probably all high net worth people. So you're saying you don't have any of them in private credit at all?
No.
At a time when that part of the investment advisory business is moving pretty quickly to give their clients access. And playing off that, it brings me back to what Lloyd Blankfein told the Wall Street Journal in a recent interview. He took a shot. Now, I read this before. I'm going to read it again. Lloyd Blankfein took a shot at the private equity firms and the private credit businesses for expanding to include retail in a bigger and bigger way. And there's a screen. Where's the screen? Why are you going into this dangerous territory just to make your business a little bit bigger when that represents such a big potential problem in the future? These securities are opaque and may be riskier than most, but to the extent you're selling to institutions, people don't care that much. But if individuals lose money or insurance companies or real businesses lose money, it's terrible. I think it's so short-sighted of these guys to get into it for that reason. I don't hear a lot of people saying that. I'm saying that. That was Lloyd. To which I asked Mark Lasry again about that side of it, whether he agrees or disagrees with Lloyd. Listen.
You can only give liquidity when there's no issues. And the minute there's an issue, everybody wants to get out, and especially retail investors. So I think Lloyd is absolutely correct. It's wrong, but it's a business, and people love that business because they can get large fees from it.
It's like he's a truth teller.
So
right?
We look at the universe of long-short equity, multi-strat funds, private credit, private equity. And we started exiting that years ago. Our exposure is infinitesimally small relative to the industry. We think that the world moves too quick, the returns are too low, and guess what? When we can get 4.5% tax-free in a municipal bond, that's 9% pre-tax equivalent, which is really what these funds are purported to generate in good times. So there's no reason to tie money up in a liquid investment when you can replicate those returns on an after-tax basis in a fully liquid municipal bond. That's our thesis.
Two things are getting conflated here, and they needed to be separated. One is the liquidity issue, which Mark Lazary is talking about. So is Mr. Blankfein as well. The other is a credit concern. Now, credit concerns popped up in October, Scott. I mean, that was Tricolor and First Brands. There was some other telecommunications company that got caught up in it as well. Right now, we're actually not talking about credit concerns. Yes, you pointed out, Scott, that UBS says there may be 15% credit defaults. Okay, that's fine. I mean, look, I'm not a big fan of licking my finger and sticking it in the wind and make predictions like that, because right now the indications are not that there are credit concerns. There are liquidity concerns, and they are different. Now, I'm not going to defend and I'm not going to criticize Blue Owl. I'm just going to state the facts. They had a 5% per quarter redemption gate, and they're giving back 30%. At par, by the way. There are a lot of questions left to be answered. What's the other, the rest of their balance sheet, their loans, what do those look like? Where are they marked?
However, do you have any of your clients? I don't want to debate. I don't want to debate necessarily the merits or the pitfalls of private credit. People know that at this point. It's simply the idea that retail, for the first time over the last few years, has the ability to have exposure to it in a way that they never did. Yeah. And I'm not going to suggest that, it's the so-called dumb money getting into things that they don't know what they're getting into in any way. It's their, advisors who are giving them access to yet another way to diversify their portfolios, theoretically get broader returns, but they are either semi or highly illiquid assets, which investors are learning about even more now with the decline in the software stocks.
Which is exactly why you need advisors for this. You need advisors to select the right firms to do this with, the right vehicles within those firms, and most importantly, the education. And I will tell you that as much as what you just said, we're not defending or criticizing private credit, a lot of people are. A lot of people are. And when we talk about credit concerns and all these talks about something systemic happening, I don't think that's the right education. The right education is, if you're in these things, you have to be aware of illiquidity. And as long as clients are educated on that and have advisors to guide them to the right vehicles, they should be fine.
This is where I think this is ultimately going as it relates to private credit. It is complex, it is opaque. And when you think about investing, Josh has been talking about Halo. One of the most brilliant investors I have ever met on Wall Street is David Tisch at LSV Advisors. He does liquidity financing solution. Where is he providing that liquidity? Directly towards the hard assets. And I think private credit, you can't look at it universally and say it's all bad, but you have to look at it and you have to isolate where the exposure is with software and then where the good exposure is as it relates to hard assets.
All right, so we're going to take a break. And when we come back, we have some committee moves to get to. Rich Saperstein, I'm looking at a couple right in front of me. We'll document those next. Welcome back. Let's do some committee moves that I have in front of me. Rich Saperstein. So you're focused on healthcare here, and you bought more Pfizer. That's number one. Why?
Pfizer and Bristol. So
I didn't get to that one, but okay, yes.
Okay, so
thank you.
Together or separate?
Well, now, I mean, since you decided you were going to do both at the same time, together.
Okay, so the thesis is broadening of the market, put the defensive team on the field. And we added Bristol and Pfizer. The reason is 12.5% operating cash flow. Spend 1% on R&D, 1.5%. So there's a lot of operating free cash flow to return to shareholders. But more importantly, they have over 40 compounds in clinical trials, each of them. And they have growth portfolios. So there's a lot of shots on goal with each of these companies. Plus, they have the cash to return to shareholders. So in an area where I want defense, not offense, in a portion of the portfolio, that's why we added the two names.
Okay. In terms of BMY, let's take a look at that one, because it was initiated sector performed today at RBC. They got $60 on there. Just a market performer. What's your case for the big upside with this one?
Well, if they have a clinical trial that produces a favorable outcome, you'll see these stocks go much higher. They've also lagged the industry, these two, the sector. So I think there's great upside to both of these, and it's a defensive play in an area where I want some defense in my portfolio.
Okay, you chose Merck recently as your sort of entree here.
I did.
Over Pfizer and some of the others. Why?
Yes. Well, first of all, I love what Rich is doing here, getting the exposure to healthcare. At the last rebalance, we took our weighting up to 12.5%. So it's Merck. I think Merck is doing a really good job understanding that the patent expiration on Keytruda in 2028, they have to diversify the business. They're looking towards the immunology division to really pick up some of the growth that they're going to lose there. But just in totality of healthcare itself, the names we added, it's Lilly, it's Merck, it's AbbVie, it's Abbott Labs, it's Gilead, which is arguably our best performing name right now. It's Cencora, it's Vertex, it's Regeneron. So healthcare really is working. And this began in the fourth quarter. It's not like this began January 1st.
No, but it did stall for a bit to start this year.
It
People are
stalled
wondering
in
where
biotech more than anything else.
Oh, okay. So, by the way, AbbVie outperformed RBC 260. Lilly outperformed also at RBC 1250 is the target there. Let's get the headlines with Mackenzie Sigalis. Hey, Mac.
Hey, Scott. Former Treasury Secretary Larry Summers is resigning from Harvard at the end of the academic year. He's been on leave since November, following the release of emails between him and the late convicted sex offender Jeffrey Epstein. According to a Harvard spokesperson, his resignation comes in connection with the university's ongoing review of the government-released Epstein files. Dr. Casey Means, the nominee for Surgeon General, said today in her Senate confirmation hearing that she believes vaccines save lives when pressed on her stance. However, she suggested that every patient should have a conversation with their doctor about medicines going into their body or their children's bodies. She also said current science shows vaccines do not cause autism, but suggested science is never settled. And Aston Martin said today it's cutting its workforce by 20%. The British luxury car maker says the layoffs are needed to absorb the impact of U.S. tariffs and weak demand in China. According to a regulatory filing, the move will result in an annual savings of more than $50 million. Back to you.
All right, Mac, thank you. Mackenzie Sigalis. Up next, something just happened in the housing market. Hasn't happened in nearly 4 years. I'll tell you what it is next. show you the home builders here having their worst day since April, even as mortgage rates fall to their lowest level in nearly 4 years. So you're looking at the group getting hit pretty hard. Joe, you own Pulte, but what is this on? I see some people trying to blame policy uncertainty. I mean, mortgage rates down, home builders also down?
I don't think you got further policy details beyond reiterating maybe banning institutional investors. I also think what we heard from Lowe's and Home Depot maybe troubled.
Depot was good. What do you mean? They had this surprise pop in comps.
They warned on the home. Lowe's specifically cited some weak demand as it related to housing, so I think that was a little bit troubling. Take a little bit of the other side of this negativity. Pulte's pulling back here, the 50-day moving average, if you could pull up Pulte, please. 50-day moving average is down at 128, so this is more of a technical correction, I think, than anything else. I take the other side of it.
Okay. So we have this revised offer from Paramount, right, for Warner Brothers Discovery. Now, a lot of people on this show was like, I like Netflix, but the stock's not going to do anything as long as it's embroiled in this, merger drama. If Netflix doesn't emerge the winner, and maybe that's what the market is voting on today, which is why the shares are up 5%, because the market doesn't want Netflix to be the winner. Who's buying this stock? You going to buy it back? You sold it because
I already saved all of the Netflix shareholders by selling out.
You sold it.
I did.
In part for the very reason which
Yes.
I said, and actually a critical part, maybe the biggest part.
Yeah, the reason why I would be somewhat hesitant to buy it back after obviously liquidating at a lower level here is I don't have the confidence that Netflix wouldn't turn and go in another direction to try and acquire the asset. So that's the only thing that would be an impediment for me actually going out and buying back the shares. But I'm sure at some point, if it reestablishes the momentum, we'll go back to the name. That's not a big deal to me.
What about First Solar? Can we look at that? They gave lower than expected revenue guide.
Net
Stock's down.
Yeah.
Hold on, let me finish. Let me finish. Got more bad news to pile on you before you go. Stock's down 12%. Downgraded at Baird. Quote, numerous unknowns and outlook lacking clarity. Goldman does reiterate the buy. They say buy the dip. What do you think?
I think 12% is actually better news than I was prepared for, because it was down worse than that.
Okay.
This is all about growth slowing. This is about growth slowing and not being able to replicate what they did in 23, 24, and 25, which was 20-plus revenue type years. This is a upper single digit at best. They had the tailwinds in 25 as it related to easing trade, the power demand here in the United States, and expanding their manufacturing footprint, I think, in 26. It's more about kind of running in place for this company and getting to 27.
Costco feels like it's kind of run in place, right? The stock hasn't been great. Let's do a year to date on Costco. Oh, it's up 15%. Maybe I'm wrong on that. I think if you back it out a little longer, though, it hasn't done all that great. Reiterated buy today at UBS ahead of earnings next week. I don't know, 6 months, 5%. Market's up more than that, right?
Well, I've owned Costco for 17 years, so you're talking to a great fan of the company.
Still? Okay.
Yeah. Look, in the world where there will ultimately be three dominant retailers, Walmart, Amazon, and Costco, I think you've got to take a position. We own Amazon and Costco. So they have a membership model, 90% renewal rate, 20 to 30 warehouses that are being built every year, global expansion, consistent margins, loyal fan base.
Why is it down 6% over the last year?
How about over the last 17 years? It's been. I think if someone wants to be in retailing, own retailing, where are you going to go? So this is, look, it's an expensive stock. It's
Rich, isn't this a classic example of what you started the show talking about, high peg ratios and consumer staples?
Yeah.
I mean, doesn't that give you a little worry, 5.4 on the peg ratio?
I would agree with you, but I've owned it for so long, and if there's a pullback, I add to it. I just think it's a great growing company over the long term.
Okay. Santoli's next with his midday word. We're back right after this. we have a news alert. Kate Rooney has that for us. Hi, Kate.
Hey, Scott. So I am now hearing from a source that Josh Kushner's Thrive Capital invested in OpenAI at essentially what is a discount. So it was a $285 billion valuation late last year. That was a fraction of the valuation OpenAI ended up raising money at, around $800 billion. It was a $1 billion deal back in December. So it basically allowed Thrive, according to the source and folks I'm talking to get a preferential price in around late last year. Josh Kushner and Sam Altman, very close. Thrive was an early investor in OpenAI and has been one of the main financial backers. Wall Street Journal first to report this. They described it in that piece as basically a call option. No comment here from Thrive or OpenAI. But again, this was a deal late last year, comes as Thrive itself is raising massive funds to invest in more of these venture capital names, AI especially, but a major backer in OpenAI, and that's the latest cut.
So just quickly, just to make sure we all understand each other, this was simply a preferential deal for Thrive, and in no way an indictment in any way, shape, or form of the current valuation of OpenAI, right, which is like, what, I don't even know now, $800 billion?
So exactly, Scott. So separate deal from what is actually going on right now, which we've reported is a $100 billion deal in itself. We're hearing that it's SoftBank, NVIDIA, Amazon. There is this ongoing financing happening right now, February 2026. This had to do with the deal late last year. So it is more of a Thrive story in my mind, that they were able to get in at a discount, get this preferential price, and get into that round with basically a call option and some interesting sort of preferred financing. So in some ways backwards looking, but speaks to this close relationship between Josh Kushner and Sam Altman and OpenAI. But I'm also told they are expected to participate in this current round, which could close as soon as this week. And that is really the mega round that will push OpenAI's valuation even higher.
Yeah, closer towards $1 trillion. All right, Kate, thank you. That's Kate Rooney.
Scott.
Senior markets commentator and overtime co-anchor Mike Santoli is here now with his midday word. We framed this, Michael, as a real critical day for the tech trade. It would be, we would think, just if NVIDIA alone, but if you throw Salesforce and Snowflake into the stew pot, you got a lot that needs to come out tasting good.
You do, and I think what has led us up to this is very relevant, which is essentially everything but tech working. You have a 2-day rally in software. We've been saturating ourselves with the disruption trade and whether we've kind of, repriced that too aggressively to the downside. Also kind of stewing in the private capital concerns. Now banks are bouncing. I'm just making the case here that the market's narrowing back out to mega cap leadership today. NVIDIA looks like it wants permission to run. It's at a 3-month high, and maybe we have the pendulum swing back to, maybe we overdid it on Mag 7, which maybe gets the overall S&P 500, which is bent but not broken, into that range of the old high. So I think that's how it all comes together. It's just how I always say a broader market is not a better market. We have a narrower market. It might actually be what the tape needs right now to carry us further.
I'll see you at 3, and you're going to have a really exciting one on OT today. Sure. Can't wait for that as well. I'll see you in a little bit. The setup's next. Let's talk some setup on some earnings outside of NVIDIA, Salesforce, and Snowflake. TKO Group. After the bell today, you personally own this one, Joseph.
I do. 21 cents EPS, about 1.3 billion in revenue. The company is growing its revenue. That's why it has a little bit of a rich valuation. On the call tonight, you want to hear and understand what the cost is going to be for the UFC White House on June 26th. There's estimates it could be 50 to 60 million.
How come you don't own this in the ETF?
So if you rank 1 through 125 in what we hold for the ETF, this fell ever so slightly out of that number.
125 and a half?
That's why my compliance is watching.
126?
That's why I bought it personally, because I knew it was just sitting right on the outside, on the bubble.
Are you telling me not to ask you any more questions because your compliance is watching?
I would appreciate that. Did you know Monster reports tonight?
Monster is tomorrow.
Tomorrow, I'm sorry. They report tomorrow.
Are you flustered now? You're worried about your compliance?
13% revenue growth there. You want to hear about the effect on aluminum as it relates to the tariffs, but this stock continues to work in consumer staples. Yeah, right. I'm flustered.
I hear you. Okay, we'll do finals next.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
All right, 3 o'clock Eastern today, you know what we're going to do. We'll count you down to NVIDIA, Snowflake, and Salesforce with Stacey Rascon, Bryn Talkington, Malcolm Etheridge, Doug Clinton, and Abby Yoder, and I hope you all will join me then. Richard Saperstein, what's your final trade on this momentous day for this market, tech trade, important day, everything else. What do you got?
Small unknown company called Microsoft.
That hasn't traded very well.
No, and now's the time to be adding it. It's a great opportunity to buy a hyperscaler, growing 38% in that business, 7% operating cash flow.
Okay. Jimmy got all worked up during the private credit conversation. As you notice, he pounded like 3 waters. Normally it's 2. No surprise then that he picks Apollo Global just to throw it right in our face.
I don't always
here on the bench.
I don't always get to use words on this show, so sometimes actions which speak louder than words are used.
All right, Shan.
Energy sector, nice run already, but there could be more room to go.
Okay, Joey.
TJX, excellent report this morning. It's a long-term buy.
Okay. Stock's giving back 1%. All right, we got a big one this afternoon. I'll see you at 3 o'clock. The exchange begins right now.
Thank you very much, Scott. We've got some huge earnings on tap, a big sigh of relief in the crypto space, and a few things that weren't said at the State of the Union last night might give the crypto world and a few other folks some pause today. We'll get into all of that. Welcome to the exchange. I'm Kelly Evans. Let's start with stocks broadly here, which you can see we're higher across the board. The NASDAQ is clearly leading the way. It's up 1.2%. That's about double the Dow's gain, 0.5% for the small caps, 0.75% for the Russell 2000s, for the S&P 500, I should say. And NVIDIA is up 2% ahead of its report tonight. Software is also rebounding for a second straight session, even with a 10% drop in Workday. And here's the crazy thing. Look on your screen right now. Not only are Workday shares off the worst levels, they have turned positive. Again, if that doesn't capture what's going on in software right now, Workday from down 10% to up 1.2% right now. Salesforce and Snowflake are also both rising, and we'll hear from both of them this afternoon. We also mentioned crypto, some huge movers here today. Circle's up 29% now after a massive earnings beat. It's driving up shares of Coinbase 13%. Robinhood is up about 5%. It's also getting some help on a bullish note from B of A. Bitcoin is up 6.5% to almost 69,000 now. Let's start, though, with NVIDIA's earnings after the bell. We'll circle back to a lot of those other topics. The shares are up 2.25% or so, and they're on pace for their first 4-day win streak since December. And the PE is still only around 27. It's lower than Broadcom or AMD. Our next guest is expecting big things from tonight's results. Get out the popcorn. He says Wall Street estimates are being significantly underestimated over the next few years. Dan Ives from Wedbush Securities is here with us. He's the global head of technology research. What are the numbers, Dan, that you're looking for? Welcome.
Yeah, great to be here. Look, I mean, obviously, in terms of overall growth and, call it street looking for, I ultimately believe will be mid 60% type growth. But I think it's all about 2027 growth. I mean, street right now has 30%. Look, I think when you look at overall data center and you look at CapEx, the $500 billion from Blackwell and Rubin, I mean, that could be estimated by 500 bips, 1,000 bips when it's all said and done. Look, there's no one that has a better perch in the AI revolution than obviously the godfather of AI, Jensen. And in what's really been AI ghost trade, this is a very important print. I'm expecting gold medal performance from NVIDIA.
And how important do you think it is for the rest of the market, Dan, which has been happy to find leadership in the semis broadly, even when NVIDIA is not participating, has been happy to look at the hardware names, has been happy to be in memory, has, you know what I mean? Like it feels like less is at stake now than it might have been a year and a half ago.
I think to some extent, yeah, I mean, everyone's been piling into obviously hardware and semis. Software right now is almost a do not enter zone. I think that continues to be the most disconnected trade out there. But it all speaks to what does demand look like? What is NVIDIA seeing? Especially China's going to be a big question mark. That's essentially really nothing right now. As the H200s ultimately come in, that's going to be key. And then what does it look like in terms of Blackwell, Rubin pipeline? And then, when you look at the timing of everything, this continues to be massively underestimated. There's one chip in the world fueling the AI revolution, and sovereigns in the rest of the world haven't even started to come in. And I think that, to us, is why this is just a pivotal report, especially what Jensen's seeing from a demand perspective.
Okay, you mentioned the software names, Dan. Look at Workday, right? And I remember you said yesterday morning as Anthropic was unveiling its big event that ended up being more about partnerships and disruption. You were saying this is the most oversold this sector has been maybe ever. What do you make of the reversal in Workday now? And is this a space you think investors should load up on, or do we have to wait to the points we were hearing last hour from kind of big name investors who are saying maybe it's better to kind of step aside here and let the dust settle?
Yeah, Kelly, I think it's the most disconnected trade that I've ever seen in my career, going back to late 90s, in terms of what's happened in software, especially when I look at Salesforce, ServiceNow, I look at IBM when it was down 13% on the worries about Claude and ultimately what these tools are going to do. Look, I'm not saying there's not some software companies that are going to be on the wrong side of this, and they will be. But the reality is that structurally, software is going to be key to actually the success of AI in the use cases. I think right now it's an AI ghost trade that you're fighting, and I think software, this is going to be viewed as, I think, generational, we've talked about, generational opportunity on names, on big tech. When you look at some of the core software names, Salesforce, ServiceNow, IBM, you look at Palantir, you look at Microsoft right now, the way that that's trading, I think this is really, the rubber meets the road. It all starts with NVIDIA.
Yeah, and one of your colleagues on the street over at Rothschild had a fun open letter to, I don't know if you saw this, it was kind of making the rounds, an open letter to Jensen Huang where he asks about some specific issues that he said, he wants to hear him address market concerns and begin to reverse this derating. He points out that the multiple is trading at less than McDonald's. There are 3 broad categories of issues, he says: the outlook for AI training and inference, customers' technology requirements and their roadmaps, and then the fit between customers' future workloads and NVIDIA's product roadmap versus that of your rivals. I mean, look at what AMD and Meta are doing today. So how would maybe Dan Ives, bullish on NVIDIA, respond to some of those concerns?
Yeah, look, I think those are great points. I think, look, first off, it's really trying to give some sort of roadmap to what this is going to look like in 2027. Because fiscal 27 is what this is all about from NVIDIA. Is it 30% or it's 40% growth? It's 75% margins. You could argue then the stock's 230, 250, or even much higher. Then it's addressing, I think, the software components as well. Jensen's a big, huge supporter of the ecosystem. And I think what's happening right now, it is a dislocated, really a disconnected trade relative to how Claude and Anthropic, they're not going to structurally break software names. But it all comes down to the CapEx. CapEx is accelerating. And we've said for every dollar spent on an NVIDIA chip, it's an $8 to $10 multiplier across the rest of tech. And that, to us, is instrumental in what I believe is going to be the bull thesis playing out for tech.
Yeah, another point here, he says, while these deals, for instance, between Meta and AMD illustrate the strength of NVIDIA, they demonstrate the degree to which rivals are determined or desperate to compete. And if NVIDIA is up against kind of some very big-pocketed other players who don't want to have, they don't want this to be a shakedown, that they just have to keep paying for these chips for years on out.
Look, and the reality is the new gold, new oil in this world, it's NVIDIA chips. I mean, and that's why there's no one, I don't think there's, when you look, they're years ahead of competition. That's why even a third-rate chip in China will, I think, be higher demand than Huawei. But it all comes down to why this is such an important night with NVIDIA, with, of course, Salesforce and some of the software, because it's an AI ghost trade. And it all starts with Jensen putting on the black leather jacket. And that's the first step to defeating the ghost trade.
I love the importance of the theatrics, putting on the black leather jacket. Dan, thank you very much. And it'll be an exciting afternoon for sure. Dan Ives from Wedbush, we appreciate it. Sticking with the theme, my next guest also owns NVIDIA and has been a longtime holder of AMD, but she's also looking at a few other names as the AI story and the build-out evolve. Let's bring in Kim Forrest now. She's the Chief Investment Officer at Boca Capital Partners. Kim, it's good to check in with you. Do you want to jump? I mean, are you as bullish on NVIDIA and on the industry broadly as we just heard from Dan Ives there?
I don't think anyone could be. I mean, I think Dan shows you who he is by how he dresses, and he's a happy guy. The glass is 3/4 full, not just half full, right? And I think he has lots of good points, but I also have to, be the word of caution here that maybe, there's a lot of fear out there that AI isn't going to roll out how everybody thinks, and especially owners of NVIDIA, how they think it's going to roll out. So I guess I'm a little bit more cautious on the whole ecosystem, although in the long run, I do think AI is the thing that gives us productivity. So it comes to fruition. It's just a longer timeline and not the way you originally think it's going to play out.
It might not matter because you still own NVIDIA, you own AMD, you own Micron, you own Synopsys. I mean, so I'm looking, it's not like you're sitting over here saying, I'm sticking with, you know, consumer staples and utilities. I mean, you're right in the thick of this trade.
I am, but I'm also very cautious because I see these sell-off waves go through when we get information. Like tonight, I think it's already baked in. NVIDIA had a great quarter. Taiwan Semi kind of gives the nod to that because they're a big, you know, provider of their actual chips. So that's really not what we're concerned about. It's the future. And the future is really up for debate. Are we going to have as many data centers as we think, and thus have as many of the higher end training chips, the inference chips, all of those chips, and in a relatively short period of time? I don't think it's going to play out that way, but you know, you're right. I do own them, and I just am not betting on a timeline. Let's put it that way.
So you still think NVIDIA is going to set the tone? Again, you've been covering semis for a long time. Yeah. So do you still think they are going to set the tone? Are they still one of the most important, if not the most important stocks in the market?
Absolutely, and it's because of their incredible ability to create the hot chip and maintain that performance, right? They are, every iteration of these AI-focused chips are more powerful than the last version, and that's exactly what the AI developers need and want and are willing to pay for. However, you know, it's interesting watching this all play out. AMD has always had a GPU chip, and guess what? That's what all this stuff is based off of. And you know, yesterday's announcement was pretty exciting, and I love whenever there's competition in an area, and I think AMD will be a competent and a good competitor for NVIDIA to push them higher. But people will prefer a lower cost chip at some point, and AMD is ready to step up and you know, take their money.
I was thinking of you yesterday, and the shares performance year today. I said Kim Forrest with her AMD is happy right now. That said, can we talk some Google? I don't see them on your list here, but given how much you know about semis, when they came out with Gemini, which as far as I'm concerned is superior, and it's powered by their proprietary TPUs, which as I understand it are more energy efficient, and they don't have to use NVIDIA. I mean, why isn't this game set match for them?
Well, because there's a lot of other people developing these chips, and they will develop them for different applications. I do think NVIDIA should pay attention to that little phrase, lower energy use. That is very big, and that's something that you know, one of those companies that I also liked, Intel, was able to do in their higher end chips was every iteration of their server chips, they were targeting lower power consumption while not affecting performance. And I think NVIDIA should take a page out of it, you know, Google's playbook and investigate that. And that may cement, you know, their leadership.
The other thing that I just wanted to ask you about, I don't know if we still have this chart, it was a great chart from our Deirdre Bosa yesterday showing the top 10 models that people are using. Number one was Minimax. You had several Chinese models on that list, and the reason simply is they're cheap and they're in many cases good enough. They might be using older version of NVIDIA chips. What would that mean could they do to AI, the Chinese, with their technology, lower cost production, what they've done to other global exports and industries, which is to come in as the lower cost option and kind of set the price and disintermediate the market leaders?
Sure. I mean, that is really the problem here, isn't it? And that is a lot of the intellectual property fights that the we'll just call them the Western models are undertaking, you know, legal fights, because a lot of their data and a lot of their results are getting, you know, kind of scraped off for free again to be used in Chinese models. I think in any situation, there is always going to be a low-cost provider everywhere. But what you have to do, like your preference for Gemini, you have to make it more, just better, and people will pay up for it. And I think that really is the key to all kind of innovation, not just technology, is you have to have that product marketing, understand what your consumers want, go to where you don't even know that they want to go, and make that product for them.
Yeah.
And that's what Apple's done forever, right? We didn't even know we needed iPads, and here we have them, whenever that was a new product. So I think these models have to be the same way. They have to be able to figure out problems that people want to solve and make them worth the money.
And if nothing else, own Synopsys. Whenever I see you, that's a favorite of yours. Kim, thanks. We'll see what happens this afternoon. It's great to get your view here. Good to see you again. Kim Forrest with Boca Capital Partners. Coming up, let's go back to crypto. Circle shares are soaring on strong results. But do stablecoins have long-term earnings power? We'll debate that next, with the shares having their best day since last summer. Plus, the top takeaways from last night's nearly 2-hour State of the Union address. The president mostly focusing on domestic issues like the economy and government-backed 401ks. But our policy analyst says don't overlook his key line about Iran, what it means for the future of nuclear negotiations, coming up on The Exchange.
This is The Exchange on CNBC.
Finally, some excitement returns to the crypto space today. It feels very 2021 or something. Take a look at stablecoin issuer Circle. The shares are up 29% after fourth quarter earnings were much higher than expected. Some analysts saying it could have benefited as a safe haven play as Bitcoin continues to struggle. Here to discuss now, Dan Dolev of Mizuho, who upgraded Circle last month, and our own Mackenzie Sigalos. Welcome to you both. Mackenzie, I'll start with you. Here's my question. At a time when we're kind of calling into question the whole crypto ecosystem, and maybe Bitcoin, who knows what price it should trade at, but what does the strong demand for stable coins tell us about the potential durability of this whole system?
I mean, it really suggests that the crypto market is starting to mature because even in a broad sell-off, which is the mode that we've been in since October, there's now this clear defensive pocket within the ecosystem. So while Bitcoin and then the miners and crypto-linked equities are all under pressure, investors aren't necessarily exiting the space altogether. They're just rotating into stablecoins like USDC, which is what Circle issues. And that's increasingly acting as the cash equivalent of the digital asset world. And it was just amazing to see that show up in the Q4 print. Quarterly profit surged nearly 3,000% from a year ago.
And Dan, remind me why you upgraded them last month. What positive trends were you seeing?
So I agree with everything Mackenzie says. It's basically all about use cases. And if you think about this, really the only good use case right now is actually for stablecoin, and USDC is a winner here. We upgraded because Polymarket, prediction market, lets you only settle with USDC. So as Polymarket explodes this year, right? Think about how many events we have this year. That should be very, very good for USDC, and then in turn, very good for Circle. And that's the main reason we upgraded last month.
We've talked about the headwinds for Circle, namely that as the Fed lowers rates, they're going to make a little less on spread income, Dan. But how much is simple adoption or usage of its stablecoin going to drive earnings power? Is it going to continue to drive earnings power?
That's a great question, and that's the reason we upgraded from a sell to a neutral and not to an outperform, because there's still some concern, right? So you have to outrun Fed rates, which we'll see in May how much they come down, when there's a new Fed chair. The positives is Polymarket, it's agentic commerce, so agents are actually talking to each other, making purchases using tokens like USDC. So that's kind of the tug of war between the positives and the negatives.
It's ironic, Mackenzie, because at the very moment, again, that the poster child for crypto in many ways is still Bitcoin, and it's been struggling. So I think this would surprise a lot of people. But we've been kind of talking about this going back to last summer. The moment that stablecoins were kind of given the blessing, they were enshrined into the U.S. regulatory system, meant that the ecosystem can flourish. People can hold this thing without too much fear about doing business with it. Again, it's kind of matured. It feels like it's matured past Bitcoin into the stablecoin activity. I don't know what you're hearing in terms of competition there. It seems like every time you turn around, someone's launching a new stablecoin, and what that means for a company like Circle in the long run.
Well, in terms of the competitive landscape, you certainly see different players stepping in, including the Trump family with USD1, which is part of their World Liberty Financial Project. But I mean, ultimately, the Genius Act, that stablecoin bill, was helpful to the stablecoin ecosystem, but now the major overhang is the next bill, so the Clarity Act, and that's basically a fight over stablecoin rewards. So you have names like Circle and Coinbase going head-to-head with the bank lobby over the rewards that they're offering on USDC. So you can earn around 4% interest on idle US dollar holdings, which is great for a crypto investor who's parking their cash in a safe place during a bear market. But the banks, JP Morgan, Bank of America, are very unhappy about that. They say that they're not subject to the same kind of, rules and regulations that guide, bank savings deposits, that these are unregistered and unregulated U.S. dollar deposits.
Right.
And so that's a big fight right now.
And Dan, obviously it has echoes of 2008 money market funds to some extent, having to understand where that yield is coming from. But what would you say about those concerns that Mackenzie raises? And look, frankly, the president did not mention that act last night in the State of the Union. I think a lot of people in the crypto world were expecting him to, as kind of galvanizing support to get it passed, and he did not bring it up.
That's a huge issue. And I think just specifically for Coinbase, just give you like a fun fact, if it actually passes the way it's structured right now, in the short term, it might actually be like a really good thing for Coinbase's profits, because they still get all the revenue from the tokens from USDC, but they don't have to pay rewards. So even though they're against it, or Brian Armstrong is against it right now, in the short term, it's actually a boon to their profits. So it'll be really interesting to see how it actually ends up. But
but that's
just a fun fact on that one.
The link to Polymarket, the fact that, like you said, you're neutral, you didn't go to a buy-in, both of those things are interesting. Mac, thanks for bringing us all the detail about the quarter as well. We'll leave it there. We appreciate it. Dan Dolev and our Mackenzie Sigalos. We've got a news alert on the AI build-out. Pippa Stevens has the story. Pippa?
Hey, Kelly. So we're getting more details on President Trump's announcement last night of the ratepayer protection pledge, specifically focusing on big tech bringing their own generation. So Amazon, Google, Meta, Microsoft, xAI, Oracle, and OpenAI are all set to head to the White House next week to sign agreements to build their own electricity supply for AI data centers. Fox did first report this news, and of course comes as affordability is a major issue ahead of the midterm elections and a bigger push for tech companies to bring their own power generation. Unclear at this point how binding this will be and what the specifics will look like, but we've already seen companies, including Microsoft, pledge to bring their own electricity. So clearly part of a growing trend here with big tech heading to the White House next week.
Yeah,
Kelly?
Pippa, they need to show your names here, like on the screen. Constellation up 3.5%, not necessarily on this announcement, but who else would you say in the energy space are kind of the obvious partners here for big tech?
I think one area to watch is certainly the regulated utilities, because when you are talking about bringing your own generation, it's a lot easier in those vertically integrated, fully regulated markets. In restructured areas, including PJM, it's a little bit more convoluted since the utility doesn't own all of the wires and the generation. So those agreements are a little bit less straightforward. And of course, we saw PJM earlier this year call for their own, reformation of the grid and asking tech to either bring their own generation or to pare back at times of peak demand. So I think looking forward, Kelly, areas to watch include the Midwest and the South, and then just focusing on those regulated areas where it is a little bit more straightforward.
All right, Pippa, thank you for bringing that to us. Pippa Stevens. Coming up, drama at the Pentagon, giving Anthropic until Friday to agree to broad military access for its AI models, or it'll invoke the Defense Production Act. What that tells us about the position the company and the Defense Department are in after the break. Welcome back. So many echoes of the past in the market activity today. NASDAQ's leading the way, crypto's higher. The NASDAQ is up about 1.1%, only a 0.5% gain for the Dow. Take a look at shares of Workday as well. This could be an important turnaround to watch. They went from dropping 10% last night on weaker than expected revenue guidance to turning positive this afternoon, up 1.5%. Jeffrey's saying this reversal is certainly making people wonder if it's a sign the lows for software are in. No firms downgraded the stock today, just some cutting their price targets. And again, Workday is still on track for a 5-week losing streak and a record-setting 5th straight month of losses, down 45%. Coming into this. Still a reversal to keep an eye on. Elsewhere, here's a name being helped by AI. It's Axon Enterprise, the maker of tasers, body cameras, and drones, soaring almost 18% today after better than expected earnings and guidance. They say AI is accelerating demand for products like license plate recognition and voice-activated companions built into body cameras. The CFO expects Axon's software business will even soon outpace hardware growth due to these AI tailwinds. That's a story we haven't heard much about. The shares are having their best day since 2024 and are still down about 40% from their all-time highs. Speaking of businesses embracing AI, remember, NVIDIA's own CEO, Jensen Huang, his message to employees is to embed AI into everything you do. And a similar message is cropping up now amongst this year's CNBC Changemakers. Today, our new list is out, and joining us with the details is our very own Julia Boorstin. Julia?
That's right, Kelly. AI is a rising trend among this year's CNBC Changemakers, innovating across industries, using AI in industries ranging from real estate to healthcare, with 16 tech executives on the list, including Takitra Mawakana, co-CEO of Waymo, who's been expanding autonomous driving into new cities and forging partnerships with Uber and Lyft. Former OpenAI CTO Mira Murati debuted her own AI company, Thinking Machines Lab. And to improve social services, Binti CEO Felicia Kurkuru launched AI tools for the foster system and more with Anthropic. While in enterprise, ServiceNow President and CFO Gina Mastantuono and Cisco's EVP Francine Castudas are leading AI initiatives for customers and growing their market value. Also on this year's list, Elena Gomez, whose restaurant software company Toast uses AI to analyze customer data and advise restaurants on how to order supplies and run their business.
With the data that we sit on at Toast, there's a whole host of opportunities that we can do. We can leverage to drive insight to our restaurants, but also help them take action and help them run a more efficient business. So incredibly excited. A lot of our restaurants are saying this is game changing for them.
These women's accomplishments are all the more notable because women are underrepresented in tech leadership, and female-founded startups draw just about 2% of venture capital dollars, according to PitchBook. For more on these and other CNBC Changemakers, go to cnbc.com/changemakers, and you'll be able to hear from many of these women on stage at our Changemakers Summit that's coming up April 16th in New York. Back over to you.
All right, Julia, great stuff. Thank you very much, our Julia Boorstin. Let's get to Mackenzie Sagalos again for the CNBC News Update. Hi, Mackenzie.
Hey, Kel. Vice President J.D. Vance said in a Fox News interview today that President Trump still prefers a diplomatic solution ahead of a new round of nuclear talks with Iran this week. However, he warned that the Trump administration would unleash the U.S. military if necessary. Washington and Tehran are set to hold negotiations tomorrow in Geneva. Bill Gates reportedly apologized to staff of the Gates Foundation for his relationship with Jeffrey Epstein. According to the Wall Street Journal, Gates insisted he did not participate in Epstein's crimes, saying, quote, "I did nothing illicit. I saw nothing illicit." Gates also reportedly admitted having 2 affairs with Russian women that had nothing to do with Epstein or his victims. And a federal judge today blocked the Trump administration policy that allows rapid deportations of migrants to countries other than their own, saying that not giving them a meaningful opportunity to raise concerns of persecution or torture is unlawful. The judge paused the order from taking effect for 15 days to allow time for an appeal. It's likely to be decided by the Supreme Court. Kel, back to you.
Mackenzie, thanks. Coming up, what the president didn't say at last night's State of the Union and why it might give some investors pause. And as we head to break, check out Cava having its best day ever after strong results and guidance. It's up 25% today. Full year sales crossed $1 billion. Actually, foot traffic fell, but they were able to grow same-store sales thanks to pricing. Don't let the president hear about that. And we're back with more on the State of the Union after this. President Trump delivering the longest State of the Union speech ever last night. But even so, he left a few things out. Eamon Javers is here with those details. Eamon?
Yeah, Kelly, that's right. Despite the nearly 2-hour runtime of the speech last night, a lot of questions today about what didn't make it in to that lengthy address to the nation, including this question of AI. A lot of focus on AI on Wall Street and in financial markets, but we didn't see much at all about AI. The president talked about tech companies paying for their own electricity bills, but nothing about AI itself and its potential to roil the economy. Also, the president talking a little bit about the state of the, talking a little bit about the Supreme Court and their decision last week. The president saying that despite that decision to shut down the bulk of his tariff program, he is going to keep on pushing on tariffs. Here's what he said.
The good news is that almost all countries and corporations want to keep the deal that they already made, right, Scott? Knowing that the legal power that I, as president, have to make a new deal could be far worse for them, and therefore they will continue to work along the same successful path that we had negotiated before the Supreme Court's unfortunate involvement.
So the Supreme Court members, a number of them sitting right in front of the president as he made those remarks last night, not really batting an eyelash to those comments. The president also touting a new potential retirement program for Americans who've been left out of a lot of the matching offers that companies make to their employees. Here's what he said there.
My administration will give these often forgotten American workers, great people, the people that built our country, access to the same type of retirement plan offered to every federal worker. We will match your contribution with up to $1,000 each year as we ensure that all Americans can profit from a rising stock market.
One other item not mentioned yesterday, Kelly, and that is tax cuts. The president had told anchors who had lunch with him earlier in the day that he would talk about a new effort to push for tax cuts through reconciliation up on Capitol Hill this year. That didn't make it into the speech. The White House hasn't responded to questions just yet as to why not and whether that effort is going to be ongoing this year, whether they just dropped it from the speech or they dropped it from the agenda. But some questions swirling around that one too, Kelly. Back over to you.
Indeed. Eamon, thank you very much. Appreciate it. Eamon Javers, as Eamon just said, the president did make some news in that lunch with reporters just before his address where he discussed new tax cuts. But my next guest says he's also about to inject nearly $1 trillion in shock and awe economic policy ahead of the midterms. Dan Clifton is head of policy research at Strategas. Dan, good to see you again. Is this $1 trillion we already know about, or is there new details, new information, new things in here?
Yeah, I thought the president's speech last night, a theme of that speech was we did a lot in 2025, and you're going to start getting the benefits of that in 2026. So, he passed one big, beautiful bill. The income tax rate was not cut. So people are going to get that in a tax refund as they file their taxes here in February, March, and April. And it's really large. It's $150 billion of new tax cuts for American workers that they're going to feel this year. And you have 100% expensing of capital equipment and R&D and property. So you're going to get about $200 billion on the business investment side. I saw the headline coming out of that reporter's lunch about tax cuts. And my view was this isn't going to be income or corporate. They don't have the capacity or the votes to do it. But will the president put out zero capital gains taxes on inflation or zero capital gains taxes on home sales, of which he did neither of those last night and really kind of stuck to the basics? He is not a long laundry list person of policy ideas like Bill Clinton or Barack Obama. And he basically just stuck to kind of his core principles and was basically preparing people for better economic growth this year rather than saying we need to new things.
Yeah, and when he says through reconciliation, what does that, I was trying to think to myself, okay, what does that mean? What is that telling us? And is it what you're saying in terms of the areas where he could move without that broad support?
Correct, right? So budget reconciliation is a way to pass legislation with just Republican-only votes. But right now, the Republicans have a one-seat majority in the House, And if this congressman from Texas resigns anytime soon, given his problems, then you can wind up seeing there'll be more Democrats than Republicans. Now, they wouldn't have the majority and it wouldn't replace the speaker because of technical factors, but they're not passing anything right now. And I'm not very confident of that. So it's going to be smaller measures. They'll do a housing bill that passed the House and the Senate. They'll do an extension of the infrastructure bill. They may do this crypto bill. But the agenda here is not for very large new tax cuts after passing such a big reconciliation bill last year.
Let me ask you then about what you think are the two most significant things last night. Number one, talking about Iran building a missile system to attack the U.S. Secondly, you said the most serious policy proposal was the ratepayer protection pledge. So first on Iran.
Yeah, so I would just say I think a lot of the commentary this morning misses what happened in that speech last night. The president gave you a pretext to be able to attack Iran if those negotiations today don't work out. And that's the idea of building a missile system that could hit the United States. We already know that they're building one to hit Europe. And of course, our allies in the Middle East. But the idea of going to America is a new discussion that they're having, and one that starts to give that pretext. That's number one. Number two, Eamon just came on and said, look, they didn't talk about AI. AI is extremely unpopular right now with voters, and there's a lot of local opposition. What the president was doing was giving you a way around that by saying these tech companies are going to be able to build their own energy and remove that from the ratepayer themselves. So I actually think there was something in there for AI, specifically about building the data centers and trying to get around some of the local opposition. I would note housing stocks are down big today because they were anticipating a plan. Defense stocks are down because they were anticipating a plan. But the banks and the cards are up because there was no talk about credit card caps or interchange fee regulations.
Yeah, I wasn't sure if
there is definitely stuff trading on last night's speech in certain sectors.
I thought housing might be. Lowe's gave this kind of, it wasn't very upbeat about the housing outlook. That stock's down 5%. But you're saying it's more because he didn't come out with a big plan that was going to kind of unleash this wave of building. But that's the stuff that you just said could actually make its way through Congress this year, one of the few areas.
Yeah, manufactured housing. There will be a manufactured housing bill. It's a very specific bill. I think what the president is doing on rates through financial deregulation and what he's doing through the GSEs with the agencies purchasing mortgages are far more important for housing than any State of the Union proposal. Sure. You're seeing the mortgage to treasury spread come in as those agency retained portfolios go up. Nobody's talking about that, and that's one of the reasons why mortgage rates are at their lowest levels in 4 years, and that's where their focus is, rather than on a 10-point housing plan, which the market was anticipating. One of the reasons why the housing
I'm turning you into like a stock picker today, Dan, but there's one more sector that I do want to ask about, and maybe this is going too far, but financials, you bring this up and say one of the most important things that's going to happen is trying to bring down that mortgage rate, bring down rates, and we keep hearing that the big priority at the Fed is going to be financial deregulation. So did the stocks just buy the rumor, sell the fact? Because the financials have now been trading very, very poorly. Maybe it's AI. I don't know if you have an additional thought about that.
I do. I don't think that the bank stocks are related to financial deregulation. The bank stocks are trading on the yield curve. The yield curve is flattening. That's not good for bank stocks. Now, at times, you'll separate from that based on what Trump is proposing. And, if you're going to cap credit cards, you'll see bank stocks even weaker on that. But I don't think it's about buying the bank stocks. I think it's about being able to get rates lower and what that's going to mean for the U.S. economy and the ability of Treasury to be able to finance our deficit. I like to call it like privatizing the Fed balance sheet and being able to start taking some of the burden off the Fed if you do that financial deregulation. So the benefits are going to be more macro and less about buying the banks themselves from this financial deregulation.
Even more, if you're right, that one of the few things they're going to really focus on is bringing down the long end of the curve. That's a curve flattener trade that will be, bad for the financial. So thank you. That's the answer. Next category, I guess, for next time. Dan, thanks. Really appreciate it today. Thanks for your time.
Great
Dan Clifton with Strategas reacting to the State of the Union. As he said, has a lot of stocks on the move today. Coming up, Anthropic might be taking a do as I say, not as I do approach when it comes to security, making its internal safety framework non-binding while drawing a hard line with the Pentagon. We have all those details next. we've got a showdown between the Pentagon and Anthropic. Defense Secretary Pete Hegseth reportedly giving the company until Friday to strip safety guardrails from its AI model or risk losing its defense contracts. Deirdre Bosa brings us the very latest in today's Tech Check. Deirdre?
Hey, Kelly. So on the surface of this Pentagon fight, Anthropic is the principled company standing up to the most powerful institution on the planet over autonomous weapons and mass surveillance. Those are legitimate concerns. But simultaneously, Anthropic has also scrapped the core safety pledge that the company was founded on. It is replacing hard safety commitments with what it calls non-binding, publicly declared targets because otherwise, they say, competitors could race ahead. And in that sense, Anthropic's safety rhetoric could look more like branding and leverage, less like principle. Now, fighting with the Pentagon is also very good marketing. A defense official telling Axios that they need Anthropic, and the problem for these guys is they are that good. Every enterprise CEO or CTO reading that takes away a few things. One, the U.S. military thinks Claude is the best model in the world. Two, Anthropic cares so much about safety, it'll walk away from a $200 million contract. Now, Kelly, we will see what happens on Friday, but the bigger story that investors should be paying attention to is what's already happening. The one company that was supposed to be different, serious about safety, told us it can't afford to be. And if that's true, the AI race just got faster. And for every company in the path of this technology, the disruption is only likely to accelerate from here.
So there were several companies that received this contract from the Pentagon, but Anthropic was the only one that gave conditions attached with that. And now the Pentagon is pressuring them to drop those conditions. Is that right?
I mean, the Pentagon says that they're just working with Claude Code, right? With Claude at this moment. I think Grok has got approval, but it's not integrated yet. So this also says a lot about the product that Anthropic is offering. It is the one that the Defense Department wants to work with, but it comes with guardrails. So it's interesting to see it in this light. Also, be interesting to see what Anthropic does, right? Because if they give this up, yes, it's very possible that OpenAI or another AI lab could get in there. And, you know, Anthropic would probably argue that they may not have as much of an eye on safety, but we should take that with a grain of salt because that's changing over at Anthropic as well.
Okay, so we've got a day or so, a couple days to see how this one evolves. Deirdre, for now, thanks. Appreciate it. Deirdre Bosa. Coming up, the SMH Chips ETF higher again ahead of NVIDIA's earnings today. The memory and design names are leading this time. Amat, Micron, KLA are all among the top performers. We'll dig into what the options market is telling us ahead of those results when we come right back. And as we head to break, take a look at Diageo, another alcohol name getting hit after its result. It's down 15% for its second worst day on record after cutting its dividend and lowering its guidance, citing ongoing weakness in North America. Remember, Boston Beer's guidance came in light as well. Bank of America is now downgrading Molson Coors to sell to reflect the risk of another potential year of mid-single-digit declines in the U.S. beer category. Another tough day for all of these names. We'll be right back. NVIDIA options are pricing in a 5% move either direction after results this afternoon. It's actually the smallest expected swing in 3 years. They're maturing, after all. Here to discuss is Chris Murphy. He's the co-head of derivative strategy at Susquehanna. I don't know, Chris, what do you want to talk about? You want to talk about are they going to be, are they the mood setter? They're the last of the Mag 7 to report. The Mag 7 have already spoiled the mood. I don't know.
Well, hey, Kelly. I think, to your point about the smaller move than the last couple of years, it's just because of the broader market low correlation setup. When NVIDIA was posting 15, 20% moves higher on earnings, that was when everyone thought AI was just generally helping everything. Now we have a situation where AI is mixed. Is it positive for stocks? Is it negative for stocks? We don't really know. So at the end of the day, NVIDIA used to not just be a blockbuster move for the semiconductor space, but it was a blockbuster event for the broader stock market in general. And that's just not the case anymore. And, it is maturing as a company. It's moving 2, 3, 4% on earnings. There's 90 plus analysts that are heavily scrutinizing the stock going in. So there's not really as many surprises as there used to be.
I miss the good old days, when they'd come in and raise their revenue by $10 billion or something. It's just a staggering amount. Who's the new NVIDIA for the market?
Well, there's the memory stocks, the memory area of the market. You even have, I would look at South Korean stock market.
Yeah.
And it's just been going parabolically higher. We've actually been seeing put buying very consistently in the EWY near-term stuff. We're curious if there's less, if NVIDIA makes a comment about maybe less of a memory shortage, could that be negative for some of the biggest companies in Korea? So that's one area to look. But really, the new NVIDIA is the other 493. We're seeing lots more action in a lot of the other sectors, from energy to staples, and tech's taking a little bit of a back burner.
What do you make of this reversal in Workday?
I'm not looking at Workday today. I don't know. If there's not a big options trade or two that's going on this week, it's not on my radar. There's just too many stocks.
Right, exactly. No, and I love that. Like you said, it's the rise of the other 493. And I guess the last thing that I would ask you then is, what does this tell us about the market broadly and the market leadership? The reason we cared so much about NVIDIA in the past is because it was carrying the market, and now everyone else is happy to bear the load.
It's a stock picker's market. It's great for your television show. It's great for our clients who are picking stocks. I mean, you have something like the staples sector that goes up every day. The price earnings there is higher than the tech sector. It's a much slower growing area. So then we have on the option side very consistent bearish flow in that staples sector. So you're having showdowns and you're having controversy in other sectors that you didn't normally see. So
I love it. You can't keep the staples down. Who would have thought that would be the mantra? Chris, thanks. Appreciate it. Chris Murphy of Susquehanna. And that's it for The Exchange. Brian Sullivan and Power Lunch are right after the break.
Happy NVIDIA earnings day, maybe the most important day of the year so far for your tech investments. Welcome to Power Lunch, everybody. Alongside Kelly, I am Brian. More on the trade ahead of those numbers, plus tech CEOs heading to the White House with President Trump saying big tech will pay more for power. But isn't that already happening? We'll ask the CEO of a red-hot data center stock what's really going on.
Look forward to that. Plus, the call that is powering Oracle higher today. The shares are up almost 3% after they've been cut in half. One Wall Street analyst says it's too cheap to ignore. He's upgrading it to buy ahead of earnings. The analyst behind that move is coming up.
All right, we are going to start with the big earnings report that is on deck tonight. That is NVIDIA. You may be asking, why do they talk so much about NVIDIA on CNBC? Here's why. It is not only the most valuable company in the world, it's also about 8% of the entire S&P 500. It's about 9% of the widely traded QQQ ETF, and it's a top holding in hundreds of major ETFs outside of that. The bottom line, NVIDIA can move the entire market. It can certainly move your money, but here's the rub, and don't tell anybody else this, but NVIDIA has not really been a big earnings mover lately. In fact, the last few quarters, it's kind of been on hold, all as its sales growth slows down. But does that mean it is time for you to sell your NVIDIA? Your first guest today says, no way. It is one of her biggest positions. Joining us now to talk about it and more, Joanne Feeney, partner and portfolio manager at Advisors Capital Management. Joanne, good to see you. Is it time to sell NVIDIA?
Not in our opinion, Brian. You know, we continue to see NVIDIA at the center of this very strong demand for AI compute. They obviously have the most powerful, most efficient chips, and making the efficiency greater and greater is going to be pretty important, particularly because of the cost of powering these systems. And we expect to hear some, solid information tonight about how they're ramping Blackwell, how Rubin is around the corner. The question really is how much of those memory price increases impacting their margins, because they do build systems that include memory.
I'm glad you brought that up, Joanne, because we were just talking to Chris Murphy about this a few moments ago as well. And in many ways, the trades that hang on NVIDIA's results are probably a lot of these memory names, where if NVIDIA says it's not that bad or it's getting better, those whole names might sell off. But if they say, no, it's impacting margins, and yeah, it's still tough out there, well, then NVIDIA suffers.
Well, you're right. Both things may very well happen. But do remember that we understand on the memory side that the demand is going to be very strong. And we know that they can't ramp up supply very quickly. So it's likely to be the case, as we've been hearing, that memory price pressure will continue. Even so, we do see continued strength in demand to add compute capacity and build new data centers and fill them with NVIDIA chips and AMD chips and Broadcom-derived chips as well. So a lot of demand out there, and it just looks like we have years of this ahead of us. So 70% growth for NVIDIA is what we're expecting for this quarter, year over year and next. And we just see that demand-supply imbalance continuing for a while.
I love how you dropped the Avago, the old reference to the Broadcom ticker. That's why, by the way, it's AVGO. We know, all that stuff you said is accurate, obviously, Joanne, with all the build out, the data centers and the spending. But does that mean the stocks are still a good value for Advisors Capital Management and your clients? Because both things can be true. All that growth can be happening, but at the same time, those stocks can be viewed as overvalued by some.
Yeah, Brian, it's a really good point you bring up. Always positions inside portfolios depend on the nature of the clients. We have several strategies at Advisors Capital, from higher yield, income-oriented strategies in balance, and all the way to growth and SMID. So our position size for NVIDIA is going to differ across the strategies, right? Growth is going to be the highest exposure to NVIDIA, but in a balanced strategy such as the one looking to add diversification in a really important way, whether it's industrials, whether it's higher dividend yielding financial companies or energy companies, it's really important for the client to be in the right kind of portfolio. We do see NVIDIA as an important driver of the growth aspects of various portfolios going forward, but that's not the only one. In fact, we're overweight Broadcom in many of our strategies, because we see it as not only being able to feed into this data center opportunity, but because they're diversified, they do a lot of other things. and they've shown themselves to be very smart acquirers of companies and managers of capital for investors.
What's the biggest risk then? Is it that something goes wrong? There's, an OpenAI, an Anthropic. We get some, I don't want to say bad news, but not as bullish news as it should be. There has to be, with everything, there is a risk. What is that risk right now?
Absolutely, Brian. I mean, I think the biggest risk is any slowdown in the adoption rate, right? NVIDIA, 70% growth this quarter and next quarter is what's anticipated in their top line. Is there a time at which investors, fail to anticipate that growth is going to slow down? Right now, it is in the forecast. People recognize that growth is going to slow, and that should be true for a lot of other companies in the space. So really, I think the risk is on the fundamental side in terms of the path of growth. There may very well be times when, power generation constrains the growth of the build out of these data centers, right? We know that's an issue. So far, it hasn't been much of a gate to the build out because chips have been the gating supply problem. But I think it's that growth eventually does slow down, and investors need to be positioned for that. Again, that's why you don't want to be overexposed to these names. You want to recognize that's where most of the growth in the U.S. economy has been coming from for the last year or so. So it's good to have exposure there, but consumer stocks also give investors a real opportunity. TJ Maxx, for example, is something we've held for clients for many years. They reported this morning.
Right.
They do well even if there's a bad economy because they get more inventory, they get more foot traffic, et cetera. So diversification is really critical, especially at a time when there is that kind of growth risk on the AI trade.
Yeah, just quickly on IBM, their UBS upgraded the stock from sell to neutral today, a more balanced risk-reward proposition after sell-off this week. So would you generally view these AI-induced sell-offs as buying opportunities then, IBM being a case in point?
Yeah, certainly could be. Obviously, look, there's a lot of concern out there about how much AI-generated coding can undermine the pricing power or even the business models of some software companies. IBM, the latest one to get hit, obviously their COBOL languages, which I learned back in college, is something that is old and hard to work with. And so anything that AI can do to improve that is going to be a good thing. But why don't people recognize that IBM is likely to adopt these tools and be able to reduce their labor costs by making it easier to do these upgrades? And the same thing holds, I think, for other software companies. They're likely best positioned to adopt AI via coding to make their own business models more efficient. But that doesn't mean that investors are going to recognize this anytime soon. They're going to be show me stories. People are going to have to wait and see. Their retention rates remain high. They're going to wait and see how much bookings they actually do. So I'm not here to call the bottom on software stocks, but I do think that the patient investor, and we're long-term holders for clients, can be looking around and making sure that they're not running away from names, after they've gone down so
Quickly,
much.
Joanne, because you do, I believe, own Blackstone. Do you have a thought on what's going on in the less transparent software areas, private credit, private equity?
Yeah, so we do own Blackstone for clients in some of our strategies. We recognize the headwinds that it has faced. Obviously, the auto-related companies that had difficulties last year gave some folks concern that accounting irregularities could be occurring in private equity holdings. But when you look at Blackstone, they had no exposure to those companies, but it nevertheless caused the stock to go down. They have 7% exposure to software, yet concerns about software valuations, I think, again, caused that stock to go down. So it seems to us that given the amount of cash they have on hand, the fundraising they've done recently, that they have a lot of dry powder to take advantage of any disruptions in the market. So we continue to like Blackstone, and view them also as one where the market is undervaluing them relative to their intrinsic value.
All right, sticking with it. Joanne, thanks for joining us today. Run through a lot of this. We appreciate it. Joanne Feeney with Advisors Capital. Meantime, let's turn our attention to the bond markets where the 10-year's around 404, around its lowest levels of the year, even though that 5-year auction last hour, Rick Santelli, what grade did you give it? And that wasn't a very good one. Welcome.
No, yesterday's 2-year was a C+. Today's 5-year, 70 billion was a C-, a bit below average, and it really does underscore that we're seeing kind of middling demand, and these are short maturities. They should find a wider, more interested audience, and the reason they're not, of course, is probably because there's so much going on with respect to what the Fed may or may not do and how that'll affect two-year note yields, closest maturity that really reflects Fed activity down the road. As you see on the 6-hour chart, right at 1 Eastern, when the results came out, we did see an uptick in yields on the far right of that chart. Now, if you look at 2s and 10s together, Kelly's exactly right. You know, we're doing most of the work in 2s, kind of above yesterday's range, not all of it. In 10s, we're doing all the work above yesterday's range. Today's low, well, it's basically around 4.02. Yesterday's low was 4.02. We've had several intraday lows of 4.01. But one thing we do not have any closes below 4% for this year. And as you look at a year-to-date chart, the last time we did have those, and I say this almost every session, was the 25th and 26th of November. It seems like 4% just repels 10-year note yields. And finally, the dollar-yen, okay? It is making progress. It's moving up. The dollar gaining on the yen. That's a year-to-date chart. We're almost back to unchanged. Now, do remember, the dollar index is only 13.6% of the yen. So even though the dollar index is down a bit, the dollar is improving against the yen. Kelly, back to you.
Thank you, Rick, very much. Rick Santelli. Coming up, reading Oracle's future. We have the analyst behind the upgrade of the day. The shares are on the move after a tough stretch, and we're back with more after this. Oracle getting some love on the street today after erasing half its value since that record closed back in September. Oppenheimer upgrading the stock to outperform. They say the pullback has created a compelling risk-reward opportunity for investors willing to step in. The shares are up 2.5% today. Joining us now is Oppenheimer's Brian Schwartz. He's the analyst behind that call. Puts a 185 price target on Oracle, and they're around 140 today. Good to see you. So talk a little bit about, Brian, why you think not just market perform, but outperform.
Yeah, thank you, Kelly, for having me on your show. You know, among this AI panic that's happening in the software industry, we're really looking for three traits to try to find winners in the future. You know, one, does the business have a defensible moat? Is there a place for them in the agentic AI future? Number two, can they drive strong organic growth? And number three, the valuation, the pricing. With Oracle, we see all three of those characteristics. And if I can build upon my answer, you know, there's an opportunity here with Oracle to invest in a generational EPS compounder who is an AI winner. So we have tried to de-risk our model. We have cut management's guidance by 25% in our base case, and we still have Oracle's EPS doubling over the next 4 years. Our investor conversations, they seem to be discounting around 10% the guidance. When you do that, you have Oracle's earnings power tripling over the next 4 years. So opportunity to own a generational EPS compounder. And then along with that, three other quick criteria. The risk profile seems to be starting to mitigate a little bit with Oracle, specifically their counterparty risk with OpenAI, who's a large contributor of their backlog. We're seeing very strong momentum from OpenAI's disclosures. We're learning about their capital financing plans to fund their operations. Oracle itself is planning to raise nearly $50 billion in capital. That should fund its operations over the next 12, 18 months.
Well, Brian, how much of Oracle investors' recent pain has been because of OpenAI? It is a private company. It is a bit of a black box. We only know what they choose to tell us. So the market is kind of a sell first, ask questions later type move right now. How much would you like to see, if at all, OpenAI open up a little bit more?
Myself, Brian, as well as every software investor in the world would love to see OpenAI open up their disclosures, because not only could it give credence to the backlog of these large software companies that OpenAI can deliver on, but it would open up the strategy from OpenAI. It would tell us which applications, which workflows are they targeting to automate. That could provide clarity to the entire software industry on which moats, which businesses are going to be defensive. So, you know, an OpenAI IPO would be very welcome news among the investment community.
Oh, don't get me started. I would like the IPO of everything. Brian, this is my thing lately.
This is your thing?
This is my new thing.
This is our thing.
I'm frustrated that we keep seeing all these IPOs being pulled. The recent ones haven't done well, so that makes no one else want to do them. Then you've got Stripe at 165 billion private. You've got Databricks, it's private. And Brian, to your point, there is a lot of value, public value in these companies going public. And I know it's a pain for them. I sympathize. I understand. I wouldn't want us talking about them all day long and tearing apart their financials. Like, I get why you'd want to stay private, but I would just love to see more of them going public earlier on. Give us better competition, better information, better transparency, higher quality of companies to pick from, especially when all of our retirements depend on the performance, basically, of the S&P 500.
It's a great point, Kelly. And I think what you're defining is really the growth of the alternative assets, the private market. We've seen that expand greatly over the last decade and a half. So there are funding sources for these private companies to stay private longer. The case I would make for a company going public is, number one, it makes you a better company because the spotlight is on you. You've got to report your financials. Everyone is analyzing you. It's number one. Number two, it gives you currency. You suddenly have stock to be able to engage in M&A activities. And number three, it's a method also of rewarding your employees when you're giving them stock options that they can actually cash in for liquidity.
Well, from your lips to their ears, okay? The two Bryans and me, we'll start this campaign together. How about that?
I'm all for it, Kelly.
Brian, thanks very much. Brian Schwartz.
Yeah, listen, I mean, not saying something will go wrong, but if something were to go wrong at an Anthropic, at an OpenAI, one of these huge private companies that is controlling hundreds of billions in spending.
You're absolutely right that they are the data points that will have more to do with how the public markets trade than almost anything else right now.
Bingo.
Absolutely right.
All right, coming up, some good news, maybe, as mortgage rates do something they have not done in about 4 years.
In municipal bonds that will fund roads and bridges? Think of Assured Guaranty's bond insurance as your guardrail. Assured Guaranty, a stronger bond.
Is this your dream of retirement? How about this sweet deal? I like fishing. Or is this a little more your style? Retiring well isn't a guarantee, it's a goal. It's easy when markets are going up. But what about when they're not? That's why you need this.
Call for Fisher's Retirement Survival Kit, featuring your guide to surviving market volatility, our stock market outlook, plus the Fisher Investments Difference. 3 indispensable guides, yours free for calling 1-800-213-5317.
Fisher Investments' disciplined approach will help see you through the market's ups and downs and give you the confidence you need to reach a comfortable retirement. And our fees are structured so we do better when our clients do better.
Call now for your free retirement survival kit. 1-800-213-5317.
See if your dream retirement is on track.
If your portfolio is $1 million or more, call Fisher today. Call 1-800-213-5317.
When I started Walton Goggins Goggle Glasses, I didn't know how to turn all this fancy prettiness into a classy-looking logo. But GoDaddy Aero does, with its magical AI powers. It not only creates it, it slaps that sweet thing everywhere.
From 1838 to 1908, the United States Mint struck one of the most enduring gold coins in American history, the Gold Liberty. These coins circulated through the Wild West, the Gilded Age, and the dawn of the 20th century. And now, for a limited time, you can own them by the pound. That's right, you can secure a full pound of U.S. government-issued Gold Liberty coins. Each coin is an original piece of history struck in various sizes, all in collector condition with clearly visible dates and mint marks, guaranteed. Call 1-888-517-8568 now to secure your full pound of historic U.S. Gold Liberties struck between 1838 to 1908 during America's age of expansion, innovation, and progress. Plus, with every order, you'll receive a bonus American Collector's Pack valued at over $230 free. Don't wait. Quantities are limited. Call 1-888-517-8568 now to claim your full pound of Gold Liberties before they're gone. That's 1-888-517-8568.
Get invested. Join the club.
Jim teaches you how to be the best steward of your own money.
I truly believe that he cares about the club. It's worth every penny.
New members save with a special offer. Go to cnbc.com/joinjim. Terms and restrictions apply.
Mortgage rates are down at their lowest level in 4 years, and normally that would mean a little bit of an uptick in home buying, but it hasn't. In fact, Google trend searches for the phrase "can't sell house" are at their highest levels ever, going back to 2004. CNBC senior real estate correspondent Diana Olick is here to help make sense of what's going on, Diana, as the stocks are really frustrated today.
Yeah, and it's a lot to unpack, Kelly. Look, mortgage rates, it's all relative. Yes, yesterday they hit 5.99%, which matches the lowest level since 2022. They did bump up 1 basis point today. We're at an even 6%. But rates have really been hovering between 6 and 6.25%. And for home buyers out there, it's just not an incentive to get into a market where they are concerned about the economy, where home prices are still high, and where there's not a lot of great supply on the market to see either. So we did see mortgage applications to buy a home last week actually dropped 5%, even while mortgage rates were coming down. Refis, great demand for that, but that's because mortgage rates were a lot higher a year ago, almost a full percentage point. So you would think that buyers would want to get in more on that. But it's just, it's a troubled market right now. And the home builder stocks, if you want the answers on that, that has more to do with what the president did not say last night. Builders were expecting him to have a very clear plan to say much more about housing affordability and how to get home buyers back in the market. And the only thing he really hit on was getting investors out of the single family rental market. So there was some disappointment around that.
Well, we're looking at the home building stocks, Diana. Mortgage rates are at 4-year lows, but these stocks are all down across the board. What's going on?
Yeah, well, as I said, it's really about what the president did not say yesterday in the State of the Union. Builders have been meeting with the Trump administration for many months now, trying to get, something on either easing land regulations or maybe some tax incentives, and they were expecting to hear something in the State of the Union. They were also expecting to hear something at Davos and didn't hear anything from that either. We also did get earnings from some smaller builders, K. Hovnanian and TriPoint, and they were a bit disappointing. And then we had that Home Depot earnings talking about a weaker consumer. So that's all weighing on the stocks. And, yes, mortgage rates are lower, but as I said, they've still been in this very narrow range for several months.
Diana, it's interesting. Mortgage rates going down. Yay. Stocks are going down. Not a yay, but we'll see if house sales actually go up. Diana, look, thank you very much.
Sure.
All right. On deck, from providing your own juice for data centers to Anthropic and Google's latest twists and turns, what does one of the heads of one of the hottest power company stocks think about it all? We're going to ask him, and you'll hear it next. The growing pushback on data centers continues. The fear is that the demand for power will add even more to your already rising home electric bill. And as you've probably seen at home, your electric rates have been going up for years. Data centers lately have been increasing the load in many areas. It is a big topic. It's such a big topic that the president hit it in last night's State of the Union. Here's what he said about making sure tech companies don't just jack up your electric rates.
We're telling the major tech companies that they have the obligation to provide for their own power needs. They can build their own power plants as part of their factory so that no one's prices will go up. And in many cases, prices of electricity will go down for the community, and very substantially down.
But as we have reported for months, this is really not a new development. Companies have been pressed for, or are pressing for, having their own power and not competing with residential rates. Let's talk more about it with energy infrastructure company Hut 8. Stock soared on Tuesday ahead of posting its results last night. The numbers came in as a bit of a surprise to some. Hut 8 posted a net loss of just over $300 million. That against net income of $152 million in the same quarter of last year. But one big reason for that change is that Hut 8 continues to build out more electricity capacity, and as you know, that is expensive. So what to make of the quarter, the president's comments, and the latest with customers like Anthropic and Google? Let's ask the CEO. Asher Ganoot is back with us for an exclusive interview. It's the perfect time, Asher. Welcome back. Before we get into sort of your company-specific details, on March 4th, a bunch of companies, we're going to show them here on the wall, are going to the White House to sign what they call a ratepayer protection pledge, basically an agreement to not raise residential electricity rates. Want to know, are you going to that meeting? And if so, or if not, does this announcement, this pledge, impact your business at all?
I'm not going, but the pledge is for the right reasons. Data centers should bring pricing of electricity down, not up. They should increase economic development and the taxes that people receive to invest in school districts. It should create more jobs. And so when we think about building data centers, it's a net positive impact that you bring to communities. And we've already been doing this for the last 1 to 2 years as we discuss energy rates, as we discuss who's paying for the generation, the transmission upgrades. And so we should have all developers focus on creating a net positive impact to the communities that they build, so the US can stay at the head of the race of AI development. If we don't build data centers to support AI advancement, we will be falling behind on other countries, and that's key.
And we talked about this. You and I talked about it. I spoke about it with other CEOs at the Edison Electrical Institute Utilities Conference in Florida in early January. And you look at like Loudoun County, Virginia. Loudoun County is the capital of data centers, and yet Loudoun County's electricity rates have actually gone down last few years because these companies are paying so much into the system. Is this pledge as you know it? I'm kind of putting you on the spot here, Asher. I know it's okay to say you don't know, because I don't know. It's just a pledge or like a commitment? You know what I mean? I can pledge I'm going to go running every day, but what if I don't?
Most of the utilities we're working with across the country are already focusing on how do we make sure that we are funding the energy needs that we have. And so this is ongoing. And I think being able to solidify this across every single development of data centers in the US will take away the friction in developing these assets that are critical to the national security of our country, and will be able to make sure that communities are able to have a positive impact on their energy and receive the revenues and the job creations that data centers bring to them. And so I think this is part of, I've heard from a lot of energy utilities that bringing on data center infrastructure, as long as data centers are paying for those upgrades, is net positive to the overall energy bill for retailers. I think the big impact is recently energy prices going up. A lot of that is because of heating resources. I mean, you have massive winter storms going across the country. People are using more heating and air conditioning within their homes, and that drives pricing up as much as the data center large scale demand does, because we're paying for the transmission upgrades. Like our Riverbend campus we announced, we're paying for the transmission upgrades there. We're looking at building a gigawatt of net new generation, and we'll be putting up the collateral and making sure that the commitments we are backstopping, so customers never have to take the impacts of that, and we're able to support everything.
We got a humdinger of a bill last month, I can tell you for sure. And it's, you know, we had the energy transition, which then led to a scramble for, you know, more energy, because it was like, well, wait a minute, who knows about the transition, but we definitely need the energy now, and we have the AI boom on top of that, Asher. I was struck by our conversation with Dan Clifton last hour, who said, I think it was him who said, AI is not, the reason the president didn't talk about AI last night, because AI is not popular. People might use it, they might like their ChatGPT or whatever, but AI, and look at the piece that was making the rounds all weekend long. It's all about Occupy Silicon Valley, right? This idea that there's going to be so much backlash. So what do you seriously do about that? How do you actually make sure the companies are paying their own way?
AI is the new evolution of what the internet is. Everybody works on the internet today. Everyone relies on it in terms of the day-to-day life. We're very, very early on in AI. It's like the dial-up generation when we're just using a chatbot right now. And so as we think about AI and its impacts into the day-to-day life, that will only increase and compound at a rapid rate over time. And when people are starting to see the impacts of these data centers, the jobs that they create, how they're driving energy bills down, how they're creating net new generation, I think you'll see those stories playing out. And in the areas that we're building, like our Riverbend site in Louisiana, we're making a massive positive impact to West Feliciana Parish in terms of taxable revenues we can drive to the county, in terms of everything we're building. We have gigawatts of sites that we're developing across the US now that take that same development model to be able to scale, make sure we have a net positive impact on the communities that we build, and we're able to support this industry and the technologies that it can create with it.
Yeah, and the connections queue, basically the line to get permitting and just the line to get lines, power lines, for lack of a better term, Asher. Some places was 1 year, then it was 2 years. Now it can be up to 4 or 5 years. Depends on the area, of course, depends on the state and all that other stuff. But how is that bottleneck that we've talked about so much, that bottleneck in getting this part done, still impacting your business? And how much, Asher, does come down to just things like being able to get the electricians or the concrete to build out the physical structure?
Hut 8 is positioned to scale and to execute and take advantage of this opportunity. We are really great at power, and we understand the complexities of power, and so we're able to navigate through these environments where many other developers aren't. In terms of the actual talent and labor, Jacobs is a large partner of ours, and they have over 40,000 people worldwide, and they've committed to being a partner of ours and actually being able to have the electricians and the mechanics and being able to bring that talent to develop these data centers. The deal that we announced with Anthropic and Google and FluidStack, that $7 billion deal, we think is just the first domino to fall on our multi-gigawatt pipeline that we're excited to scale. And this complexity is an opportunity for us to show our differentiated moat.
Is it getting better? Are you noticing, but so much talk about it, speeding up the permitting process, getting this stuff done. But have you noticed, as the CEO of a company that does this for a living, have you noticed anything getting better?
It depends on where you are.
Okay.
There are some states and some communities that they're very supportive, and you're able to scale and grow quickly to meet the demands. In other areas, people are nervous. They want to know what this impact really means, and they want to understand what these large investments actually do to their lives. And so I think the more protection there is, because it's already happening. When we develop assets, we are making sure we're paying for the power generation, the transmission upgrades that are needed. We're paying for the labor that's going into the environment, the taxes that we pay in different jurisdictions. And so you're going to see more clarity that's wanted. And I think that clarity is good because it allows the development of these projects to move much faster.
All right, Asher, appreciate you joining us today. And again, a hugely strong performance by the stock. We heard about it yesterday from James Chuckmuck as well, a fan of it. Asher Janut, the CEO of Hut 8. We checked on the solar stock run up last week. Different story today for one of the biggest names in the space, one of the U.S. ones. First Solar shares down 15% after a lackluster earnings report. They missed on the bottom line, and their full year guidance was well below what the street was looking for. A few downgrades this morning. You can see the stock reacting accordingly. Brian, this would be its worst day since June.
Yeah, still's been a red hot stock. Stock's done very, very well. So maybe they would say price to perfection. But either way, yeah, not a great day today.
Yep.
But it's been a pretty good run for First Solar.
We still need all hands on deck, I think, when it comes to energy provision. And let's get to Kate Rogers now for the CNBC News Update. Hi, Kate.
Hi, Kelly. Democratic Senator Maria Cantwell is urging the House to take on a new vote on aviation safety bill, which fell short yesterday by one vote after the Pentagon withdrew support. Collisions. It was introduced after the January 2025 crash between an Army helicopter and American Airlines plane that killed 67 people. A top official in the Treasury Department will reportedly step down after challenging the Trump administration's plans to crack down on alleged fraud in Minnesota. According to the Washington Post, John Hurley conveyed concerns to Secretary Scott Bessent about a plan to enhance federal monitoring of international payments. In a statement to the Post, Hurley denied the reporting. And FBI agents raided the headquarters of the Los Angeles School District and the home of its superintendent today. The agency confirmed it was executing search warrants, but did not comment on the investigation. The district is the nation's second largest. Kelly, back over to you.
All right, Kate, thank you. There's always a lot of uncertainty in the oil markets, but even so, more so right now with the heightened tensions between the U.S. and Iran. Our next guest says he has a safer way to play the space. Stay with us for Market Navigator.
Welcome back to Power Lunch. I'm Dominic Chu with your Market Navigator. With the State of the Union now in the books, what can investors take away from the current state of the markets? Our next guest believes with geopolitical concerns, global tensions percolating, energy is a good place to focus your portfolio. So joining us now for the case is Matt Powers, the managing partner over at Powers Advisory Group. Now, Matt, you heard a lot of stuff coming out of the president from the State of the Union. Did anything catch your attention as to driving why you think that energy trade is going to be key in the coming weeks and months?
Yeah, Dom, good to see you. Thanks for having me. I mean, there's always geopolitical and global risks in the market, but right now they're certainly elevated. You know, at the moment, there's a lot layered into this market. We've got trade, tariff confusion. You've got the Middle East tension with Iran, like we just mentioned. You know, there's plenty more. And hovering over all this is AI valuation concerns. So it's not just one thing, it's everything happening at once. And when you've got so much in the air, boring works. We already started to see that at the beginning of this year as we kick off 2026 with energy and staples leading. But our view is simple. In this geopolitical climate, stay invested, reduce volatility, take a defensive posture and get paid to wait through here just a little bit. And, this is not the time to play offense. But we're focused on energy, defense contractors, and staples, and I do think energy is key right now.
Where exactly do you think the trade is within that energy complex overall? Is it in the ETFs that track the fuels and oil and gas themselves, or is it around the companies and stocks that go along in that ecosystem?
Yeah, I mean, energy's quietly become the best trade in the market. It's up around 23% this year, and I don't think that was on anyone's bingo card to start the year. The Middle East is back in focus again with Iran, and we just had Venezuela. So geopolitical volatility is here, and anytime that happens, oil carries a risk premium, and energy has one of the lowest correlations to the broader market. So yeah, the two that I'll talk about are touching all-time highs. Valuations on them both have moved up quite a bit, but I think we're starting to reprice the idea that oil might be around and profitable longer than most thought, and we still see a runway here. So that's why we like the two majors. So Exxon and Chevron, they're obvious names in this space for a reason. Great balance sheets, global scale, reliable dividends. They're basically cash machines. So they do well when oil holds in at healthy levels. They don't need a massive spike to outperform, but a sharp move higher would certainly add to the upside. So just a quick line on each. Exxon's fully integrated. Upstream, refining chemicals, it gives them the ability to consistently generate enormous free cash flow, and even in a flat pricing environment. I don't want to say this is a place to hide, but it's your core holding. Chevron, similar in quality, maybe even more conservative, but arguably the cleanest balance sheet in the space. So with both, you've got a nice mix of domestic and global assets, and with a solid dividend while you hold.
All right, perfect. Matt Powers, thank you very much for the trade there on both Exxon and Chevron. We'll see you again soon. Back to you, Brian.
Appreciate it. Thanks.
Actually, Dom, come on over here if you can, because we're getting a lot of questions from everyone who's trying to access, in some cases, metals pricing, natural gas pricing. And for the last couple of hours now, there have been these, it's unclear exactly what's happening.
Technical issues, for sure.
Technical issues. What can you tell us?
So what we can tell you right now is that both Nat Gas and Globex metals futures have now resumed trading, I think, as of just a couple minutes ago right now. Nat Gas earlier on this last hour, and then now for metals, they are still trying to figure out what exactly were those kind of technical issues that led to the halts in trading. But the big deal right now
Look
is
at that gold chart.
Things are yes.
Yeah, it's not actually flat. It just didn't trade.
They just didn't trade.
Yeah.
The important thing, if you're a trader in Nat Gas and in these metals using CME platform products, is that all of the orders that you had in there that were either good for the day, right? Good
GTD.
for the day, right? Or good till a date, which is, some specified expiration date down the line. Those orders are now canceled. So if you want to trade in them and with orders in place, you have to go in there and re-enter those orders. It does not affect those orders that traders place that are GTC or good till canceled. If they have been acknowledged as good till canceled, those orders, CME says, are still in effect.
So let's go back. It's a big story. And a lot of people have been pinging us, and we appreciate everybody staying focused. Metals, gas contracts at the CME. I know the NYMEX has some of these contracts too. We're talking about Chicago. We don't know if it's a CME issue or maybe it's a Chicago issue. Right?
We don't know. We don't exactly.
We don't know what happened.
They're still trying to do a postmortem on what's happening right now. They have not updated us yet on what exactly was the or cause or outcome of it. We do know, remember, it was not that long ago where there was a data center issue with the CME that caused a little bit of the issue that they had with regard to technical operations with the CME. Data center related. We do not know what that is right now. I'm sure that the folks at CME, we are in touch with them, not yet telling us exactly what's going on, but we will, of course, bring you those details as the CME knows those details and then makes them clear to us.
But if you had an order that was very short term, good for the day,
right?
Those are canceled. If you put those in, those are gone. So if you think, folks, that you've made a contract or a trade for a very short-term amount for today, you probably did not. It's on their website right now.
Correct.
But if it's good till canceled, like I'm going to put in a longer-term order and I'm going to ride it out unless it hits or I cancel it. Those are still in force, correct?
Those are if those orders, GTC good till cancel, have been acknowledged, then they are still in play. But if you had a good for the day only or good till a certain date down the line, those orders, CME says, are now canceled.
Any truth to the rumor that these contracts are going to move to Northwest Indiana to look for a new stadium? Sorry,
no,
wrong issue.
That's a sports thing.
Sorry,
you crossed the Bears and everything.
I got hit in the head the other day. Easily confused.
There you go. So am I.
But look, at a moment when there's been so much interest in these very contracts, you know, this is a year in which this is where all the activity is.
And all the attention, for sure.
Absolutely.
Well, is there another data center issue? We were just talking
Did
about.
someone unleash Claude on their systems? And it, when have you seen the reports making their rounds? They say Claude destroyed my whole infrastructure.
So is Claude the new Mothra? Is it Gamera? Is it Godzilla? Are we now looking at Claude?
Hydra?
I don't know. Dom, thank you.
It's my
Please
favorite.
Not Mecha Godzilla, though.
Dom Chu.
Shin Godzilla.
Coming up, a power check on healthcare on a stock that's down double digits in the past year, but our portfolio manager says now is the time to go discount shopping for it. We will reveal that name next. Welcome back. It's time for today's Power Check. In doing so, let's first reveal our mystery stock from before the break. It's Intuitive Surgical. And despite the 11% year-to-date decline, it's one of our next guest's highest conviction positions. And there's an AI reason for that. Tom Hulick is the CEO of Strategy Asset Miners. Tom, and you think this is going to be a company that starts telling us how AI is helping it grow profits. Is that right?
Oh, it is, and nice to be here rather than be in New York. But you know, we're right now in a real-time adaptation cycle where automation and AI are disruptive, yes, but things are really accelerating so much for productivity margins and this long-term economic growth. So, would love to share more about that.
Yeah, well, you're hating on New York too. I mean, it's like it's fine. You know, New Jersey. You can come to New Jersey next time.
Lived there for many years.
There we go. We don't have time to get into Lockheed, which you like, but I do want to ask you about Palantir, which has also been hit hard amid the software slump this year. But you think this is one that, again, is going to turn around and get its mojo again. Why is that?
I do. You know, so Palantir sits at the intersection of AI, also defense and enterprise automation. And it's important to know that it's moving fast beyond experimentation to deployment. Palantir isn't just building models in the software, and it's integrating these into AI operational workflows. So for government and defense, a demand for AI-driven decision systems accelerating, we're going to see Palantir participate in that in the long run. We really like this company.
All right, I know you've got a lot of tech too in your top holdings, Broadcom, Microsoft, Alphabet. So we'll see what happens with NVIDIA after the bell. Tom, come back. We'll talk about that, about your power themes here. A lot to discuss around the table. Appreciate it.
Thank you very much for having me.
Tom Hulick with Strategy Asset Managers.
All right, well, from Tom to tahini, fast Mediterranean chain Cava also popping today. That stock having its best day ever. It's up 25%. Same-store sales rising, even with menu price hikes, Kelly. It's had a good year. It's down 15% over the past year, but that's actually pretty good. Consider the last 12 months, Chipotle's down almost 30%, and Sweet Green saying, hold my salad. It's wiped out 3/4 of investor value, so down 15 is the new good.
That is even better for Cava, given its peer group.
All right, up next, why one of the richest men in the world just went hard after your washer and dryer. Sorta. All right, here's where we remember that tease before the break. Hedge fund legend David Tepper blasting the bosses of one of his largest holdings, Whirlpool, in a scathing letter. The billionaire and owner of the Carolina Panthers accusing Whirlpool of destroying, quote, hundreds of millions of dollars in shareholder value. And now Tepper is calling for a strategic reset of the company. You may have a point, Kelly. The stock's down 60% in the past 5 years.
Yeah, he was really upset, I think, that they are issuing equity as well. So again, this is the fun of being public. You know, you have to be held to a higher, so you can have people like Tepper coming after you and saying these decisions make no sense for shareholders. See how they respond to that. Meantime, moving the other direction today, quick look on the crypto space because Bitcoin is back above 69,000 after what we heard. With the other altcoins are bouncing back as well. The crypto exchanges are flying. All this really goes back to Circle's earnings. Brian, you probably saw the stock. It was up at last check 29%. There you can see some of those names.
Well, I'm glad the crypto winter is thawing. If only the winter would thaw. I know in New England and Boston, they're like, don't talk to us. They got 40 inches of snow.
Yeah.
This needs to end. This cold weather, I'm done. I'm sick of it. I can't deal with it.
I like how Tom said, I'm glad I'm not in New York.
Anyway, thanks for watching Power Lunch, everybody.
Closing bell starts right now.
All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. And this make or break hour begins with the big countdown. NVIDIA, Salesforce, and Snowflake all reporting earnings in overtime tonight. And our team of experts, there you see them, they are at the ready with everything you need to know to get you set up for a critical evening. In the meantime, let's show you the scorecard with 60 to go in regulation today. We are higher across the board today, led by the NASDAQ, 1.25%. The mega caps are looking pretty good, and so are the software names. That hasn't been the story that many times over the last 6 months, but we're watching that very closely. And look at them. They are all running into these numbers tonight. Elsewhere, the banks and private credit names are green. Our focus pretty heavy there as well. There's Blue Owl in the center of a lot of these questions, up more than 6% today. Not so much for First Solar, though. It's been a big decliner on the day, near 14% on its outlook. TJX, they beat and guided ahead of the street. That stock, though, not doing too much on that. We'll watch all of that. Does take us to our talk of the tape. The future of the tech trade, arguably on the line tonight, as NVIDIA and those three of those marquee software names do report. So let's welcome our panel to discuss. CNBC's Christina Partsinevelos and Seema Modi. Star Bernstein analyst Stacey Rascon, along with CNBC contributors Capital Area Planning Group's Malcolm Etheridge, Requisite Capital's Bryn Talkington. It is so great to have everybody with us. The first ever 6-box on the closing bell, at least when I've been doing it. So here we go. And it's worthy, Christina, because this is a huge night. We're going to start with you. What matters more than anything else?
Commentary from Jensen on the earnings call. Largely, the street, every single guest on our network, retail investors, everybody seems to be very convinced that earnings are going to be a beat, maybe to the magnitude of roughly $3 billion for revenue that just passed. And that's because the supply chain has been telling us this for quite some time. Foxconn, for example, one of their suppliers worked through Chinese New Year just to keep up with orders. And then the second thing is the hyperscalers that keep spending. So we kind of already know that earnings are going to be great. It's more, what is Jensen going to say to the audience, the retail crowd, the investors, the Stacey Rascons that are going to be on the earnings call, that are going to convince them that demand is going to remain sustainable well beyond 2027, that backlog is going to increase, that partnerships are going to increase, et cetera, so that we know that money isn't going to disappear over the next year.
All right. Well, Stacey, Christina called you out, so I'm going to go to you next. I mean, what do you need to hear from Jensen tonight?
Yeah, you bet. So you're right. We do expect the numbers to be fine. He's not walking around, like a CEO who's worried about his quarter, and clearly all the supply chain checks suggest like massive demand. I think the worry is you look at where NVIDIA is trading versus like some of the other names in memory or semi-cap or whatever. There's a pretty big divergence there. People do seem to be worried that we're approaching, call it like a local peak in spending, given the magnitude of the hyperscale, the dollars and everything that are getting spent this year. And I think what people need to believe is that we are not at a local peak, and that this can continue, not just in 26, but in 27 and beyond. And so anything that Jensen can give us sort of on that forward view and that forward roadmap and trajectory would be helpful. I think the other thing that people want to get comfortable with is gross margins, because component costs and everything are rising. And the company has already said that they think they can hold gross margins in that sort of mid-70s range this year. And people are going to want to get, like I said, some sort of comfort that can still be a sustainable thing as we go forward. And we'll see what they have to say, but like I said, the general dynamics of the industry and the demand environment all seem to be going in their favor right now. Again, I'd expect the headline numbers and everything to be very, very strong.
But that suggests, I guess, when you talk about gross margins, because I feel like that's an undertold an under-discussed part of this story. All you need to do is look at Micron shares, for example, and you realize how much these companies are paying for memory. As to whether NVIDIA, I suppose, could continue to raise prices for their best and brightest chips to offset the increased prices that they're paying for memory. Are you worried that that's going to wane at some point?
Well, I think the holding margins this year is a combination of two things. One is procurement. So they were out in front of this like much before anybody else. I mean, he was in Korea, eating chicken and drinking beer with, the chairman of Hynix, like not that long ago. There was a reason for that. So they've secured, memory earlier before others. So I'm not really worried about them getting that supply. That's good. But on the pricing front, you're absolutely right. They need to take prices up because their costs are going up. So it's imperative on them to make sure that they're improving performance much more than they're taking up price. That's actually their ceiling in my mind. It's not anything else, competition or anything. It's the amount that they can improve performance. He already gave some data points on Rubin at CES, and it was something like I don't know, 10x or whatever it is. And I mean, as long as they can keep performance improving on that kind of a trajectory, I'm not really worried about their ability to price to it, because it's still a very NPV positive thing for their customers. If pricing is doubling and performance is going up 10x, most customers will take that all day long.
I mean, it's interesting, Malcolm. Yes, the stock has started to run again into the number, which does something to expectations, I would suppose. But according to Vanda Research today, retail conviction is soft into this number tonight. We know that shares have seen somewhat of a muted reaction on the backside of most recent earnings reports, the last three. The stock's gained or fallen less than 3.5%. What moves the needle for you?
Yeah, I think that Stacy's point about productivity getting stronger could create sort of a good news is bad news kind of scenario, where maybe the market sees that as an opportunity. I personally trimmed last week, might trim again depending on how shares go after the close, because my concern now is the market might start reading this as, if we can get more productivity out of our chips, if Rubin does actually increase output by a factor of 10 or something similar, then that's a little bit scary in the sense that maybe we don't need the level of chips that we have back orders for, and that starts to cut that number in half. And we've already gotten questions on previous earnings calls from analysts about the validity of those RPOs and whether we can see those all the way through, how quickly they expect to actually turn that inventory and make good on all those receivables. So I think we might see a scenario where the shares start selling off after the print, just because we get good news.
And the other thing, Bryn, is that if you look at the PE, NVIDIA is like the cheapest it's been in a long time, which is another maybe untold story as part of all of this.
Yeah, the stock gets cheaper every single quarter because they're going to have, 72% earnings growth, which is just historic with a company this size. And so each quarter, the stock, from a multiple perspective, gets cheaper and cheaper. The reality is, I love the setup today. I've been talking about this 195-200 stock price has been really like that outer Earth orbit that it couldn't get through. If it punches above that after earnings and after the call later on, I think the stock goes higher. I think what I'm looking for also, and I think he'll talk about it, because a lot of the bears obviously talk about the depreciation, the useful life, et cetera. And I think I want to hear about that, about the useful lives. How many years are people actually using even the H100s? It seems like much longer than people anticipated. So we know the call is going to be great. But just remember, this is a cheap name. I think it deserves to be in the 250s, not a one handle. And so I'm hopeful that it can get above that. But it is a good setup, I think, the price action going into this print.
Christina, what do you make of what you heard?
Well, Britton just talked about the depreciation. We know that even just the A100, which is a much older chip, is repeatedly used as a line that has been sold out. CoreWeave, which also supplies a lot of these chips, has talked about, demand just being through the roof. You see pricing going up for so many older chips. So I think that really strengthens the argument that demand is staying intact across the board. In terms of the stock, though, in general, the company has beat, you said 3.5%. Lately, over the last 2 quarters, we haven't seen as much of a positive reaction post-earnings. But for that, if those looking for that $5 trillion number, NVIDIA needs to hit 205.76. So we're still a little bit away from that number at 197 right now. But there is room for growth, and especially tomorrow morning in the open. The first hour is really key for NVIDIA.
Oh, it's a good point you make. Stace, what about the angle of of competition. Thought it was interesting that Rothschild and Redburn put out an open letter to Jensen Huang today. They do talk about that, and they talk about recent deals that AMD's done with OpenAI and Meta, illustrating this, not only the strength of NVIDIA's own market position, but the fact that rivals are determined to be even more competitive. I mean, I raised the issue with Jensen a few weeks ago out at the Super Bowl, and he said, you know, none of that bothers me. Should they be more concerned about their competitors who are making different kinds of chips and the ones who want to be, you know, have a little more of the action?
Yeah, I guarantee you he's cognizant of the competition, like he's not dismissing it. But right now, I feel like the question sort of misses the point. You know, I get this a lot on like the whole like GPU versus TPU kind of area. And it's like, the question is not who's winning or losing right now. It should be like, is the opportunity still big or is it not? If it's big, lots of them can thrive. If it's not, like, everybody's screwed, right? So that's, and I don't think that's where we are right now. I think you can look at some of their other competition, though. I mean, Google and TPU and everything are one thing. You got AMD, you know, like AMD announced their deal with Meta yesterday, but it's the same thing. They're giving up, you know, chunks of the company in return for that. But I'm not blaming AMD for doing that. I understand why they need to get to scale, but I think you do have to view their relative competitiveness like through that lens. Like it's clearly in NVIDIA's game to lose, and I don't think Jensen's in this game to lose it.
I can't even imagine what would happen in the marketplace or how investors would take the news, Malcolm, if NVIDIA does everything that everybody has already said needs to happen, or they would love to hear from Jensen. They lay any fears that are out there, but the price action isn't great after the fact, inside an already jittery tech trade. What do you think about that?
Well, I think that we have to consider the way the market has been trading in recent weeks or months. Good news should have been received as good news. If you think about the earnings period we're in, starting with the banks, then moving over to tech, earnings growth is solid. Earnings are not driving the market the way that we would expect them to. Otherwise, the companies that are down year to date would be leading. And so I think that we have to at least consider that the stock and the company are two separate things right now. And the way that the market is responding is not necessarily indicative of the strength of NVIDIA or the importance even of NVIDIA. And I also think, to your question, if we do see the semis start to roll over and that trade start to break down, that is going to be really meaningful to the downside to the broader market, I think, near term.
Well, I don't think anybody wants to see that. The other idea, Seema, is that maybe leave it to Jensen Huang to try and save the software trade, too. I mean, there's a suggestion among our guests today that he may, you know, say something to try and defend what's been happening within the software trade, but a really good earnings report from NVIDIA just might be a rising tide lifts all boats kind of thing, or at least takes the pressure off, because the pressure, as you know, from covering this space has been so heavy.
It absolutely has. And when watching just the divergence between chips and software, it's been quite dramatic so far this year. And so we'll be watching what CEO Jensen Huang has to say, not to mention CEO Mark Benioff of Salesforce, as that company gets set to report tonight. The focus for that company will be Agentforce, right? Provide concrete numbers as to how this business is gaining traction, with now every software company really providing some type of AI agent. And those key metrics around annual recurring revenue, remaining performance obligations, those are the two specific numbers that investors are going to be looking for. What we've been finding so far this earnings season, Scott, as you know, if any of these software companies miss on earnings or guide light, that in a way reinforces the AI disintermediation fear. So that's going to be key too for these companies, given all the volatility we've been seeing in these names. Can you just deliver a clean beat? Can you provide some guidance on what the next 6 to 12 months look like? I would look to Workday, which actually saw this dramatic 13% reversal today. And the CEO, Anil Bhusri, talking about how as they embed these agentic capabilities into their workflow, you're not going to really see the benefits till the second half of this year, Scott.
Malcolm, you got ice in your veins, my man. I mean, because you've been buying into the SaaS apocalypse, as people are calling it, right? And you've been doing that lately. What gives you the conviction to do so?
Yeah, I have been buying, like you said, some of my favorite names that have been on deep discount. I think that this is completely overblown, and I think investors who are watching what's happening right now, wondering whether now is the time to jump in, they're still on the sidelines. I think 12 months from now, they're going to look back on this as a missed opportunity. I think that what we should be doing is considering the way that these different companies bill their customers, and if it's on a per head count, on a per seat basis, like Salesforce, for example, derives a lot of its revenue. A company like Amazon that's cut 30,000 jobs in the last 12, 18 months is meaningful for that company because it's per head count. But on a per usage basis is going to make a totally different impact on a company. That's what drives the annually recurring revenue figure that Seema was just talking about. So I think about IBM, for example, as a company that's out there doing a lot of consulting work, helping companies figure out how to actually embed and then deploy their AI strategy across the company. That company shouldn't be selling off the way that it has in recent days. And so to me, that's an opportunity to be adding names to a portfolio or adding to positions that a year from now we're going to look at this and say it was completely overblown. Yes, there will be some companies that get completely taken out by this moment of disruption. I don't want to discount that whatsoever, but I think more than likely we're going to see a lot of M&A start to pick up amongst the space. That's going to be great for shareholders, and I think also we're going to see a lot of those names start to get bid back up, which already, to your point I think you were making earlier, has already started to happen today.
Bryn, you used to own CRM, which is Salesforce, of course, and you sold it near where it is now. I mean, what would get you to buy it back? Anything that could happen tonight?
Well, I feel like they're going to have 9% earnings growth. Obviously, a founder-led company. I just feel like the sentiment is just so negative on this name. And I love what Malcolm said about the seat count, which is an issue for Salesforce. So I'm definitely going to listen to the call. I would love to get back in the name, but technically there's been a lot of damage. So I don't like buying stocks at 52-week lows. I think it's close to that, but I'll definitely be listening. Would love to get back in the name because I do think it's a strong company. And I do think this whole dystopian view, Centrini's story, their novel, is one narrative. And I think, I'm very positive on how AI is going to actually help a lot of these companies. And so I do think that we're going to hear from Jensen and Mark Benioff this opposite of this dystopian view we've been hearing recently about AI taking over everything and the negative impact. I think it's going to be more positive.
Seema, you feel like of the two tonight, it's CRM that has the most to prove?
Definitely the most to prove when looking at Salesforce versus Snowflake, the two software companies set to report tonight, because the stock has been so pressured, and to what Bryn was just saying about how the sentiment has been so sour, and this being such a big name that has made this huge pivot into Agentforce, and there's been criticism as to whether there's been some big customer wins. So we want to hear not only do the numbers stack up, but show us examples of how your AI agents are being integrated into large Fortune 500 companies. And is there a runway there for this company? So that's going to be key. And then, for a Snowflake, and is there any type of color on that deal continuing? Because there is some concern that the hyperscalers at some point can provide that data warehousing skill that Snowflake currently does.
All right. Well, you guys crushed the first 17 and a half minutes. Appreciate everybody. Enjoyed the conversation. Thank you. We'll see what happens. Christina, Seema, Stacy, Malcolm, and Bryn. So what does all this mean for the market? JP Morgan Private Bank's Abby Yoder joins us now at Post 9. Welcome back.
Thank you.
All right. How much of the tech trade hangs on what happens tonight with all of these companies reporting?
I mean, it is a lot. And I think that whole conversation was really interesting to listen to, and there was a lot of talk about sentiment and what could make it work. I don't know that tonight is going to be that answer, right? Like, I think, yes, on the semi side, there is this question on whether or not we're at peak CapEx from the hyperscalers. I don't think that's going to be the issue because I think there's a supply constraint. On the software side, I think we talked about this last week. This is a sentiment overhang that isn't going to be answered in one quarter, right? Like, this is going to take several quarters of proving that they're not obsolete. And so, yes, it would be great if we saw a revenue acceleration on a sequential basis, but we're going to need to see several of those. And the other thing that I think would help sentiment around here, which we saw a little bit of today, is these companies, these software companies, starting to buy back shares, right, at these prices, right? That could signal some confidence in terms of
Because there was a suggestion, I feel like it was a few weeks ago already, like, where's all the insider buying?
Yeah.
Right?
I think that's a big question.
There was a dearth of it.
Yeah.
You had to look like far and wide to see anybody stepping in to buy their stock.
Right, in which you can imagine if you're a read through to like an investor, you're like, well, if they don't have confidence in it, why would I, right? So, but we've started to see a little bit of that come into the market, and I think that's encouraging from that.
You hit a good point. Fundamentals are going to take time to play out. This is an entirely, you would think, a narrative-driven story.
Yeah.
Right? A research paper comes out that, from not even talking the one this week, I'm talking about the one of a few weeks ago.
Yeah.
Company that used to make karaoke machines puts out a news release, and next thing you know, it's like sector by sector by sector. It's like dominoes going down.
It's 100% sentiment driven, because obviously when you look at software right now, the earnings revisions on a 1 to 2 year basis are positive, right? So this isn't about, okay, what's going to happen to software earnings in the next 1 to 2 years. This is about their terminal value and ascribing a certain valuation to that, which I think the market is just wrangling around right now. And there is an element of was software overvalued heading into this, right? And so there's a sense of just valuation compression at the moment, back to normal, and then a recalibration on what the end growth markets look like.
So because it's going to take time then for the fundamental story to show itself.
Yeah.
Does that mean that the tech trade more broadly is going to be choppy for the foreseeable future?
It seems that way because, like the panel just discussed, I mean, and like you said, we don't want this at all. We don't want semis to break down, right? Because if that were to happen, then tech really doesn't do well. But what's been interesting is you've actually already seen, just because of the damage in software, a 5-turn multiple reduction in tech to start the year, right? We went from like 29 times to 23 to 24 times. That's a massive, massive change, right? The 5-year average is something like 25 times. So I think this chop continues where there's a lot of, different moving, the industries are moving in different directions, and semis continue to lead the way there.
Where are you hiding out? I mean, where would you hide out? If you think there's going to be some more volatility in tech and kind of the rest of the market trade, been doing okay, but not like it was, to start the year.
Right.
Where would you go?
Well, I mean, it's hard mathematically for the index to do well when tech isn't doing well and financials aren't doing well. That's the other big component that's very interesting. But I think right now when we're looking at the leaderboard and we're thinking about what we have conviction in, it's not energy, because the supply dynamics there are not great in terms of our outlook for where oil goes.
Which was like the best performing group.
Yes, with negative earnings revisions, right? So it's been all multiple expansion. And so when we think about that type of cohort, and I know you've talked about this heavy asset, low obsolescence, it would be more on the industrial side, not only because it participates in that, but it has so many different structural growth drivers behind it in terms of just fiscal policy, traditional, monetary policy too, picking up from a manufacturing perspective. So that's really where we're leaning in terms of
Are you, since you mentioned the halo, the so-called halo trade, right, coined by our very own Josh Brown,
yes.
Are you spending a lot of time on that? You think other strategists are too? Just trying to pick through the market, turn things over maybe more than you otherwise would to see what has some level of perceived immunity?
Yeah, I mean, I think yes, that is certainly happening at a market level. And I do think that there is just this, it's interesting because this is not like this is a new concept, right? That the administration has been really focused on industrial policy, that there are these levers. There's a lot within the OBBA that incentivizes that type of spend. But it is interesting that it kind of took the combination of those policies coming to fruition, entering 2026, I guess, and then a shakeup of the tech trade. That's where you started to see the money really flow. And I think the other interesting place where you've seen that, and I think it's a related trade, is to EM Asia. I think there's a connection to that trade as well.
Great insight to help us wrap up what we heard from our panel. Abby, thank you.
Thank you.
It's Abby Yoder. Let's send it back to Christina now for a look at the biggest names moving into this close. Hi there.
Hi, well, let's start with Cava having its best day ever. Shares right now surging almost 25% after its Q4 results and full-year outlook just topped estimates. The restaurant chain also reported full-year revenue of more than $1 billion for the first time ever. The company said the pullback it saw among younger customers last quarter has come to an end. Shares of Coinbase also rising right now after the crypto exchange launched 24-hour stock trading on its platform. The move is part of Coinbase's strategy to expand beyond crypto trading to include stocks, ETFs, and prediction markets. Shares up almost 14%. And shares of First Solar moving the opposite direction after posting weak earnings and full-year revenue guidance. Shares literally opposite direction, down 14%. The CEO said, given the new 15% tariff that President Trump just announced, the solar panel maker anticipates the impact from tariffs will total between $125 to $135 million, hence the sell-off. Scott?
All right. We will see you in a little bit. Christina, thank you. We're just getting started here. Coming up next, growing private credit jitters. Another Wall Street titan now sounding the alarm on that space. The details just after this break. Welcome back. Private credit concerns once again front and center today. I asked Avenue Capital's Mark Lazary about the software piece of private credit and concerns about where some of those loans are marked. Listen.
Of course, you should be concerned. I mean, we should all be concerned. Today, would you want to make that loan at par? That's the real question. And I think the answer to that is no. You'd want more collateral. You'd want a higher EBITDA. So things have changed, but you don't have that luxury. So if I was going to go buy that, or other people wanted to buy that loan, you'd buy that loan at 80 cents. You wouldn't be paying par for that loan because you're not getting paid enough for the risk you're taking.
All right, interesting thoughts from Mark Lazary. Now, another well-known investor is weighing in with his own warning. Leslie Picker joins us now with that. Hey, Les.
Hey, Scott. Yeah, Saba Capital's Boaz Weinstein reiterating his view on private credit that it was at iConnections yesterday in Miami, where he said the wheels are coming off the car in the asset class, noting its super early innings. Weinstein had said a few days ago on X that his firm was actually long the stocks of Blackstone, Ares, Apollo, and even Blue Owl. And I say even Blue Owl because alongside Cox Capital, Saba had offered tenders for investors in several of Owl's unlisted funds, which thwarted withdrawals recently. The hedge funds are offering a steep discount of 20 to 35% of the estimated net asset value. However, that discount is actually typical for listed funds. We listened to a client call Blue Owl hosted earlier in the week where they sought to assuage rattled investors. Co-CEO Doug Ostrover said the headlines, quote, misconstrued the announcement and they were surprised by the recent volatility. The firm thought that the market would be happy about the $1.4 billion in loans that were sold at 99.7% of par, kind of what Lasry was talking about there. But quickly, the focus turned to the change in redemptions to quarterly returns of capital. Today, though, those shares of Blue Owl are rebounding. And also today, UBS is out with a note upping its worst case scenario for private credit defaults. Now that figure is 15%, an increase of 2 percentage points from where the firm had it earlier this month. And that's about 3 times the current default rate as we reported yesterday for our Inside Alts franchise, Scott.
Yeah, let's stay with me for a minute. I mean, because more people are obviously talking about it. I also asked Mark Lasry, as you might have heard, about what Lloyd Blankfein recently told the Wall Street Journal, criticizing those in the business for leaning more heavily into the retail channel. Here's what Mr. Lasry told me about that.
You can only give liquidity when there's no issues. And the minute there's an issue, everybody wants to get out, and especially retail investors. So I think Lloyd is absolutely correct. It's wrong, but it's a business, and people love that business because they can get large fees from it.
And an incredibly fast-growing still business, right, Leslie?
Oh, yeah. And that's the key point of all of this is right now, actually, the retail involvement in this space, in the private market space, is still relatively small compared to the size of the overall private markets. A McKinsey report just had some numbers about this. They said that in 2025, the retail capital flowing into alternative private markets, that's private credit, that's private equity as well, that reached about $204 billion, which was more than double the 2023 level. But that's still just a fraction of the overall multi-trillion-dollar private markets. Now, the problem, as these managers see it, is that that is the key growth area for them. They've all set up these wealth divisions in recent years with the idea of, okay, we may have, largely saturated the market for institutional investors, but the growth will come from high net worth individuals and maybe one day down the road, even just regular retail investors as well, potentially even 401ks, which is something that the government is looking into right now. And so the important part of that is this is kind of the next leg of growth for these managers. So all of these headlines and all of this drama and concerns about things being called semi-liquid but not really liquid, that all has massive ramifications potentially for kind of that down the road growth plan.
All right. Appreciate that, Leslie. Thank you. That's Leslie Picker. Still ahead, the drama between Anthropic and the government heating up yet again. The details coming up. And later, what to watch for from the big earnings reports in overtime. We told you about some of them. They're right on your screen. NVIDIA, Snowflake, Salesforce. Bell is back after this. All right, we're back. The battle between Anthropic and the government taking yet another turn today. Kate Rooney joins us with those details. Hi, Kate.
Hi, Scott. So Anthropic still faces a Friday deadline to allow the U.S. government to let the Department of Defense use its AI technology, no questions asked, or to be labeled as a supply chain risk. This is according to sources. And the government could invoke, I'm told, the Defense Production Act as well, basically forcing the AI company to comply. Anthropic did tell us in a statement that they're still negotiating. They do hope to come to an agreement by 5 p.m. on Friday. Anthropic investors I'm talking to out in Silicon Valley do worry about that supply chain designation and what it means for their total addressable market, any sort of chilling effect it could have for enterprises. CEOs, of course, are already pretty nervous about getting offsides with the administration. One investor described the spat as a lose-lose for Anthropic. So if they acquiesce, they're going to be seen as backtracking on safety, and if they don't, could get them offsides with the administration, with the White House, and potentially hit their reputation as the sort of the safe AI player. But speaking of that, at the same time, Anthropic dropping its flagship safety policy. So executives told Time that with that rapid advance we're seeing in AI, it doesn't quite make sense for us to make unilateral commitments. Talked about competition out there. Investors also tell me there hasn't been much pushback, though, on dropping that safety designation. It all comes down to power and the power of this technology. Dario Amodei saying in a podcast this week, he compared AI to a tsunami that no one is preparing for, Scott.
Well, I mean, continuing kind of what he's been either saying or writing, so maybe not a surprise, just a continuation of some of the concerns that he has. Speaking of Anthropic, I thought there was an interesting piece in the Wall Street Journal today, not specifically throwing any cold water on the potential of an Anthropic or an OpenAI IPO, but just current market conditions and how they might be impacting the IPO market this year, which was expected to be pretty robust as it relates to tech.
It's such a great topic, Scott, and as we talk about some of what are poised to be some of the biggest AI IPOs, but IPOs in history, really, volatility is such a big issue. I talked to a banker about this recently who said, you look at the markets the last couple of weeks, where you are from Monday to Friday is just completely different. They were saying, if you're planning, you have to start preparing for an IPO, call it 9 months ahead of time, maybe even a year. There is just no way to predict. So with that said, he was saying they're doing their homework. They're getting ready to IPO. I think it's going to come down to the actual quarter that they're in, looking at the markets and saying, what does the volatility look like? Do we expect this window to stay open? But the window is so narrow. The markets have just been so reactive to AI. You can see sort of a massive sentiment shift would really affect their willingness to go public. And there's also this debate of who's going to go first. Does Anthropic want to wait, let OpenAI go, sort of test the waters? So they are definitely doing their homework, from what I'm told, and sort of putting volatility aside, saying we can't control that. It's been crazy, but give us 9 months. We'll see where we are at the end of the year.
You had this other piece of news regarding OpenAI today that was pretty fascinating in its own right. This sweetheart deal, if you want to call it that, for Thrive and their investment into OpenAI. Give us more details, please.
Yeah, no, Scott, that one, it's dog years. So much happens in the scope of a day. But Thrive Capital basically got sort of a discount in an OpenAI round. So this was late last year. They got it to a discount at what it was sort of trading for in private markets. So lower than the $300 billion valuation where it was last year. But it does speak to the close relationship between Josh Kushner, who has just become a prolific tech investor. I would say his relationship with Sam Altman, clearly they have an inside track to some of these deals. This was, again, last year. This company, OpenAI, as we're talking about, is in the midst of raising what could be a $100 billion deal. I'm told Thrive is set to participate in that. They would not comment on it, but sources telling me that is the sort of financial part of that. There's the strategics. You got NVIDIA, SoftBank, names like that, Amazon as well. And then you have the more core financials, venture capital investors, where Thrive is set to be a big player there. So interesting, private markets is not as straightforward. You're able to get sort of these interesting deals on the back end, and Kushner and Altman definitely close, definitely paying off for him.
And worth underscoring, just again, like we did on halftime, this is all about the timing of a deal between Thrive and OpenAI, rather than a question about OpenAI's valuation in any way, shape, or form.
Exactly, which you pointed out, it's approaching in this next round close to $1 trillion. So the numbers, they may sound eye-popping based on what we were talking about last year. Flash forward we are now hitting the $1 trillion numbers basically for private markets, which is just a level we have never seen and is completely unprecedented.
Yeah, it's astounding. Kate, thanks.
Yeah.
Kate Rooney.
Thanks.
Up next, the biggest movers into the close. Christina Partsenevelos is standing by once again with that. Tell us.
A web services giant hitting multi-year lows on a weak outlook, and a biometric firm surging on a strong quarter. And lastly, a tech blue chip getting a second look from Wall Street. I'll have those details after the break.
All right, we're less than 15 from the bell. Let's get back to Christina now for the stocks that she's watching. Tell us more.
Go Daddy. Yeah, getting hit hard today, down about 14% after its revenue outlook came in lighter than Wall Street expected. The company has really just made a big bet on AI to help small businesses run their online presence, but so far customers just aren't biting at the pace investors had hoped for. The stock now at its lowest level in more than a year. Shares of biometric company Clear popping right now, 38% after earnings and revenue for its latest quarter came in better than expected, as did its Q1 revenue guide. The company said its total Clear members, all those stations and airports, grew to roughly 38 million people, up over 30%